So guys, we'll start off with that consolidation question. Okay, start off with that one. Okay. So guys, actually all the questions what I have taken are guys past paper questions from the exam kit, right? So this paper guys is already in the WhatsApp group, right? So you can check and see. So we'll quickly first do the full mock paper discussion. Right. Anyway guys, today after the class is over, I'll be marking and you will know your marks, right? Okay. Okay, then guys, let's start over there then, right? Question number 3. Right, now guys, question number 3, they are asking, okay, right, requirement number 1, prepare the consolidated statement of financial position as the 31st of December 2019. Now guys, as soon as you know it's an SOFP, right, always guys, what you do, right, you leave a couple of lines, okay, not couple of lines, right, I would recommend you to leave guys roughly around, let's say, somewhere around 20 lines in your spreadsheet. Okay, so today guys, if possible, now once I do the mock paper discussion 1:30 3:30 guys, we will do a question on the platform and see, right, because now it's high time we start practicing questions on that one. Okay, right. So when you guys take then question number 3 over there, right, you know it's a consolidation, leave 20 lines, and then guys, as always, you start with your workings. So I saw most of your papers, they all have done that working part properly. That one is okay. Okay, right. So let me guys now start marking then over here. Right. Working number 1 guys, we have, okay. So guys, working number 1, we have the group structure. Right, leave around 4-5 lines. Then guys, working number 2, net assets, okay, of subsidiary. Right. So guys, for net assets of subsidiary, we normally have 3 columns, right? We have acquisition, then we have reporting, and also guys, we have then post acquisition. Right, then guys, you leave around 1 2 3 4 5 6, around 6 lines. If you leave, then that should be fine. Then guys, working number 3, we have then goodwill, right? So wait, okay. Then guys, for working number 3 guys, first thing we have investment slash fair value of consideration, okay. Then guys, we have plus fair value of NCI, right? Then guys, minus net assets at acquisition date, right, which is working number 2. Okay, then we have guys goodwill at acquisition. Then guys, remember sometimes there can be impairment, but I don't think in this question we had any impairment. Along with that one guys, we have goodwill at reporting. Right, then guys, we have working number 4, consolidated retained earnings. Right, for that one guys, we normally have brought forward of parent upfront, and then we have post acquisition reserve, right? I'll go in short form, right? Leave a few lines. Then guys, we have after that one working number 5, non-controlling interest. Right, below that one guys, first thing we have fair value of NCI. Below that one, once again PAR, right? So we can now start the question. Right, now guys, first of all, you always start with working number 1. In working number 1 guys, what is the first thing that you should do? Timeline. Right, now see, this question is finishing off for 31st of December 2009. So if it's finishing for 31st of December 2009, okay, that means guys, this question has to start on, okay, when 1st of January 2009, right? So this is when the question has to start. Right. Now let's look at the first part. On July 2009. Now see guys, question is starting on January. July 2009 means after the year starts now, right? So if you see that the question is starting off guys after the financial year starts, then it means that what you can say, guys, this question. Okay, regardless, right? So remember, guys, if it starts after the financial year starts, guys, that means it's a what? It's a mid-year acquisition, right? It's a mid-year acquisition. So let's start, guys. P acquired whom 80% of S. Okay. So guys, when you acquire 80% of S, guys, there is a 20% NCI. Now, guys, most important thing, these people bought the company on 1st of July 2009. Question is starting on January. So it's after the financial year starts now, guys. So that means, guys, remember, this is a how many month subsidiary? This is a 6-month subsidiary. You should have identified that. Then, guys, you should understand one small thing. If it's a mid-year acquisition, in SOFP, you have to be very careful. That's because, guys, this part over here, right? That is in working number 2, guys. We have something called retained earnings, no? Right? This retained earnings will not be provided to us, right? The retained earnings, guys, at the acquisition date will not be provided, right? We only should find that. So as a student, guys, this is what you should know, right? As soon as you see in the SOFP, it's a mid-year acquisition, you should quickly understand a separate working must be done in order to find this answer, retained earnings at the acquisition date. Now that we know the group structure, guys, now let's start copying the numbers like how you would normally do. Okay, right. Now you have to copy the numbers, right? So let me, guys, then start over here. So guys, do the basics right always, right? P group, right? Consolidated statement of financial position, right, as at 31st of December 2009. Okay, now, guys, let's start copying the numbers, right? Starting, guys, we have non-current assets, right? PPE. So, guys, I'll write short form, but in the exam, guys, it's always better if you can write the full form and show it in the exam. Okay, so we have, guys, over there, then first thing, right, PPE, right? So, guys, under PPE, guys, we will have over there, right, first one, 215,000 plus 87,000, parent plus subsidiary, and keep the bracket open. Next one, guys, we have then investment, 297,000 plus 11,000. Done. Now, guys, remember, after investment, what should the always working be? Working number 3, guys, which is going to be goodwill, right? Also, guys, always leave 1 or 2 lines, because remember, guys, in the paper you might have, now in this paper when I read the adjustments, I saw that there is also a what? Associate. There is an associate in this question. So always, guys, for safe side, just leave 1 line blank, because show associate, right? Leave that part. Then, guys, next line, put the heading, right, current assets, right? Below this one, guys, start writing inventory, right? Then we have, guys, trade receivable. Okay, right. Then, guys, after trade receivable we have cash. So copy the numbers and show, guys, over there, 61,300 plus 22,500. Trade receivable copy, 37,100 plus 15,600. Cash, guys, copy 1,300 plus 9,200. Right. Then, guys, we have total assets. Okay. Then we have equity and liabilities. Okay. Below this one, guys, first topic we have equity. Right. Below this one, guys, we have equity shares. So normally, guys, remember, parent share we can copy and show in the SOFP, guys. I'll mark it on the side, 270,000. Right. Then, guys, we have retained earnings, which is working number 4. Right. Now, guys, remember, retained earning brought forward is there, no? Okay. Right. Retained earning brought forward, we can't directly copy to the SOFP. Right. Now, normally parents SOFP, guys, we have to copy to the, what you can say, I mean, parents equity, we have to copy to SOFP. But retained earning, because there is a working, can you guys make sure you have copied it here in working number 4, right? Brought forward of parent, 214,300. This should be the answer. And also, guys, subsidiaries equity is then, we never copy that to the SOFP because that goes to working number 2. Now itself, guys, copy this and show. Okay, so let's mark it. Right, equity share. Right, so always remember, guys, for subsidiary, the equity share at acquisition and at reporting is always the same. This one is retained earnings at the reporting date. Done. Then, guys, come back to the SOFP. Right, start putting the next topic, guys. We have non-current liabilities. Okay. And then, guys, we have after that one, current liabilities. Copy and show, guys, non-current liability. We have loan, open bracket, parent, plus subsidiary. Over here also, guys, you can show now trade payable. Guys, I forgot to write under retained earnings, we should have non-controlling interest, right? Working number 5. Next one, guys, we have trade payable 49,400 plus 18,300 of the subsidiary. Correct. Okay, right. Then, guys, next one we have total equity and liabilities. Okay. Right, now, guys, I have done all the copying part. Now I can, what you can say, start doing the adjustments. Please take the same approach in your exam also. Set up the workings, do working number 1, and then you can start copying the numbers after that. Okay, let's start. On 1st of July, P paid 100 million in cash to acquire 80% of S. Now, guys, P is the parent. He is paying 100 million to buy subsidiary. What do we call that one, guys? We call that as investment, no, fair value of consideration. So first thing what you should do, the money that you paid to buy a company, number 1, guys, make sure you have marked it in goodwill, right? So make sure, guys, in goodwill you write 100,000 because 100 million, no, guys, right? So without 3 zeros, 100,000. And I have advised you, whatever that you copy in goodwill, please make sure you have deducted this from your investment as well, minus 100,000 from here. You should always do that. If not, guys, the double entry does not get completed. Right. Now all these numbers we have taken now. Right. Now let's look at this one, guys. The fair value of Scottish net assets were equal to the carrying amount with the exception of its head office. This had a fair value of 12 million in excess to its carrying amount. So, guys, head office fair value is more. So what do we call this one, guys, in consolidation? What type of adjustment is this? It's a fair value adjustment. Exactly. So normally, guys, when there is a fair value adjustment, what is the first thing that we should do? You should copy this inside working number 2. Right? Can you guys make sure yesterday mock paper, did you mark it over there? Right? Fair value adjustment. Right? So mark this one, show, guys, how much it's increasing. 12 million. That means 12,000. It's increasing at the acquisition date. Yeah. At the date of acquisition. Okay. So you have to mark it there. Now, guys, when you read that paragraph, have they spoken anything about the building after that? No. That means what? The building is still with you. Therefore, guys, you should mark this and show in the reporting column also. Always you have to do that. Okay. First, copy the increase in acquisition. Then see if there are any changes. Right? There is no change. So, same thing comes at the reporting column. Now, guys, when you do this, you know what happens? Goodwill becomes credit. Then where is it debit? Now, what's increasing? Head office value. Head office is a non-current asset. So therefore, guys, you have to increase your PPE. Then PPE will become debit. This is how the 12 million has to be marked. PPE goes up, add PPE debit. Copy this in working number 2. Goodwill will become credit. Okay. So guys, then that part is all done. Okay. Then, guys, let's move on to the next one then. What does it say after that? And also guys, they are telling it has a remaining life of 10 years. Normally guys, why do they give remaining life in accounting? To calculate what guys? Exactly, depreciation. But guys, you have to be careful. Take 12 million, divide this one by 10 years. Okay, but guys, after dividing by 10 years, now you have to be careful. These are how many months subsidiary? 6 months. Therefore, the depreciation, guys, you have to always take it only into 6 over 12 months, right? Only for 6 months only you have to calculate this and take, right? So therefore, guys, 12 million when you divide it by 10,200, 1,200's half, guys, will be how much? Just 600. No, 600 should become the depreciation. Now, how to mark this and show? Guys, when you depreciate, step number 1, your PPE value will fall. So therefore, guys, minus 600 over there for PPE. All okay, so PPE becomes credit. Then where is it? Debit. Always, guys, when you mark, check the double entry also as much as possible. So when you mark to PPE, PPE credit. Then guys, where should it be debit? Very simple. Whose property is this? Subsidiary. Subsidiary depreciation means it's subsidiary expenses, no? Subsidiary will always mark all his expenses inside retained earnings, which is in working number 2. So it's like this, guys. Always remember in consolidation, subsidiary income and subsidiary expenses is always marked in retained earning. Where is subsidiary's retained earning? Inside working number 2. So in working number 2 only you have to mark that and show, right? So you start writing, guys, over here then fair value depreciation. Now if you are having a doubt which column, ask yourself, when do you guys normally depreciate? At the start or at the end? At the end. At the end of the only, guys, we always depreciate. So minus 600 over here. So what's the double entry? When you write it here in working number 2, retained earning will become debit. When you copy it to PPE, PPE will become credit. This is the double entry. Okay, you mark it inside working number 2, retained earning will become debit, and deduct it from PPE, PPE will become credit. Right. Now guys, let's go for the second one. On 1st of July 2009, P also acquired 40% of A. Guys, remember, when you buy an organization between 22, what you can say? Yeah, under the group structure, you can mark it as P because that's a working, but what you said is correct. Top of the SOFP, and I mean like over here, and also for the workings, you have to show on top zeros. Okay. Top of the SOFP, we have to show zeros, and over here also we have to show zeros. PS, that's not an issue. You can mark that. No problem. Okay. Right. Okay, guys, then let's, next one, guys. What I was explaining, when you buy an organization between 20% to 50%, we call that organization as what, guys? An associate. So normally, guys, when there is an associate, you have to update this in the group structure. It's not compulsory, but as a practice, we normally do that. Now, guys, what happened? P also acquired 40% of A. So this is an associate. Guys, this also, can you see when did they acquire? On the 1st of July 2009. Understood? When you guys buy a company on 1st of July 2009, again, how many months we are looking at, guys? Just 6 months once again. So again, guys, we are looking at a 6-month associate. Okay, we are looking at a 6-month associate. So the moment, guys, you see associate in your lesson, right, in your paper, you have to, guys, now open working number 6. Right now, guys, can you open then working number 6 over there? What is the name? Investment in associate. Okay, right. Start writing the equation, guys. Right. First one, we have investment plus PAR. What is PAR, guys? Once again, post acquisition reserves. That means the profit that they have made for the year, right? Minus any URP, right? Minus any impairment. So this is the equation for associates, right? Okay. So set up that working and keep, guys, over there, working number 6. right? Okay, let's start, guys. On 1st of July 2009, P acquired 40% of A. P paid 30 million cash. So guys, to buy the company, we paid 30 million. What do we guys call that in accounting? We call that as investment. So next to this investment, guys, first show me cash. Right, we have paid 30 million. Done. Okay. In addition to this, P also issued the owners of A 30 million shares which had a market value of 2.3. The total consideration exceeds the group share of Angus Corporation net asset. P has only recorded the cash consideration. Right. Let me guys summarize what's happening there. This is what happened. Guys, to buy the company, we paid cash 30 million. Not only cash, we also guys went for what? A share exchange. But unfortunately, this share exchange has not been recorded. Only the cash consideration has been recorded. Parent gave some shares to buy associate, but they haven't marked that. It has been omitted. So first thing, let's calculate how much did they give. Right now, guys, look at this one. P has issued the owners of A 30 million shares where the market value is 2.3. Yes, I'll advise you. Always remember, when there is a share exchange, always try to find nominal value separately, premium value separately. Okay, you always better do that. If not, guys, what will happen? Your calculation will go wrong or you might lose marks. So if there is a share being issued, share exchange, please calculate both nominal value and what value? Premium. Right, now guys, look at this working. Share exchange, first let me find the nominal value. Right, and then guys, separately let me find premium value, and then let's have the total. Right, now guys, listen carefully. How many shares did the parent give? 30 million shares. So I'll mark here 30 million. Here also I'll mark 30 million. Right, 30 million shares were issued. Guys, look at this carefully. The market value is 2.3. Now I need to understand what's my nominal value. If you want to understand the nominal value of a share, what you should do? Go to the SOFP. Guys, here can you see in the SOFP, one share, what's the nominal value? $1. So guys, listen carefully now to what's happening over here. Right. The market value of the share is 2.3. The paper says nominal value is $1. So guys, out of 2.3, if $1 is nominal value, how much is balance then? 1.3 is balance, no? That 1.3 guys will become your premium value. Once again, parent's market value is 2.3. I want to understand what's the nominal value. So what should I do? Go to the SOFP. In the SOFP, guys, the value that they show is nominal value. So guys, out of 2.3, if this is nominal, what's remaining is no premium. That's why 1.3. Right, now start multiplying. 30 into 1, this is the nominal value. 30 into 1.3, this is the premium value. So guys, when I multiply, my answers are going to be over here, guys, 30,000. Over here, it's going to be 39,000. Total, I am getting 69,000. Right, can you guys mark this and show them over here properly? Right, this is how you should do that adjustment. Right. Now guys, students who did the mock exam, you check your answer and do the corrections. Anyway, you have sent me the copy now, so I'll be marking. Right, guys, I am explaining a little bit faster because some people have done the mock exam now. So the students who have not done the mock exam, guys, just let me know if you are not understanding how the adjustment is being done. Okay, we issued shares, I broke it as nominal value and premium value. Guys, now next part. Now we have a problem here. What's the problem? This has not been recorded. Right, the paper very clearly says this has not been recorded. So guys, normally when they don't record, what you should do? Just pass a normal double entry. Right, listen, what is this? What are we looking at here? How much you paid to buy the associate. So in accounting, guys, we call this as investment. So under 69 million, guys, can you write here investment faster? This is investment. Total, this much we paid. So when they don't mark, you have to mark the double entry now, guys. So you know what will happen? Investment will become debit. Okay, add guys over here, then mark their investment debit. Okay. Guys, next part. Now think, what are we issuing? Shares. Think, who is issuing shares, guys? Parent or associate? Who is issuing the shares at this point? Parent. Oh, guys, listen. Who is buying whom? Parent is buying associate. Correct or wrong? That means who should issue the share to buy the associate? Parent only should issue. So therefore, guys, what will happen? For the nominal value, share capital will become credit. Who's one? Parent. Premium, guys, what will happen? The share premium will become credit. Who's one? The parent. Okay. So guys, remember, credit means what? Plus. Credit means what's going to happen here, guys? Plus. Investment debit means plus. All okay. Now the problem is this has not been recorded now, guys. So first we have to record this and show in the first place. Are you guys okay with that part, right? First thing, they are telling only the cash consideration was recorded, right? That means that this consideration has not been recorded. So what we should do is, guys, first we have to mark this and show in the financial statement. Right now, guys, let's start marking it together. So we paid 69,000 to buy. They haven't marked. First of all, guys, can you go to the SOFP? Make sure, guys, to investment you added 69,000 plus 69,000 first. At this. Why are we adding? Because it has not been marked. So investment becomes debit. What and what should become credit? Share capital should become credit. Who's one? Parent. Because parent is the one who is issuing shares. So guys, parent shares are in the SOFP. Add 30,000, guys, to this one quickly. Right? For the equity share, add 30,000. Why? Because parent is issuing the shares. Okay. Guys, after that one, now 30,000 credit share capital, now 39,000 credit where? Share premium. Now guys, can you see in our question, is there a premium? No, there is no premium. Guys, when I copied everything, guys, did you find a premium? No. Therefore, what you should do, guys, we have to now add a new column called share premium. Right now, guys, if possible, now can you add a new column, guys, over there as share premium, please? Create a new column, share premium. How much is the answer? 39,000 has been issued. Right, mark it over there. Okay. So guys, problem number one, they gave shares to buy the company. You have to find the value first. Second problem, it was not recorded. So pass the double entry. Investment debit plus share capital parent credit plus share premium plus share premium was not there. So what did we do, guys? We went and created one share premium. All okay, right? We went and created a share premium. Are we guys all okay with that one? Right. Guys, again, now don't forget what we are doing. Now see, guys, again, can all of you all guys go to the associate working? Right. Now listen, this entire paragraph is speaking about what? How much we paid to buy the associate. So guys, see, we paid cash 39 million to buy the associate. Then we paid shares 69 million to buy the associate. That means, guys, total how much did we pay to buy the associate? We have, guys, paid 99 million in order to buy the associate. How 99 million? Once again, guys, look at this carefully. The paper said to buy the associate, first we paid what, guys? First we paid cash. Additionally, we also issued what? Shares. What is the total value of shares, guys, that we have issued? Here we calculated, no? Total is 69. So cash 30 plus shares 69. Investment in associate, guys, we have marked 99 million over here. Mark it, guys, over there. Investment is 99. Right now, guys, in class, I never got an opportunity for you to explain how to do a question with associate. But when I'm teaching associate, I said, when you mark it here, this is what you should do. Right? In class, this is what I explained. Right? When I taught you associate theory, I said to you, when you mark investment like subsidiary, you should remove from the SOFP. This one, what you mark here should be adjusted inside working number 4, retained earnings. If you add here, working number 4, adding. If you subtract here, working number 4, subtracting. So if you have forgotten associate accounting, guys, again, let me give you a recap, guys. Listen, when you do associate accounting, now you are marking the numbers here. No? Once you mark there, make sure you complete double entry. So how to complete double entry? Listen once again. When you write here investment, Like for subsidiary, you should remove the investment from here. Now guys, can you remove the investment and show here minus 99,000 from the SOFP? Make sure you do that one, minus 99,000. Okay, like subsidiary. Now guys, when you calculate goodwill, when you mark investment, you are removing now. Same like that for associate. When you mark the investment, you have to remove that from the SOFP. Second thing guys, what you should do is this. These three things. Now you can see here now guys, there are three things. PAR is there, URP is there, impairment is there. Three things are there. Those three things, when you copy here, you should complete your entry in working number 4, retained earning. How to complete? Here plus means working number 4 also plus. Here and here minus means working number 4 also minus. Simple as that. So guys, with that one, second paragraph is guys now completely over. Okay, right. Now guys, let's go for the third paragraph then. What's happening there? Okay. Right. S. Guys, who is a subsidiary? Made a loss of 10 million for the year on 31st of December 2009. Okay. A has made a profit of 6 million for the same period. Right. Now guys, listen very carefully. This is the problem that we are having. Okay, now guys, A has made a profit of 6 million. Right, now guys, who is A? Associate. This year they made a profit of 6 million. Now guys, tell me, when they make a profit, we have to get a share. Why should we get a share? Because we own them how much percent? 40% we owe. So you know guys, what you should do like this. When they make a profit of 6 million, I'll give you time to copy. You should guys mark this over here. PAR, post acquisition reserve. That is after you buy them, how much profit they made. Wait, 6 million they made. Can we get the entire 6 million to ourselves? Can't. Only how much percent we can get? 40%. But once again guys, you have to be careful. This associate is how many month associate? Just a 6-month associate. So this into 6 over 12 you all have to calculate when seeing for associate. Right, now guys, can you calculate that answer please? 6,000 half will be 3,000. 3,000's 40% answer is 1,200. All good? Right. Now guys, listen, when you write here, please complete double entry. If not, you will miss. Guys, what you write here should go to where? Working number 4. Now guys, can you go and copy this in working number 4 quickly? Right. Start writing here PAR of whom? Associate. Right. Mark it over there, please. Okay. Right. So guys, how much will be the answer? 1,200. Make sure you transfer it to retained earnings. Done. That's it. All good? Right. But guys, now for the first time, I believe we are having another problem on the hand. Look at this one guys over here. First one. S made a loss of 10 million for 31st of December. Why have they given this answer? Right. Listen carefully guys. Now here we have a big problem. Right. The problem is like this. See guys. I said you when I started the question, because this is a 6-month subsidiary, this answer is not given to the hand. Right? Retained earnings at acquisition is not given. We have to calculate. To calculate that, we have two options. I have taught you in class. Okay, to calculate this guys, there are two options. What are the two options? Like this. Option number 1, retained earning brought forward of subsidiary plus profit after tax into number of months. This is one equation. Or retained earning carried down of subsidiary minus profit after tax into number of months. Right. Now guys, look at this part carefully. These are the two methods that you have to use to get the retained earning at acquisition date. Now, which method are we going to go for in our exam? Guys, look at this. Go to working number 2. Retained earning of subsidiary. Here, guys, can you see in the reporting column how much you have? You have 81,700. Now, that means the carried down is available. You can, guys, go in this method. No need to go for method number 1. So, you as a student should know what are the two methods that we have to get that answer. Then you see what type of information is available to you. Now guys, in my paper, retained earning I need of subsidiary, right? So guys, subsidiary retained earning, I have 81,700, but that's at the reporting. Reporting means that's carried down. So then I should go for second approach. Right, now look at this, 81,700 minus, you have to be careful once again, the business did not make a profit for this year. Look at this guys, the business made a what? They made a loss of 10 million. That means guys over here, minus 10 million over here. Into number of months. Guys, how many months subsidiary are we looking at? 6 months. Right, now guys, if you didn't know how to do this, right, copy this and get the answer. What is this answer guys? Actually, this answer is none other than retained earnings at acquisition date. Okay, this is the answer. Right, try finding this answer guys now. Copy the working down and find the answer. Retained earnings at the acquisition date. Okay. Guys, now when you use this equation, guys, what are the answers then we are getting, guys, in that case? How much? Right. 81,700 minus 10,000, okay, into 6 over 12. So, guys, is it by any chance 86,700? Correct? No, that should be the answer. Okay. So, guys, remember when you do this working, we will be getting what, guys? Retained earnings at what date? At the acquisition date, right? So, that one's answer, guys, should be none other than 81,700. Okay, this should be the answer. Sorry, 86,700. No, right. Now guys, can you mark this one over here? 86,700 should now be your answer. All okay. Guys, remember the retained earnings is actually increasing. Now, if you actually see our previous papers, the retained earning has always reduced, but this time it's increasing because we are making a loss now, right? So when you are making a loss, prior we have more than at the reporting date. Okay, right? So that's how, guys, this adjustment should be done. Any doubts that you have, guys, please ask from me, because I remember this is the first time where we have a loss, right? Retained earning loss for the current year. All the other questions we always had profits. Okay, right. Now guys, can you go to adjustment number 6? Let me finish that off. That's easy. P value is non-controlling interest at fair value, and the fair value is 29 million. Guys, when the fair value of NCI is given, you have to mark it in 2 places. Where and where? First of all, guys, can you make sure you have marked this in working number 3, goodwill, 29 million. Also, guys, can you double check whether you have marked it over here inside this one also, which is going to be here, working number 5, 29 million. This has to be the answer. Okay, right. Then, guys, let's move on to the next part then. Right, adjustment number 4, something little different, right? This is not actually consolidation, but this is actually, guys, financial instrument lesson. We'll discuss. P Corporation and S Corporation both hold equity investments. So, guys, what is this? Financial assets, investments in equity. Okay, remember, guys, in financial instrument lesson, we have 4 instruments: financial liabilities, convertible loan, compound instrument, financial assets, investments in equity, financial assets, investments in debt. So these equity, this is very easy. No election has been made to classify them as fair value through other comprehensive income. In simple words, this is going to go for default position. Now, guys, Those who have started revising for the exam, you know that under financial asset, there are two types of accounting: default position and alternate position. Alternate is where they do through OCI. So they are telling there is no election to go through OCI. That means they're not going for the alternate method, guys. They're going for what method? Default method. Guys, when you go for default method, what you should know? Two things. Number one, issue cost. Any issue cost is an expense. Second thing, if there is a fair value increase or fair value decrease, it should be marked where? Income or expenses. These are the only two rules that you need to know when the financial asset is at what position? Default position, right? Any changes to the value, right, should either go to income or expenses. Now guys, see what's happening. Both parent and subsidiary have some investments, it seems. At December, parent one has increased by 15 million. Subsidiary one has increased by 3 million. All these have been happening in post acquisition. That means after we buy the company only this has happened, but no entries has been made. Guys, listen, point number one. What's happening to both the investments? Both the investments are, guys, actually increasing, correct or wrong? So when the investment is increasing, first of all, guys, can you make sure you have marked it over here, right? Can you guys go to investment in your paper? Can you make sure you have added 15 million plus 3 million, guys? Both are increasing the investment. Are we guys all okay with that part? Right. Guys, now see what did I do? 15 million increase, 3 million increase. I added to what? Investment. So investment becomes debit. Then where should it become credit? Very simple. 15 million is whose investment? Parent's investment. That means, guys, parent is earning an income. Guys, think. Parent, where does he record income? In retained earnings. Where is parent's retained earnings? Working number 4. So therefore, guys, what you should do, go to working number 4. Here you should mark and show increase in fair value of investment, right? Please mark it over here and show. Okay, so guys, how much has the parent one increased by? It has increased by 15 million. 3 million, guys, whose one increase? Subsidiary. That means subsidiary income. No, think. For subsidiary, if it's an income, where does subsidiary record his income? Retained earnings. Where is subsidiary's retained earning, guys? Working number 2. It's in working number 2. Right now, guys, can you go to working number 2? Start writing here, guys. Right? Fair value of investment. Right. Okay, guys, I want you to read this carefully and tell me in what column should I mark? Should I mark it in the acquisition column or should I mark it in the reporting column? Which one, guys, should I mark? Reporting, because, guys, the paper didn't tell at acquisition. No, it happened post acquisition. Post acquisition means what? After buying the company, meaning, guys, it's at the reporting column over here, 3 million rupees. All good? Right. Right. Then, guys, let's move on to the next part then. Right. The last adjustment, number 5. Right. Online children, guys, right? Those who have not done the mock exam, if you don't understand how the adjustments are going on, please let me know, then I can explain it to you, right? People who did the mock, guys, you all have marked the entries now, so you can quickly now start updating. Okay, right. Next part. S and A have both sold goods to P. None of these goods remain. It's good. Why? When companies trade between each other, and if none of the goods are remaining, guys, that means all the goods has been sold. No, that means there is no URP, which is good. Right. Go forward. P Corporation's financial statement shows a 5 million payable to S. Guys, 5 million payable to S means, guys, what do we call this? Intra-group trade payable and receivable. So between parent and subsidiary, guys, when there is a payable and receivable, what we should do? Eliminate. Right. First of all, guys, can you go for trade receivables? Make sure you have removed 5 million. Right. Make sure, guys, in trade payable, you have removed 5 million from there also. Are we guys all okay? But then guys, they are telling them this disagreed with the amount receivable due to 2 million payment made by P. But guys, subsidiary is telling over there, okay? Not subsidiary, 1 minute. Wait, let me read one more time. P's financial statement shows 5 million payable to S. This disagreed with the amount in the financial statement of S due to 2 million payment made by B has not been recorded yet. Okay, so guys, technically what's happening here, right? It's like this. Parent is telling I should only pay 5 million to S. But S is telling no, it's wrong. In my record, it's different. There is a difference of 2 million in payment. That's because guys, what actually happened, parent made the 2 million payment. That's why his records is showing 5 million. Right? But subsidiary still has not received this money. That's why there's a small disagreement. Normally guys, when one company makes a payment and if other company does not receive, what do we call that guys in accounting? Cash in transit, right? It's cash in transit. That means the money is still on the way, right? So cash in transit guys, what we should do, number one guys, what you should do is, right, from cash, right, can you guys mark it over here, plus 2 million, okay, because this cash has to be received, it still has not come, right? First mark guys over there, cash plus 2 million. And then guys, what has to happen, from trade receivable you should subtract 2 million rupees, right? From trade receivable you have to subtract. Guys, please check your notes for cash in transit. So normally guys, when cash in transit is there, step number 1, remove the trade receivable, right? Because for other party, the problem is guys, he hasn't got the money yet now. So because he has not got the money yet, his customer value is still high, right? But actually the other party has paid. So the payment is on the way, right? So therefore cash should become debit and trade receivable guys should become credit. That's a double entry that you have to pass there. That's it guys. So with this now we have finished off all the adjustments in the paper. Now guys, it's time for us to balance off this question and see. Behind that guys, there's a theory question also we will discuss, but first guys, let's finish off this one now. Okay, right, now guys, can all of you all now come to working number 2? Right, let's close this one then quickly. The fourth adjustment, 1 minute, fourth adjustment is, okay, I will explain that, right? So what happened is this, okay, the fourth adjustment, right? Parent has an investment which went up by 15 million in market value, okay? Subsidiary has an investment which went up by 3 million in market value. So remember, this is an equity investment. Now we have two options. One is through other comprehensive income, but there has no election been made. That means in simple words, they are not going to go for that method. So if they are not going to go for the other comprehensive income method, that means this increase is there. No? This increase we are marking inside profit and loss account. Profit and loss account means either inside other income or maybe inside other expenses. But luckily, both the investments are what's happening. It has increased in value. So step 1 is like this. When the investment increases, investment should become debit. So what did I do first? Because both investments are increasing, in my SOFP, I have added both. So investment becomes debit. And retained earning should become credit. You know why retained earning credit? Because number 1, they are going for default method. Default method means any increase or decrease should go to P&L. P&L means in SOFP, what is it? Retained earnings. So retained earnings should become credit. So parents' investments, when it's increasing, we should mark it to parents' retained earnings, which is here, working number 4. Because parents' retained earnings we are showing in working number 4. So parent, when his investment is increasing, I should mark it in working number 4. When subsidiary's investment is increasing, for subsidiary it's an income. No? Subsidiary's income we are marking in retained earning, which is in working number 2. That's why subsidiary share I am showing in working number 2. Which column? Reporting column. Why should we show it to reporting column? Because it happened post acquisition. That means it happened after we buy the company, meaning at the end of the year. That's why I have marked it there. First of all, 15 million, 3 million, both are increasing in value. Investment will become debit. Parents gain, I'm marking in working number 4. Working number 4 becomes credit. Subsidiaries gain, I'm marking in working number 2, which is his retained earning. That's how we did that adjustment. But can you little bit check and say, are you okay with that one, or do you want me to go through it in a different way? Understood. No, right. Okay, guys. Now let's finish this off, guys. Then over there, right? Take out your calculator. This one, guys, 0. This one is 0. Here, guys, the difference is 0. Here, the difference is minus 5,000 actually. Okay. Here was the difference, guys. 0. Here it's minus 600. Here was the difference 3,000. Right. Now, guys, when you do the totaling up part, guys, what will happen? 40, 120, 130. 138,700 guys will become the answer. Okay, 40, 120, 130, 138,700. Yes, this should be the answer. Right, then guys, over here the answer is going to be 3,000 minus 5,000, guys, minus 2,000. Minus 2,000 means minus 1,400 should be the answer. No, not minus 1,400. Minus 2,600 should be the answer. Okay, that means, guys, over here the answer has to be 136 100. No, guys, 136 100. Correct. All okay? Right. Now, guys, what you should do, this 2,600 post acquisition should always be split between whom and whom? Parent. Also, guys, you have to split it to NCI. Okay, right. Now, guys, can you split and show what are the percentages? 80% and 20% you should split. It's a minus answer. Right. 20%, guys, will be how much? 520. 80 minus 520 actually. Right. That means, guys, over here 80% answer, guys, should be how much in that case? 2,080 minus. Now, guys, always, no, parents answer should go inside working number 4. Mark it, guys, over here. NCI answer should always go to NCI working, right? NCI answer always to NCI working, minus 520. Right. Guys, now let's quickly finish off then working number 3, guys, faster, right? Let's do that and also finish it off, right? Let's start. Okay. Net assets at acquisition date, guys, answer is 138,700. Right. Okay. Now, guys, can you get me the goodwill, guys, faster? Right. Calculate the goodwill. 129,000 minus 138,700. So, guys, how much is the goodwill? It's coming as a minus answer, no? Exactly. So, guys, for the first time in our papers, we are getting a minus answer for goodwill. What does this mean? This means this is a bargain purchase, right? Mark it, guys, over there. Bargain purchase means what, guys? You have bought the company for less than its value. See, the value of the company is, guys, 138,700, no? But you are only paying how much? 129,000 only to buy the company, right? So you have bought it at a profit, right? So we call this as what? Bargain purchase, right? Something new to learn. Guys, listen. Normally, if this answer is positive, what do I do in the paper? I go and mark this here, goodwill, working number 3, right? Normally, if the answer is positive, guys, exactly, we go and mark it in goodwill, no? But today, guys, the answer is minus. It's a negative goodwill. We call it as bargain purchase. Then guys, what you should do. If it's a bargain purchase, guys, this answer should go to retained earnings, right? Mark it now, guys, over here. Bargain purchase. It's a profit. So therefore, guys, positive 9,700 over here. Right. Now, guys, can you total it up and see, guys, then how much you're getting then for retained earnings? Right. Now, guys, close all of these workings. Working number 4, working number 5, working number 6. Please close all of them, guys, quickly. Let me check, guys. So far, what we had done is everything okay. Should be fine. Yeah, I think, guys, we are going good. Okay, right. Then guys, first get the retained earning answer, guys. How much is that going to be then? Right. 214,300 plus minus 2080 plus 1200 plus 15,000 plus 9,700. 238,120. Yeah, that's the correct answer. 238,120. Right. Over here, guys, when you check the answer, guys, how much will it be? 28,480. Yeah, correct. Right. Then guys, associate accounting 100,200 guys should be the answer after we give them the profit. Yeah, that's correct. Right now, guys, what you do? These answers. Right now, guys, can you now start transferring it, guys, to the SOFP, guys, faster? Okay. Right now, these answers I want you to transfer it to SOFP. Like this one, and this one. Start transferring it over there. Okay. Right. So, guys, retained earning answer. I'll now mark it, guys, over here. 238,120. Non-controlling interest answer 28,420, 480, and investment in associate 100,000. That one, guys, should come here, right? Investment in associate, which is working number 6. What's the answer, guys? 100,200. Okay. Goodwill, guys, today's paper is 0. Okay. Right. So guys, this is the discussion for the mock paper. Right. Can you guys now quickly double check your numbers, guys? It has to balance, right? Now that we have got all our answers properly. Okay. Right. So guys, I'll give you 2-3 minutes. Right. Can you guys please check on these workings? Right. And any doubts that you have, please ask. And at 9:40, I will guys start explaining to you the second part of the question. They have asked a theory question. They are asking why we are removing intra-group trade payable and trade receivable. Second thing, guys, they are asking why you are removing unrealized profit. Okay, so we have to explain all of that theory question. Still I have not decided. Most probably we will do maybe like a ratio question or a consolidated question in the CBE platform. Okay, we might do one of that. Okay. For the theory question answer, guys, can little bit check and see. If anyone is still checking the numbers, you let me know, guys, then I can come back to that part. Okay, right. Theory question, guys, can you quickly write the answer? Why should we remove intra-group trade payable, trade receivable? Let's start writing, guys, over here. Right. Intra-group trade receivable and trade payable should be eliminated as it's being recorded in both parent and subsidiary individual financial statements. During consolidation, when accounts are merged, it shows the group So this is the reason, guys, why we are removing intra-group trade receivable, trade payable. So in theory class, guys, anyway, I explained to you. Now, when one company, when parent of subsidiary, in parents records they mark, subsidiary record they mark. So when you merge, this number is appearing both places. So you're showing the number twice. That means you're showing the group of itself. So we can't show that in consolidation case. In consolidation, we only show when you owe to an outside, not within the group. Group transactions are eliminated. Right. Second thing is they are asking why you are eliminating URP. Right. So there you write down here. URP is eliminated because when stocks are not sold to third party, the profit is not realized and inventory is overstated. This is the reason why we remove URP, because again the profit is within the group, right? So only when the stock is sold it actually becomes realized or clear, right? So when it's not sold, the profit is within the group, our inventories are held at a higher value, so we need to eliminate that. Okay, right. So guys, then with that, the mock exam consolidation question, guys, I have completely covered, right? The 20 marker is now being done. Now guys, what we will do, let's discuss the ratio question as much as we can. Let's have the break, and after that I will discuss with you the financial instrument question, or maybe guys we can maybe start off with the financial instrument question actually. Okay, let's look at that one video. Okay, all right. Can you guys check your answer for the financial instrument part, will you? Okay. So what is the first question they are asking? Okay, first let's read the question. Question number 1, guys, regarding financial instrument. The following trial balance relates to Harvard. Convertible loan, liability component, loan notes 100,000, equity investment. The following notes are relevant. The convertible loan is an 8% 30 million one issued on October 2004. Okay, October 2004 means at the beginning of the year. An equivalent loan without conversion would carry an interest of 10%. So guys, listen, this 8% is there, no? This is the nominal one, agreed one. Without conversion, the interest is 10%. Then this is what we call, guys, the effective interest. Okay. Howard's finance director correctly split the instrument into equity and liability. That's actually good. Normally, guys, in a convertible loan, first thing what you should do, we have to find the debt component. No, to find the debt component, what we do the present value table. We mark interest, and then liability. Do the discounting part, right? That's the hard one actually, right? Where you have to do the discounting, find the liability component. The good thing is that they have done that and given to us already. Okay, the liability component has already been done, but nothing else. That means hard part is done. Okay. 5% loan notes are issued at 10 million. Howard incurred issue cost. The loan has an effective rate of 8%. Guys, loans is a financial liability. We always do it at what? Amortize cost. Right. The equity investment relates to 1 million shares in Kapoor, an unrelated entity. During the year, Kapoor paid a dividend of 10 cents per share and the fair value is this. So this guys an equity instrument, financial asset. Guys, now see over here, are they mentioning regarding any alternative way? Right, normally guys, if it's an equity investment, it's a financial asset. Financial assets, guys, have two ways of accounting. Right, one is default way, alternative way. Alternative way should only be applied if the paper says. Okay, but here guys, are they mentioning anything like that? No, that means guys, there is a financial asset under the default position. Okay, let's see question number 1. Which of the items included in the trial balance will be classified as financial instrument? Actually guys, in this question, all the items are examples of financial instrument because we studied all these instruments in that chapter. So this is definitely all three are financial instrument. Right, now guys, what they are asking, what should be the value of the liability on 30th of September 2005? Guys, listen. Now the convertible loan, they are giving you the answer as 28,508 now. Okay, this is the answer on first. That means what? Initial measurement. The paper is asking you the same loan. What's the value on 30th? 30th means guys at the end of the year. Guys, it's a loan. If they want you to find the value at the end of the year, what's the accounting treatment? Any loans you're doing through what table? Amortized cost table only, guys, you have to follow. Even guys, convertible loan, once you split and show as equity and debt, right? The debt instrument, the answer is at the beginning of the year. If you want to find what's the answer of the loan at the end of the year, guys, what you should do? You should put it through the amortized cost table. So therefore, guys, now what I'm going to do, I'm going to now show you the amortized cost table. Brought forward plus interest. This should always be, guys, what interest? Effective minus cash is equal to carry it down. Brought forward, guys, will be this answer. The answer what they gave on 1st of October, 28,508. The interest will be the effective. Guys, we decided no, effective rate is how much? 10%. So you see 10% for this. Then it will become 28,850.8. Minus cash. Guys, what is actually cash? Cash means actual interest paid. How do we calculate that? To calculate actual interest paid, you have to first see what's the value of the instrument. Guys, in that paragraph, they are telling the value of the instrument is 30 million, right? Because guys, now when you take a loan, that person won't go to see how much is equity, how much is debt, right? When you take a loan from that person's mind, how much he gave? 30 million. So you have to calculate for that. And the person who is giving the loan, he won't be worried about effective rate. He will only be worried about the rate that was promised, agreed rate. How much did you agree for? 8%. Exactly, guys. So you have to see this for 8%. Then, guys, the answer will be 2400. Right. Now, guys, can you calculate and see, guys, what should be the answer for this part over here? 28,508 plus 2850.8 minus 2400. Answer, guys, will be 28958.8 approximately. C should be the answer. Okay. So, guys, when you do this, I'm getting the answer as 28,598.8. Okay. So when you round it off, guys, this should be the answer, option C. All good, right? Guys, next one. What is the finance cost regarding the loan? Guys, again, loan means what? Amortized cost, right? So one more time, guys, let's start. Brought forward plus interest. That's enough. Now we do the whole table. Why not do the whole table? Guys, listen. What is the finance cost to be shown in P&L? In profit and loss account, you always show this interest only. So they are asking only that. No, so no need to do the whole table. No need to waste time. Guys, brought forward. Listen, earlier the brought forward was given. Why? It's a convertible loan. This is a normal loan. Guys, in a normal loan, how do we get the brought forward? The equation is proceeds minus issue cost minus discounts. This is what we studied in class. Okay, for a loan which is a financial liability, we are doing it through amortized cost now, guys. So for amortized cost, what's the brought forward? Proceeds minus issue cost minus discounts. Now, guys, see, for this loan, Roman number 2, we got the loan for 10 million. Then that's what we call proceeds, 10 million. Minus issue cost. Guys, there is a 400,000 issue cost. Minus 400,000 from this. Any discounts? No. So therefore, guys, the brought forward of the loan will become 9,600. Now, guys, for this, you have to charge the rate. What rate? Effective interest. How much is the effective interest? Again, it is 8%. Now, guys, can you check now 8% of this answer, please? 9,600 into 8%. Exactly. So answer will be 768,000. That should be, guys, the answer for this part. Which one? In respect of the loan notes, no?
Yeah, convertible loan was in 2008, 28,580.
That means you are telling this answer and this answer then. Okay. Also there. Yeah, correct. Wait, guys, wait 1 minute. Let's see, guys. 1 minute. Just let me a little bit check with the answer sheet and see. And yeah, what you're saying is true, but even in the marking scheme, the answer is 768. The reason why the answer is 768 is in this question, when they say loan notes, they are only asking about Roman number 2. In case they wanted the other one, then they will mention the word convertible loan also. That's why the answer is 768. Right. Okay. Then guys, question number 4. What income should be recorded in relation to the equity investment? Okay. Now guys, listen. Equity investment, I said you it's a financial asset. What position? Default. Default means guys, this is what you should do. First, you should see how much is it at the start. So what happened guys? We bought 1 million share. Okay. Right. For how much did we buy? It shows 6 million. $6 million. That means guys, when you started the question, right, you bought this for, right, the brought forward guys is going to be how much? 6 million. That means what? We bought 1 million share. One share is 6 rupees. That's why 6 million. Right. At the end of the year, the paper says one share is $7. So that means guys, 1 million, when you take it into 7, it's 7 million. That means what is the increase? 1 million, it has increased. This increase, we should mark it inside where? Income. Okay, because it's a default position. What if it's alternative position? Alternative position means this 1 million should go to where guys? OCI, other comprehensive income. That's a difference. Okay. If the paper is silent, it's default. Default means if the fair value is increasing, income. If fair value reducing, expense. If it's alternate position, guys, any increase or decrease, where should we show? OCI. But you have to be careful. The paper says what income. That means there could be another income. There is another income in the question. Look at this, guys. What's happening? Kapoor. Kapoor means whom? The company who we bought shares is paying a dividend of 10 cents per share. So if Kapoor is paying means guys, for its dividends received, we have to calculate that also. So therefore guys, what will happen? We have 1 million shares in the company. These people are paying 0.1 per share. That means we'll be getting 100,000 dividends received. So therefore guys, total for this question will be 1.1 million rupees. This has to be the answer. Right. Then guys, next one, number 5. H is uncertain how to treat professional fees. Guys, what is professional fees? Guys, issue cost. How should the investment for professional fees should be capitalized as a part of the asset? Right. First one, guys, fair value through other comprehensive income. Guys, if you're doing through other comprehensive income, you have to capitalize issue cost. Fair value through profit and loss. Normally, guys, through profit and loss, the issue cost is expenses. Right. Next one, guys, what they are telling over there, amortized cost of investment. There also, guys, what you should do, you have to capitalize your investment cost. Right, guys, listen. Normally, only at one situation, issue cost is not capitalized. Okay. Issue cost is not capitalized only if the investment is taken through what? P&L. If the investment is not taken through P&L, issue cost is always capitalized. It's not only capitalized under two situations. That is financial assets through P&L, financial assets, investments in debt through P&L. These are the only two situations where issue cost is not capitalized. All the other situations, guys, issue cost is capitalized to the asset, except for these two: financial assets, default position; financial assets, investments in debt through P&L. All okay? So guys, then with this, I have also explained to you guys the MCQ question of the exam kit as well. Okay. Done. Okay, now guys, what we will do, we'll start the ratio question, and after the ratio question, guys, what we will do, we'll come back and discuss the revenue contract accounting. Okay. Right. So guys, remember yesterday in the group, the mock exam, they gave you all guys instructions to do everything on the Excel sheet. Okay, not a problem, right? All of you sent, but I think you sent me through different. That's the correct way to do it, right? Okay. So remember, guys, though yesterday instructions were given to do everything on the Excel, in our real exam, the ratio question should be done on a word processing software. It will just be a blank page. Don't worry, today guys 1:30 session I will load up and show you a mock paper. There you will see that it's actually done through a word software. Word software is just a blank sheet. Okay, there's nothing much. Okay, now guys, first question what they are telling in this paper is that they are asking you all to do the ratio question. First of all guys, they want you all to calculate ratios, right? First of all guys, let's see whether the ratio calculations are all okay. Okay, so guys, in this iPad doesn't seem like word is there, so in that case I also will do it on the Excel itself. Okay. Okay. So requirement number 1 guys, they want you to calculate all these ratios for treats. Okay, so let me now quickly do and show it to you. Right, treats. Right. So a lot of ratios guys they're asking actually, right? ROCE, right? Net asset turnover, right? GP margin, OP margin, then guys current ratio, inventory turnover, gearing, and receivable collection period. Okay, guys, I will first show the sector answers, the same what they gave over here, or we don't need sector answers actually, it will be a waste of time. Okay. Okay, now guys, I'm not going to write the equation down, right? But when I'm doing the question, if you want to understand from where the number came, you tell me, I'll explain. Now guys, normally for ROC, what's the first thing you need guys? Operating profit. Where is the operating profit guys in this question? Here, 7466. So let me take that one. Okay. Okay. 7466 divided by what guys? Capital employed. What is capital employed? Equity plus debt. Okay, so capital employed means equity. Answer is this, plus debt. Debt means what guys? Non-current liability. But you have to be careful. This non-current liability should be what type of non-current liability? Interest bearing, right? There has to be some interest attached to it. Also guys, little bit check current liability also, because you know sometimes lease can come inside that. No, can I remember when I'm explaining I said you lease which is inside current liability also should come for the ROCE calculation, but luckily none of that is there. Okay, so therefore guys, the equity will be 25,968, debt will be 33,621, this into 100. Okay, net asset turnover. So guys, for net asset turnover on top, what do we need? We need sales, which is revenue. So guys, revenue is how much? 214,553 divided by guys, divided by basically what? Capital employed. So capital employed is what I copied up now guys, right? So let me mark it over here and show that same thing. GP margin guys, GP margin, what do we need? We need gross profit, 106,544 divided by revenue, 214,533, and that into 100. Right, operating profit margin guys. Okay, what are the operating profit means guys? First we need operating profit divided by guys again revenue into 100. Okay. Right, current ratio guys is basically what guys? Current assets divided by current liability. So guys, see, current assets are this much, 214,553. No, yes, thank you. 553. Here also guys, 553. Okay. Right, now guys, next one we need current assets this much, current liability which is this much. Okay, so guys, current assets 47,996 divided by current liability 50,391. Okay, inventory turnover ratio guys, what's the equation? It's cost of sale. Cost of sale guys, answer is up, 108,009 divided by what guys? inventory, right? Now, normally it's average inventory, but I didn't see in the paper opening inventory. No, so if opening inventory is not there, you can take but inventory, guys. You can take your closing inventory as average inventory. 30,393. Hearing, guys, these people are going debt over equity. Guys, debt means what? Non-current liability 33,621. Equity is 25,968. Okay. Then, guys, I have receivable collection period. Normally, guys, we should take debtors. Debtors are 17,603 divided by credit sales. Normally, guys, in FR papers, revenue itself is credit sales. So you can take the whole thing, 214,533 into 365. Right, so these are, guys, the answers for the ratio substitution. Now, guys, what I'm going to do, I'm going to directly mark the answer from the exam kit. Right, if you want to know from where the numbers are coming, guys, you please let me know, then I will explain, because there is no point me calculating, it's only going to waste your time. Okay, so I'll just put the answers from the exam kit. I check and see, guys, ratio calculation wise whether things are okay. So, guys, the answers for ROCE 12.5%. Over here, guys, 3.6 times. Okay. Over here, 49.7%. Okay. Next one, operating profit 3.5%. Current ratio, guys, 0.95 times it seems. Right, inventory turnover 103. Guys, inventory turnover, I think I did a mistake, right? They want inventory turnover in days, no? Inventory turnover period. Guys, that means my equation is wrong. That means it has to be, guys, other way around. Right? Other way around means it has to be inventory divided by cost of sales. Okay? 108,009. This into 365. So it's 103 days it seems. Gearing ratio, guys, answer is 129% it seems. Receivable collection period, guys, is 30 days it seems. Okay, so these are the answers for the ratios. Right? Can you guys quickly write it down? To be very honest, guys, this question, the evaluation is very easy because there is a lot that you can talk about. Lot of points are available on the paper. Okay, so there is a lot that we can talk about. Right? Copy this down, guys, quickly. So these are the answers for the company treat. So how many marks is the ratio? Only 5 marks. Okay. Okay, no guys, right. Okay, so let's start then evaluating the question. Right, let's see what does it say. Right, number 1. Let's read the points now. Okay, point number 1. Property, plant and equipment relates to the retail stores operated by Treat, which is depreciated over a useful life of 20 years. The cost of this asset is 637.8, and the directors are now considering replacing and updating the plant and machine. Let's now see here. First thing, the original cost of the asset is guys 637 million, but currently it's only 61 million. No, yeah, 61 million guys, 637 million. Now if the carrying value is just 61 million, almost 90% of the assets value is gone. That means guys, point to note, the organization is holding a lot of old and obsolete assets. That may be a way to manipulate ROCE. Okay, because guys, 637 million, if you are only having 61 million guys, that means basically out of 20 years, 19 years is gone, right? So that is something where you can speak a lot of points on. Another one point guys, can you see here, they are planning to update the machine, replace. Guys, you should understand one thing. Now when you replace the asset, what will happen to capital employed? Capital employed will go up in the future. Okay, now guys, they are keeping old assets. Now when they keep old assets, capital employed is down, less, so they can manipulate ROCE. Now next year guys, when they replace, what's going to happen? The ROCE, I mean the capital employed, will go up. If capital employed goes up, that means ROCE is going to fall. And not only that, if they are going to replace the machine guys, these people should have what? Money in the hand. Now did you notice guys, in current assets, these people don't have cash, right? So they don't have money to replace the assets. What they should do is they should go and borrow it from outside. Okay, that's something that we should keep in mind. Treat Corporation paid a dividend of 7.14 million despite the concern raised by some directors on the existing overdraft. Guys, without having money, these people have gone and paid dividends also. Right, next part. The overdraft is used for working capital management purposes and does not form the part of the long-term financing. Okay. Treat Corporation sells its product to supermarket chains in addition to its own retail stores. Most companies in the sector exclusively sell through their own retail stores only. Right. So guys, now these are the points what they have given to us. So remember guys, point number 1, these people are having very old assets, right? And they are planning to replace. These people have paid a good amount of dividends, even though some directors have said no. Okay, and guys, 4th point, we are selling through supermarkets mainly. Little only we are selling through our own chain, but the competitors, the sector is all selling through their own retail stores only. Okay, now guys, these are the points that we should know. Right, now guys, let me copy down these sector averages also guys faster, right? If I can copy this down, then we can easily evaluate the question. Okay. Okay, right. Now guys, on the left hand side, I have the answers for whom? Treat. On the right hand side guys, I have the answer for the sector. Okay guys, I'm going to first start with gross profit margin. Okay, first let's start with that. Okay, can you guys, let's start marking now over here. First let's discuss about performance. Okay, right. So guys, under performance, I'm going to first talk about the gross profit ratio. Okay, right. Gross profit margin. First let's discuss about this one guys. Okay, gross profit margin. Right, now guys, the gross profit 49% and 55%. Sector is higher than our answer. What is the main reason guys behind it? I gave you, now there are 4 points now guys in the question, right? What do you think? Why is our gross profit margin lower than the sector? What's the main reason guys behind it? What do you think? Look at those 4 points. What was mentioned? Now guys, normally gross profit means what guys? It's something to do with sales and it's something to do with cost of sale. Okay, right. Can you guys think and let me know why is our gross profit margin lower than these people? What is the main reason? Okay, right. What do you think about that one guys? What should be the main reason? Guys, we are selling to whom? Mainly our sales is going to whom? Look at the 4th point guys. In the 4th point is where that point is mentioned. Right? Why is our gross profit low? Because we are selling to the supermarkets guys. Right? Now when you sell to supermarket guys, who is having the bargaining power? Supermarket only will have the bargaining power. So therefore guys, we need to lower our margins. But guys, competitors, they are selling directly through whom? Retailer. Then they can keep high margins. That's reason number 1 why our gross profit is less. But still you should see, even though we are selling to supermarkets, we are still able to earn close to 50% margin, which is good on one hand, because it shows that means we are a big company. Only guys, big companies deal with supermarkets, right? And if we are still able to have a profit margin of 50, that means we are big in terms of the size of the company and we are doing somewhat okay, right? Because our sales is mainly through these people, supermarkets. Right, guys, from that point number 1, can you tell me another thing why our margins are low? Look at that point number 1 guys, regarding that machine part. Tell me why is our margin low? And the one point that you can add to that. We are guys actually having what type of machines? Very old machines. Guys, what do you think about production quality when it comes to old machines? Production quality will be low, or maybe production cost might be very high. So that's another one reason why we are losing out on the margins. Right? Shall we guys mark those points over there? Right? Let's start marking guys over there. Right. Treat corporation gross profit margin is less than its sector. Okay. It's less than its sector. Right. The reasons for this could be, okay, right. Number 1, okay, number 1, right. Treat mainly sells through supermarkets, which reduces the margin per product, as they have more bargaining power. Guys, when I say they have more bargaining power, I'm talking about the supermarkets are having more bargaining power. Okay, they have more bargaining power. Whereas the sector sells directly through retail. Right. But still, the margin obtained can be said as a favorable one. Okay, so even though it's less, we can still be happy about it, because even when selling to supermarkets, we are having a percentage of 50, means if we sell on our own, it could mean that we could charge much higher, right? So that means our company is good, right? Okay, second line guys, you can write, right, the lesser GP margin could also be contributed by high production cost, as the business holds on to very old PPE, right? So we can have a lot of wastages, production issues because of that. So these are the reason guys why our gross profit is less. So always guys, my advice, when you have a lot of ratios, always start with gross profit, because when you start with gross profit, you're touching the ground roots. Then when you're starting to explain the other ratios, you don't need to do much, right? You can easily, but you can say, guys, cover the points. Guys, now let's talk about operating profit margin, guys. Okay, let's talk about that, right? Put the next subtopic, will you? Right, operating profit margin. Right. All okay? Right. Now guys, see operating profit margin. Okay, now guys, look at these two parts. Okay. Now guys, see our operating profit margin. Now see guys, our gross profit is 50, but our operating profit is just 3. The sector's gross profit is 55, their operating profit is 12. Right? So guys, our operating profit margins are relatively lower than sector. Okay, can you guys tell me first of all, what is the main reason why our operating profit is less? Okay, why is it less than the sector? Actually guys, there are two evident reasons. Okay, first of all guys, tell me one evident reason, will you? Yes, we can give that as the answer. That's correct, Hazik. Right, guys, any other points that we can tell why our, first of all guys, why is our gross profit lower than the sector in the first place? Because our what is less initially? Exactly, first place because of gross profit. Right, now see guys, first one, our one is less than the sector. The starting point should be our operating profit is less because there is a lesser gross profit margin when compared to the sector. Right, that we already discussed. So first you should tell operating profit is less than sector because our gross profit is initially less than sector for the points discussed above. Right, now guys, throw in the new point. So one student said me one reason could be we are having depreciation. Yes, depreciation could have contributed to operating profit margin. Then guys, you can also tell our business is having a poor control of cost. See, these people from 55%, they are able to retain 12%. That means they are only losing how much? 43% approximately. Whereas us guys from 50, if we are having only 3, we are only left with how much? We are losing 47%. Right? 47, yeah, almost 47 guys we are losing. So you can tell our business has poor control of cost when compared to sector. To be very honest guys, regarding operating profit, from the 4 points, I did not see much that I can talk about. Right? They are not talking about one-off cost, right? But only one thing guys, what I can add to this is, now see the first paragraph. Guys, our business is using what type of non-current assets? Very old ones. So guys, when you are using very old non-current assets, guys, there can be lot of repairs, lot of maintenance. So this has contributed to our operating profit being relatively low. That's the only point that we can speak about. Apart from that, any other breakdown is not available. Okay, right, let's start writing the answer guys. So first of all guys, when you write a ratio, try to see whether any other ratio is contributing towards this. First cover that point. Right, so below this you can start writing down guys. Number 1, the operating profit margin is less than the sector. Right, mainly due to our gross profit margin, being less. Okay, right, being less than GP, the sector, due to reasons mentioned above. That's point number 1. Other contributing factors could be depreciation of PPE. Okay, right, next point. Since the business holds on to old non-current asset, there could be a high cost in repairs, maintenance, impairment, right, leading to high operating cost. Right. Then I'm just adding a general point. It can also be added that the business has a poor control on cost. Apart from that PPE point, guys, I don't see any other point where I can talk about operating expenses. This is the maximum that we can talk about, right? Right. Then, guys, if you want, you can add a point this way, right? A further breakdown of operating cost could be useful. When you guys do a ratio paper, if you feel like if this information is there, my analysis would have been made better, you can point out that. Now, about operating expenses, we don't know anything else now, guys, right? So you can, point out something like this. Okay. Guys, now let's talk about ROCE, guys, quickly. Okay, so what we'll do is, guys, we'll talk about ROCE, net asset turnover. After that one, guys, we'll go for the break. So when I come back from the break, I will talk about the position ratios like gearing, inventory turnover, all of that. Guys, now look at this, guys, ROCE. We are 12.5. These people are 28%. So we are almost half of the sector, right? Can you guys tell me what's the main reason why our ROCE is lower than the sector? Because number one, guys, our what is low? And normally, guys, ROCE, what's the equation? Operating profit over equity plus debt. What is the main reason why our ROCE is very lower than the sector, guys? Because our operating profit is low, as we have already discussed above. Okay, guys, then you can also at this point, now see our ROCE is low, even though we are holding on to what? Right, our ROCE is low, even though we are holding on to point number one, guys. We are holding on to very old non-current assets. Normally, guys, when you hold on to old non-current assets, our capital employed is less. Even with that, we are still having a very low ROCE. That means it suggests that our debt levels are very high. Guys, not only that one. Now, look at point number one, guys. What is this business plan for the next year? They are planning to replace the non-current assets. Now what will happen next year? When they replace non-current assets, capital employed will go up. When capital employed goes up, guys, what will happen to ROCE next year? It will reduce even further, right? So that is not a good sign for this business organization. So these are the points that you have to speak, guys, when it comes to ROCE. Okay, right. Let's write down, guys, these answers over here then, guys, faster, right? Below this, write down ROCE. Right. It's almost less than 50% of the sector. Main reason being low operating profits plus could be high levels of borrowing. Okay. Next line. It should be noted that capital employed includes old and obsolete assets. Right. Next line. ROCE will fall even further in the next year if the business replaces its old non-current assets, as there will be an increase in capital employed. Okay. Right. Then, guys, let's quickly give a comment about net asset turnover, guys. After that, we can actually go for the break. Okay. Okay, guys, now look at the net asset turnover, guys. Our answer is 3.6, whereas these people's answer is actually only 2.4. So guys, this is the ratio where we are higher, right? So maybe guys, the reason why we are higher is maybe we have a high amount of revenue. Okay, because normally guys, net asset turnover means what? Revenue over capital employed. So the reason why our answer is higher is mainly because our revenue is high, because we have an agreement with the supermarket, no? So because of that, maybe we have high sales. But guys, again, you can point out this, right? Now, even though we are having 3.6 and they are having 2.4, our capital employed has a problem. Our capital employed consists of what? Again, coming back to point number 1, guys, it consists of all non-current assets. So it's like a deliberate way to improve the net asset turnover. Next year, what will happen to this? It's eventually going to fall, because again, when you replace new assets means capital employed will be high, no guys, right? So eventually this will fall next year, right? So we can point out that one, guys. Let's write this one, right? Net asset turnover is higher than the sector, right? This could be due to high revenue from the agreement from supermarkets, right? Then guys, what you do below, you can just write, okay, right? But points mentioned above regarding the old non-current assets will affect points mentioned above. Guys, points mentioned about mean these two. These people are holding all non-current assets, and also next year when they replace, the ratios will get affected, right? But points mentioned above regarding the old non-current assets will affect the ratio next year. Again, no need to repeat the points now, guys. So you can just mention that it will affect. Okay, right. So guys, you can have your break now. Come back at 11:05, and then we'll continue the ratio question plus finish off our which one? Contract accounting as right. Okay. Right. Then guys, our current liabilities, guys, we have trade payable, we have an overdraft, and also we have current tax liabilities. So remember guys, our answer is 0.95, but the sector is 1.8. Okay, so guys, what do you think? What are the contributing reasons that our answer is extremely lower than these people, guys? What are the reasons that you can tell? Okay, now guys, first of all, we are selling to whom, guys? Mainly supermarkets. Exactly, guys, understand, if we are dealing with supermarkets, that means guys, to meet the supermarket demand, what should happen is, right, we should be buying a lot of inventories. When we have a contract with supermarkets, guys, we have to supply properly, right? So therefore guys, that means we have a lot of inventories involved. That means we are buying a lot of inventories on credit, right? So that's one reason why our current ratio is actually low. But guys, the other people, the sector, they are guys selling actually to whom? Retail market. Exactly guys, when they are selling to the retail market, guys, they are able to, now when you sell in retail, do you sell for credit? No, you sell everything for cash. So that means guys, the sector is having good cash balances simply because what, guys, they are selling for retailers. Whereas when we are selling mostly for, what you can say guys, when we are selling mostly for supermarkets, point number 1 guys, we should invest in lot of inventories, then our credit purchases should be very high. Second thing guys, maybe payments from the supermarket guys is going to be extremely late. Here I'll show you an example guys. By supermarket, this one is extremely late here. Now when you look at our answer here, see, right, this part guys, see, receivable collection period guys, when you see, our answer for receivable collection days is actually guys 30 days. Okay, whereas guys, these people are 15 days. So the sector, when they sell, they are collecting money within 15 days, but we are guys collecting money within 30 days, double. So why our payments are getting delayed from customer? Because we are dealing with supermarket now. So his bargaining power is more. So if he asks for more days, we have to give more days. So we don't have cash in our hand. So us not having cash in the hand only, guys, has pushed us into an overdraft situation. See guys, our business does not have cash now. We are at an overdraft situation. Why? Because payments from the supermarket is getting delayed. That's why we are having a very adverse current ratio. Okay. And not only that one, guys, over there, because we are having an overdraft situation, next year when we want to buy assets, we don't have money. Right? We have to borrow and only buy. Right? So because our cash balances are extremely poor. Right? So let's give some points, guys, on that part then. Right? Let's start marking. Right. Right. Current ratio, right, is less than the sector due to the following reasons. Okay. Right. Number one, as we are dealing with the supermarkets for majority of our sales, we need to invest in a lot of stocks, which will increase our credit purchases plus the trade payable balance. Right. Second reason, guys, we can tell, as our main customer is the supermarket who has a high bargaining power. Cash collection from them could be delayed a lot, which is reflected through the trade receivable balance, trade receivable collection period, which is more than half of the sector. So sector is collecting, guys, within 15 days, we are collecting in 30 days, right? It's because supermarkets have more bargaining power. When we sell for them on credit, they can ask more time to pay, right? Okay. This arrangement has caused a reduction in our cash balances, thus leading to an overdraft situation. Okay, thus leading to an overdraft situation. Okay. So these are the reasons, guys, why our current ratio is much lower than the sector. Then, guys, let's quickly give the points for the other ratios and also, guys, finish it off. Right now, in receivable collection period, guys, there itself we spoke no why they are 30 and why they are 15. Sector is 15 because of two reasons. They are selling to retail. So when they sell to retail, their credit side is relatively very low. Because we are selling to supermarkets, guys, we need to give them more time to pay. So that's the reason why here there is a big drastic difference. Right. Guys, over here, inventory turnover ratio, guys, see, the retail is, the sector is selling stocks in 25 days. What is the main reason, guys? Because our sector is mostly going into what sales? cash sales now through the retail now, because they are going for cash sales, their inventory turnover period is very, very low. But guys, see, our one is 103 days. It's 4 times of the sector. Why it's 4 times of the sector? Because again, the problem is our arrangement with supermarkets. Now guys, if you're dealing with supermarkets, can you have low levels of inventory? Can't. You have to buy large amount of stocks and keep it ready. Then only, guys, you can meet the demand of supermarkets. So because we are holding a large amount of inventory to meet the demand of supermarkets, our inventory turnover is going to be very high, because we need to hold a lot of stocks and supermarket will buy once in a while only. But when they are buying, we should have enough stocks with us. So that's the reason, guys, why our one is 4 times of the sector. And this is a risk, because guys, I think treat manufacturer, what type of business organization, guys, are we? Are we like a pastry shop or a confectionery? Yeah, guys, we are a confectionery shop, sweet shop. So when we are holding large amount of inventory, it's a risk, because our goods are perishable goods now, right? Into the future, guys, there can be a lot of stock losses and write-off, right? That we have to be careful about, right? What else then we can mention? Yeah, let's quickly, guys, mention about that will regarding the inventory, right? Right. Inventory turnover ratio. Right. Treat has almost 4 times higher inventory turnover days when compared to the sector, because of the arrangement with supermarket. This would require Treat to invest and keep a large amount of inventory ready to meet the demand of the supermarket. Whereas the sector sells through retail, which has a faster inventory turnover days. Right? Another one point, guys. Let's add to this. Okay. Right. Having a high inventory turnover is risky for business like treats, as they deal with perishable goods, which can result in high inventory losses. Okay. Then, guys, last one, let's talk about the gearing and, guys, give conclusion. Guys, see, gearing 129%, whereas these people are only 43%. So that's also bad. Okay, let's quickly give the comment, guys, over there, right? Okay. Gearing ratio of treats is high when compared to the sector, which indicates they have a higher level of borrowing, which is not favorable. Right. So guys, we have given good amount of points. Let's give the conclusion guys over there, right? Conclusion, like are they like worried about the performance or something like that? What does it actually say? Evaluate the performance. Yeah. Okay, so guys, then below this, and let's write the conclusion guys for this question, and let's finish it off, right? We'll give the conclusion as this way, right? Treat corporation is well below its performance and position when compared to the sector. Right. The main reason being its arrangements with the supermarkets. Right. If they can negotiate for favorable terms. Now guys, if you negotiate for favorable terms guys, that's going to include a lot of ratios. The problem is because we are selling to supermarkets, our margins are low. Because we are selling to supermarkets, we have to hold high amount of inventory. Because we are selling to them guys, payments are getting delayed from them. So if we can sit down and negotiate with them for a little bit, flexible or favorable term, that's going to increase many of our ratios into a favorable way. Okay, right? Then that would actually solve guys most of our problems in the company, right? Favorable terms in relation to cash collection, margins, and inventory demand. This could improve many areas for trades, mainly solving its cash balance problems. And also guys, we should write cash balance problems, right? Trade should also find a way to finance the purchase of new non-current assets. Because next year guys, they are planning to replace all the assets now. Now if you have to replace all the assets, you have to find money. First of all problem, our business doesn't have money. We are in an overdraft situation. Second thing guys, now if we don't have our own money, what we can do, we can borrow money. But I don't think guys this business treats can even borrow money, because already their gearing is very high. Can you remember guys, their gearing is how much? 129%. So there is no room for borrowing. So the only thing what they can do is they can issue some shares and get some money. That's the only way that they can raise money as far as I can see. Even for leasing we can't go because our borrowing levels are very high. Okay, but remember guys, when you do issue shares, in the short run it will affect lot of ratios. Why do I say that? Because guys, when you issue share, what will happen? Capital employed will go up. When you buy new non-current assets, capital employed will go up. Then in the short run, your ROC and net asset turnover will get affected adversely. But that's a short run problem. But in the long run, you issuing shares and also you buying new non-current assets, in the long run it will work really well for you, right? So these are the points guys that we need to mention when it comes to this part guys over here, your ratios. You can also guys just read your revision kit answer also for some additional points, but I think this should do the trick. All okay, right? So guys, then with this I have now explained to you the ratio question of the mock paper as well. Now guys, what we will do, we'll quickly discuss the last question of the mock paper, which is a question that came from the revenue standard contract accounting, right? First of all guys, just get down these points. We'll start then that last question what we have. Now guys, then let me explain to you guys this question over here regarding contracts. Okay, number one, what revenue should be recorded in relation to contract number one? Because normally in contract accounting, how do we guys calculate revenue? We calculate revenue this way. First we take the contract price. Okay. Once we take the contract price, guys, we multiply this with the progress rate. That's it. Whether it's a profit making contract, loss making contract, it doesn't matter. For contract accounting, guys, how do we normally find the revenue? We take the total price and check the progress rate according to what we have done. So guys, for the first question, the answer would be contract 1, price is 10,000, progress rate is 80%. This into 80%, guys, answer should be 8,000. This should be the answer for the first question. Right. Second one, guys, what cost of sale should be recorded in relation to contract 2? Guys, listen, normally if they are asking cost of sale, first thing what you should do for this contract is you have to check overall loss or profit of the contract, right? You have to find overall gain or loss. 1 minute, right? If they ask revenue, you don't need to do that. But in the paper, guys, if they ask cost of sale of a contract, first of all, what you should do, you should find the overall profit or loss from the contract. How to do that one, guys? You should take the total price minus the total cost. So contract 2, guys, total price is 8 million. The total cost is going to be, guys, 10 million. What is total cost? Cost incurred and yet to incur. So that means, guys, this is actually what making contract? It's a loss making contract. Now, guys, you have to be careful if it's a loss making contract, right? So if it's a loss making contract, guys, when you go to find your answer for cost of sale, or if you go to find the answer for the income statement, this is what you should do, right? Step number 1, guys, what you do, take the price of the contract. Price means what, guys? Now normally, guys, when you go to find cost of sale, this is what you should do. Revenue minus cost of sale is equal to gross profit. Okay. Now, since this is a loss making contract, according to prudence concept, the entire loss should be marked at once. If it's the overall profit, that's not the way that we do. If it's an overall loss, guys, according to prudence concept, guys, this entire thing should be marked immediately, minus 2 million. Revenue. Guys, what I mentioned earlier, whether it's a loss making contract, whether it's a profit making contract, revenue will always be same like this. That means you take the price and you put the percentage. So guys, price is how much? 8 million. What's the percentage of progress? 60%. So revenue, guys, will be 4,800. That means cost of sale, guys, will be your missing answer. The missing figure only will become cost of sale. That means, guys, if it's 4,800 here and 2,000 here loss, what should be the missing answer, guys? 6,800 should be the missing answer. This should be the answer. But guys, I want you to understand one more small thing. In class, I explained, if it's a loss making contract, when you get the cost of sale, right, though it's not needed for this question, you should break it down to 2 parts. Now, today's question, they ask cost of sale. What's the cost of sale, guys? 6,800. That's a final answer. But I said you in class, when doing theory, if it's a loss making contract, first find the missing figure as cost of sale. This cost of sale, guys, should always be broken down to 2 parts. 2 parts as what? One is cost incurred, which is 4 million, and something called provision for loss, which is 2,800. Because sometimes like this, they can ask in the exam. Now I remember, guys, in the last pre-mock exam means not June, in the March pre-mock exam, it was compulsory for students to break it down this way. Then only they will be able to get the answer properly. Okay, so always remember, guys, if it's a loss making contract, cost of sale will be what answer? The missing figure. This missing figure should be broken down for 2 parts for further questions. Sometimes you might need this. Always break it to 2 parts as what? Cost incurred, which is 4,000. So guys, from 6,800 if 4,000 goes, how much is remaining? 2,800. This is provision for loss. Remember guys, this is a current liability, right? This might be needed for further questions. So this is a current liability. Maybe guys, if we have time today, we'll practice that pre-mock question and see regarding contract accounting. Okay guys, next question. What should be recorded in the statement of financial position relating to contract number 3? So guys, SOFP means you know what they want. Contract asset or contract liability. Normally guys, how do we find that answer? First, we should take the contract. What you should take, first thing guys, what you should take is you should take the contract price. Okay, right. From the contract price guys, not contract price, my bad. First thing guys, what you should do, you should take the revenue recognized. From this, you should subtract the amount billed. Okay, right. Now guys, always how do we recognize revenue? Same way. First take the price and put the percentage. So contract number 3 guys, price is 4,000. Okay. Price is 4,000. Yes, wait. Price is 4,000. What's the percentage guys we are using? 25%. Good. Therefore, revenue recognized will be 1,000. Amount billed. How much guys we have billed? 800. Now deduct. 200 positive. If the answer is positive, it's a contract asset. If the answer is negative, it's a contract liability. Simple as that. Okay, this is how guys you should find the answer. So guys, if you know the equation, and normally when we do contract accounting guys, we have 4 steps now. Step 1, overall loss or profit. Step 2, the progress rate. Step 3, income and cost of sale. Step 4, contract asset or liability. If you know the equations, it's just a matter about you putting these equations and getting the answers. Okay, right. Then guys, next part. Bailey's assistant accountant is unsure how to deal with a brand new contract when the progress and the overall profit cannot be asserted. Which of the sentence is true? When the progress and the overall profit are unknown, no contract asset or liability can be recognized. That is guys false. Where the progress and overall profit are unknown, revenue should be recognized at the recoverable cost. Yes, that statement is true. Okay, last question. Bailey's assistant has also inquired about changing the way of measuring the progress of contract. So they want to change the way. Okay. How should this be applied? Now guys, when you're changing the measure of progress, we call it as a change in estimate. Because guys, the way we measure the contract depends on the directors. Some directors, what they do, they measure the progress according to the cost. Some people, they measure the progress according to the work done, output. So whether they are using input approach or output approach will come down to the business, the director. So it's an estimate. So when you change an estimate in accounting, that change has to be done prospectively. These are the 2 answers for the question. It's a change in accounting estimate. In IAS 8, when you change an estimate, guys, we should do what effect? Prospective effect. Okay. So this should be the answer, guys. So I think with that, I have guys discussed with you the entire, what you can say guys, mock paper. We have done the discussion and finish it off. All okay, no? Right. So guys, in this question, I was a little bit fast. You can guys take down the workings and let me know guys if there was anything difficult. Especially guys, you should understand number 7 properly. Okay. That is how to find the cost when it's a loss-making contract. Plus this cost must be broken down to 2 parts definitely in the paper. But at least in the back of your mind, you need to break it down to 2 parts for further questions. Right. So mock paper is guys fully done. We'll move on to other questions in the exam kit, right? We'll do a little bit more consolidation. Guys, listen. Next week, I will practice with you individual financial statements. Right? I'll tell you standards to go through and come. So next week in the marathon, we'll look at individual financial statement. Today, we'll focus on consolidation. Right? Individual financial statements, guys, remember when it comes to the income statement format, there is a small change. Not much. A slight change has happened in the syllabus regarding the income statement format. I will explain to you next week and do questions and show you how the change is going to get impacted. But don't worry, very small change only has happened. Okay, it's not as big as people are thinking. Right? I will explain to you the changes. Don't worry, because IAS 1 has been replaced with IFRS 18. But not a massive change, minor change. When I teach you the change, you will understand, is this even a change in the first place? Right? I'll show you. Right. All good, guys? Right. Now, guys, in today's class and Friday class, I explained to you consolidated SOFP. But we haven't done much questions on consolidated income statement. Right? Only one question we practiced in class. Now, guys, I'm going to pick up a question. I'll tell you, guys, this question is little hard. Okay. Now, we are going to do a past paper on income statement. This question is a little hard. And same like this, another question was repeated. I will tell you which year paper. Then, you can practice this extra. It was in the ACCA platform, I remember. Okay. Right, regardless. Okay, now guys, in your exam kit, can you guys go for this question, guys, over here? It's an income statement. Question name is, guys, plank. Right, go for that question, guys, if possible, on the income on the exam kit. Go to, guys, the question that says plank. Okay, but go to that question then. Plank question. Yeah, this question, guys, over here. Okay, right. Question number, guys, 434 in page number 150. Go for that question, guys, over there. Question number 434. It's a consolidated income statement. So this is second income statement, guys, that we are practicing in class in terms of past papers. Go for that question, guys. 434. Plank Corporation, page number 150. Okay, let's look at the two things what they are asking. Number one, prepare the consolidated statement of profit and loss and other comprehensive income of Plank. Calculate the carrying amount of investment in Arch. So looks like it's an associate. Okay, carrying amount of investment in Arch means I think it's an associate related question. Right. Okay. Guys, first of all, right, let's go to, right, can you guys open an Excel sheet then? Right, open an Excel sheet. Okay. So guys, then put the heading question number 434. We are doing plank. Okay, working number one. First, guys, let's draw the group structure. After that, we will we'll start copying. So normally, guys, income statement, first we'll draw the group structure and show, because then only we understand whether to do the number of months thing, no, 9/12, 6/12, that story. Okay, right, guys, first of all, okay, look at this date, draw and show me timeline, guys, faster. Okay, look at this date. First of all, can you draw and show me the timeline? Okay, working number one, group structure. First of all, guys, please show timeline. Okay. Right. So guys, done with the timeline then. Right. So guys, this question is ending on December. That means, guys, when should the question start? 1st of Jan. 1st of January 2001, 2008 question will start. This will go all the way until 31st of December 2008. All good guys with that one, right? Now guys, let's look at the first paragraph. Now guys, don't worry about this part. Carrying amount of investment in art, for the time being, don't worry, we will come back to that one later. Okay, right? Now guys, look at this one. Okay, Flank has owned arts 35%. So guys, when you own 35%, guys, we call it what type of an organization? It's an associate. On June 2007. That means guys, should I be worried about the number of months? June 2007 means, should I be worried about the number of months? No, because guys, question is starting on January 2008. No, you bought it before, then don't worry about the number of months, right? So let's start writing guys over there, right? P acquired 35% of A within brackets full year associate. Okay, done. And it acquired 85% of S. Then guys, below that write down P acquired 85% of S. Okay. On 1st of April 2008. Now guys, should I be worried about the number of months? Yes or no? Yes. Guys, when you buy someone in April 2008, is that is after January 2008. No guys, so until December guys, how many months are there? If you buy them in April until this one guys, how many months are there? We have only then 9 months. No guys, if I'm not wrong, right? If you buy in April, May, June, July, August, September, October, November, December. Yeah, it's a 9-month subsidiary, right? Within brackets guys, right here, this is the 9-month subsidiary. All okay, right? Done. Guys, now that we understand the group structure, A is an associate while S is a subsidiary. Now in income statement, once you understand the group structure, now guys, we can start copying all the numbers, but you have to be careful. I'll give you time to copy. Just look at this guys, how it's done now, right? So you put the heading really together. Okay, we'll start doing this together, right? Put the heading P group, right? Consolidated income statement. No, consolidated, my bad. Profit and loss and other comprehensive income year ended 31st December 2008. All okay, right? Guys, now let's start copying now, right? First thing guys, we have revenue, right? Copy the revenue 705,000, right? Now guys, look at this carefully, yeah, plus subsidiary, but guys, subsidiary we should put how many months? 9/12, because we only own them for 9/12. Now into 9/12. Guys, now tell me, arch income and expenses, can I consolidate and show like how I'm doing for a subsidiary? Can we do that? No. Even though Archer's revenue, cost of sale, income, expense, everything is given, guys, remember, you don't consolidate them like how you do for a subsidiary, because we don't have control, right? They are not in the group, they are outside the group. So because we don't control them, their income and expenses, we are not adding. That means we are not consolidating like how we do for a subsidiary. These are just given to confuse you. Only subsidiary numbers, guys, we should mark and show. All okay, right? Now guys, then let's start copying them together, right? Put the next heading then, cost of sales. Copy parent, add subsidiary, but this into 9/12. Don't copy arch, don't copy associate, right? Okay, so okay, now guys, can you then start copying them, right? Put the next heading then, gross profit, keep it blank. We normally don't copy the gross profit. Right, next one guys, we have distribution expenses, right? Mark that and show guys, distribution expense, distribution cost. Okay. 58,000 plus 16,000 into 9 over 12. Right. Next one, guys. Administration cost. Copy that also. $92,000 plus 28,000 into 9 over 12. Okay. Then, guys, we have investment income. After, guys, now remember in this question we have an associate now. So after investment income, a new sentence should come as profit share from associate. This is working number 3. Why this is working number 3? Because, guys, remember working number 2 is what? NCI profit. Okay, so this is then working number 3. Right, next part, guys, we have then finance cost. Right, copy that one. 12,000 plus 14,000 into 9 over 12. Then, guys, next one, profit before tax. Investment income, guys, I forgot to copy actually. Right, copy that one. 46,000 plus 2,000 into 9 over 2. Right. Profit before tax, we don't copy. Tax, we can copy. Okay. Then, guys, next one, profit for the year, don't copy. Right. Other comprehensive income, guys, you can copy. Okay. Copy the gain on revaluation. 2,800 plus 3,000 into 9 over 12. Okay, guys, even for revaluation you should put 9 months, huh? Right, you have to put for 9 months unless they specifically tell you not to put, unless otherwise we have to put. Right, then, guys, we have total comprehensive income. Okay, right, then, guys, you have to add sentences on your own. Okay, so after total comprehensive income, guys, what you should write? Right, profit attributable to, okay, parent NCI. This is working number 2. Right, once again, after that, total comprehensive income attributable to parent, and then we have NCI, which is working 2. Okay, first of all, guys, can you copy it and keep, guys, up to this point? Okay, right now guys, once we have marked all of these, we'll keep the other two parts also ready, then it will be easier for us. Okay, now guys, can you put the next heading once you're done with this part, right? Working number 2, right? NCI profit. Right. Okay, start copying the equation guys. Right. Subsidiary profit after tax minus impairment minus fair value depreciation. So guys, we have to learn all these equations. Okay, then guys we have minus URP. But guys, remember over here URP, who should be the seller guys? Is it the parent or subsidiary? To affect the NCI, who should be the seller? And normally guys, URP can happen if parent sell to subsidiary or subsidiary sell to parent. No, in this working guys, you should take who, when who is the seller. When SOP, think, if who sells will the NCI get affected? If the parent is selling or if the subsidiary is selling? Subsidiary, because guys, when parent is selling, parent now makes the profit, so it doesn't affect NCI. When subsidiary is selling, subsidiary when make profit, it will affect the NCI. So within brackets guys, it has to be, you can make it and keep, right? If S is seller. Okay, done. Right, then guys, below this write down adjusted profit. Okay, then guys, subsidiary OCI. Then we have adjusted OCI. Okay, so this is the equation to find subsidiary profit. All okay, right? Then guys, can you put the next heading then? Working number 3. Okay, working number 3, profit share of associate, because that is also there now, right? Copy down this case, profit share of associate. Okay, right, let's start. Below this one guys, can you write down first one, profit share, okay, minus the impairment minus URP. But guys, you have to be careful if A is seller. Okay, if A is seller. So in this equation guys, URP will only affect if who is seller guys, if A is seller, if associate is selling to parent. So guys, these are all the workings that you need to do the income statement. But guys, remember there is another one question also they are asking, no, calculate the carrying amount of investment in Arch in the consolidated statement of financial position. That means they are asking in SOFP, how much will be the associate. So guys, this is a very good question to learn associate properly. You know why? Normally guys, when it comes to associate, there are two things, you know. Income statement answer for associate, we are doing in working number 3. Then in SOFP, we have to do investment in associate, working number 6. So this paper, after you finish the income statement, separately they are asking from you how much will be as Arch, who is the associate, his investment in the SOFP. Right, then guys, separately can you put down over there, right, part B of the question, investment in associate. This one guys, normally we do for SOFP as working number 6. Today morning we did no one, same like that. Okay, so start writing investment in associate, right, copy down the equation, investment, right, plus PAR, post acquisition reserves, okay, okay, minus impairment, okay, minus URP. Here guys, you have to be careful if P is seller. Okay, if A is seller, it will affect the profit share. If P is seller, it will affect the investment in associate, the SOFP working. And also guys, minus any dividends received. Right. Can you guys copy down all of these and keep? Okay. Now guys, we have copied everything that's needed for the question. First of all guys, I will give you all the easy adjustments for you all to start on your own and show it to me. After that, the difficult one guys, I will start explaining to you how it's supposed to be done. Okay, right. First of all guys, can you keep everything ready? After that, we'll start with you. Keep all the adjustments ready. So guys, remember, like I said, it's a very difficult question. There are some parts guys, you have to listen very carefully to what we are doing. Once we do this, I will then take up another question, right? And I will show it to you guys over there. Same like this, I remember there was another one question. Let me find that and give. So after the break, we can practice this also. Yeah. We are putting P to show this one company name. Okay. Now for an example, guys, if it's a question like this, right? Now we have 435 gold corporation. Now, so here what's happening? Gold acquired 90% of silver. That time when I'm writing the group structure, I will write G acquired S. Okay. In the exam kit, most of even past papers, most of the questions, parent company starts with P, subsidiary company starts with S. So we put P acquired S. But to clarify your doubt, we are writing the initial for the company name. So this is a good question to clarify your doubt. Now here gold is buying silver. No? So in the group structure, you should write G acquired S like that. Are you okay with that part? We are writing the company initial and only showing the company name, not parent subsidiary. Company initial only we are showing. All okay, no? Right, no problem. Okay, guys, I will mark and give you some adjustments, guys. I want you all to try this on your own. I hope all of you all guys have kept the workings ready, right? If you still want time, let me know. Okay, right. Anyway, I'll keep it on this side if you want, right? Guys, can you do and show me, guys, these adjustments on your own? These are the easy ones. Can you try to do adjustment number 1, adjustment number 2? Right, try these and show it to me, guys, over here. Right, adjustment number 1 and adjustment number 2. Try those two first. Those are easy ones. Okay. Here you should do only one thing. Over here, you all should do 3 things. That means 3 things are involved inside that. Okay, so try to do those, guys, over there. Yes, if you all want, you all can give an attempt for this one. Nah? Number 4. You can try if you want. We have done something like this in class. So you can try and see if you want. Don't do the others, guys, because I have to explain those, right? Okay, guys, shall I discuss those adjustments and show it to you? Right, little bit check value. Right, next question you can do better. Right, first one, guys, what happened? A fair value exercise conducted on April 2008 concluded that the carrying amount of the net assets were equal to the fair value, with the exception of an item of machine which had a fair value of 8 million in excess to its carrying amount. Now, guys, what happened? Fair value increase. Guys, understand the 8 million fair value increase, we normally show that in SOFP as a fair value adjustment. Understood? So that 8 million you don't have to mark anywhere because that's a fair value adjustment. But guys, to the income statement from that 8 million, what will affect you? The paper says very clearly what you have to calculate, guys. You have to calculate depreciation. Right now, guys, can you make sure you haven't done any mistake? Look at this. 8 million is the increase in fair value. The 8 million will go to SOFP. What is important for the income statement? Depreciation. Divide by 3. But guys, you have to be careful. Whose plant is this? This is the subsidiary's plant. How many months subsidiary, guys, are we looking at? 9 months. So therefore guys, this you have to see into 9/12. All okay. So when you do this one guys, what will be the answer? 2000. This 2000 paper says charge it to where guys? Cost of sale. So therefore I want you guys to now go to your cost of sale. To your cost of sale, could you add this 2000 and show? Done. That's it for the first part. All okay guys with that one? Right. Then guys, next point. That's it from the adjustment. That's the only thing that we should do. Since acquisition, Plank had sold goods to Strip for 39 million. So guys, keep in mind, Plank is selling to Strip. Parent is selling to subsidiary for 39 million. Stop here. Guys, when someone is selling, what is the name of this adjustment? Intra-group sales and purchase. What should we do? Should we keep them? No, we have to eliminate. Exactly. So one company is selling now guys. That means so one company sale. Remove this from sale. Minus how much? 39 million. Correct. For other company guys, this is purchasers. Purchasers in the income statement is normally where? Inside cost of sale. Then remove this from cost of sale. Done. That's it. Now what you should do? You have to guys start calculating now URP. Always we should do that, right? When parent is selling to subsidiary or subsidiary is selling to parent, after you eliminate the sale and purchase, definitely next one, no need to read the paper. It will be URP. Right, now guys, let's start then calculating then URP. Let's see how we are going to do that one. Right, Strip had 1/4 of these goods. So normally guys, URP, how do we calculate? Profit into inventory held. The paper says Strip had 1/4, 1/4. Now guys, calculate profit. Profit equals selling price minus cost. 1 minute. Okay, right. So guys, profit is equal to selling price minus cost. Right. Profit is how much guys? 30%. Here, all goods are sold at 30% markup. But guys, markup means who is 100? Cost of selling price guys. Cost. Good. Selling price should always be bigger than the cost. That means selling price is 130%. Guys, if you are selling for 39 million, remember 39 million is your selling price. Now find how much is the profit. How to do that? 39,000 divided by 130 and that into 30 should come over there. Right. That time guys, what will be the answer? 39 million divided by 13. Is it 900,000? Yeah, no, 900,000 or 9,000. 9,000. No, 9,000 will be the profit. This thing to 1/4 guys, I believe the answer should be 2,250. Guys, I have said you a shortcut. Doesn't matter who is selling to whom. When you guys get the URP, what you should do guys, doesn't matter who sell to whom. When you sell, URP guys should always be what happens? Should be added to cost of sale. Exactly. Add to cost of sale guys over here plus 2,250. That's your answer. Okay. Right. Then guys, let's move on to the next one. Not only parent is selling to subsidiary guys, parent is also selling to what? Associate. Okay. Right. Now guys, let's start. Again guys, how do we calculate this also? Profit into inventory held. But guys, in class I said you, when you do associate URP, same equation, profit into inventory held. Plus, there is another one thing guys, what you should do, put the associate percentage also for it. That's the only difference. When you do URP between parent and subsidiary, profit into inventory held. But when you do guys URP between parent and associate, profit into inventory held plus the associate percentage also guys must be put. All okay? Right. Now guys, let's start doing. Right. First of all guys, how much is inventory held? 100%. Why? All of the goods are still inside the inventory. Associate percentage guys was how much percent in our paper? 35%. 35%. Okay guys, now again start calculating the profit value. Profit is equal to selling price minus cost. Profit is 30% markup. Markup means cost is 100. selling price is 130. We sold for 26 million, guys. Then 26 million is 130%. Please calculate and give me, guys, how much is 30% in that case. Right. So, guys, 26 divided by this one, how much is it? 6,000. No, only the profit. Yeah, I think only the profit. Correct. I think Hardik, okay. I think that 6,000 should be the answer. No, 6,000. But then when we put it over here, 6,000 into 35%, guys, what should be the answer? 2,000? 2,100. This is the answer. Okay, right. Now, guys, listen carefully. What's a double entry? Right now, guys, listen. I'll tell you a small thing, guys. Keeping in mind, associate and parent URP double entry is a little bit difficult. Now I'm sending you a short note. Start studying that one, guys, because it's very difficult to keep in mind the double entries for URP, especially between parent and associate. Right now, guys, listen. I'll share the short note with you. Don't worry. Right, but 2,100, guys. Now who is selling to whom? Parent is selling to associate. So, guys, when parents sell to associate, guys, what should happen? If you are doing the income statement, once again, go and add this to cost of sale. Right now, guys, again to cost of sale, can you add this answer and show plus 2,100? Okay, add it, guys, over there. Right. Then, guys, what will happen? Cost of sale will become debit. Then where should it become credit? Okay, it should become credit in working number 6. Can you guys mark it over there? In working number 6, it has to become credit. Investment in associate will become credit, minus 2,100. This is how, guys, the URP should be done. Okay, once you get the answer, add to cost of sale debit, credit where? SOFP, investment in associate. I'll share the double entries, guys, with you now in the group. So start studying that one. And also, guys, one more thing I forgot to mention. This 26 million, we don't have to remove. Now see, guys, when I did parent and subsidiary sale, what did I do? First I removed the sale, then I did the URP, correct or wrong? But when you're doing sales with associate, you have to only account for URP. No need to remove 26 million from our books and the cost of sale. You know why? Guys, associate sales and cost of sales, are you adding and showing in consolidation? No, right? Now see, guys, when you're copying the numbers, did you take arch, revenue and cost of sale inside the profit and loss account? No. Why? They are outside the group. Because they are outside the group, this 26 million worth of sale, no need to remove like how we do for subsidiary. The only thing that you should account for it is going to be the URP only. So remember, guys, know the differences. Parent and subsidiary, when they sell, we should remove sales and cost of sales because they are part of the group, and then do URP. When parent and associate do sales and purchases, you don't need to remove sales and purchases. Why? They are not part of the group. We don't consolidate them. The only thing, guys, what you should adjust for should be the URP. So, guys, when parent is selling in the income statement, add it to cost of sale only, because the paper is asking about working number 6. In working number 6 also it should be marked. Now, before I forget about this one, guys, let me send it to your WhatsApp group. Then we can check and see. Okay, so please start studying, guys. Double entries for URP with associate. That's the only confusing part of associates. Okay. Right. I shared it to the WhatsApp group. Huh? Right. Guys, then what is the next adjustment, guys, that I gave it to you? Right. Look at this part now. The investment income of Plank. Guys, investment income of Plank means they are talking about this one. Here, guys, this 46,000, right? They are talking about that. Let's see what they are telling. The investment income of Plank includes dividends from strip and arch. Look at note number 4. Guys, listen. When subsidiary gives dividends, we should remove that in consolidation. When associate gives dividends, that also, guys, we should remove. I'll tell you why. Listen. When subsidiary is paying dividends, guys, it's an intra-group transaction. We should remove that from our books. When associate gives a dividend, we should remove that from the book. You know, guys, why we had to remove that from the book? Because, guys, in the income statement, separately we are showing as working number 3 profit share of associate. No. Then the dividends from associate, again we can't show in our books. We have to remove and only show the profit share of associate. Now guys, this is a mistake that you should avoid making in the exam. Careless mistake that many students do. Listen, look at this. Now you understand now guys, when subsidiary pay dividends, it's inside investment income. What should I do? I should remove. When, who is the other person guys? When associate is paying dividends to us, that also will be inside investment income. That also guys, what we should do, that also we should remove. Now to remove the dividends, first of all, we should know the dividend. No mistake that students make: strip paid a dividend of 18, arch paid a dividend of 35. Students normally what they do guys, they remove the entire dividend. Don't do that mistake. Okay, remember guys, strip is paying dividend to all shareholders. Are we owning everything? No, we only own how much percent guys? Only 85%. Then only our share we should remove from the consolidated P&L. Even guys, when it comes to Arch, he is paying 35 million guys to all the shareholders. Do we own everything? No, we only own 35%. So therefore guys, only that particular share has to be removed from the investment income. So guys, let me summarize it for you. Number one, when subsidiary pays dividends and when associate pay dividends, it will be inside our investment income. During consolidation, we have to remove that. But when you are removing, only remove parent share of dividends. Don't remove the entire dividend. Only what we are entitled to guys, we should remove. Okay, right. Now guys, let's start calculating them. Right. Now guys, start value 18%, 18 millions, 85%. Right. What should be the answer guys? 15,300. Correct. This is the 85%. Then guys, 35 millions, 35%. How much guys? 12,250,000. Guys, remove both of these guys from the investment income faster. Right. In your income statement, remove now. Okay. Right. Parent share was 15,300. Remove that. Subsidiary share is 12,250. Remove that. Okay, right. So this is how guys this adjustment should be done. Okay, right. Guys, now look at this part. 1 minute. Let me guys clear the screen. There's a lot of things are going on. Okay. Right, now guys, we have done everything. Okay, now guys, look at adjustment number 5 and 6. After that one guys, I'll put you all to 3 because 3 is the difficult one to understand. Okay, right. Look at guys now adjustment number 6 and 5. First look at 5. In Plank's consolidated financial position, the carrying amount of the investment was 145,000. So guys, at the end of the last year, associate value is 145. What should we do with this one? Can you guys copy this and show it to working number 6 guys faster? Investment in associate from last year brought forward. Start writing 145,000. Because guys, this is an old associate now. So last year the closing balance is 145,000. Mark it and show here. Guys, we are doing the question without the zeros. No. So no, it has to not wait. Are the adjustments also without the zeros? That means that this answer will come in a minus, no? First, let's mark and keep you guys 145,000 milli, but I think it has to be, but then I think it has to be just 145,000. That's fine. Okay. If not, guys, the answer will come as a minus answer now if I remove the 3 zeros. Okay. That's the next part. Number 6. Now, guys, look at this carefully. Very important point. All other comprehensive income occurred after 1st of April 2008. Underline that and keep it. Underline the date. Okay. It occurred after 1st of April 2008. Guys, now go to this part. Now we need to do adjustment. OCI. Okay, all other comprehensive income means gain on revaluation. Now guys, now tell me, for this 3000 we put 9 over 12. Okay, why? See guys, subsidiaries gain on revaluation is 3000. When we are copying, what did we think? This 3000 is for the entire year. So we should put 9 over 12 because we only own them for 9 months. But now guys, what is the paper telling? All other comprehensive income occurred after 1st of April 2008. Think and let me know. This 3000 guys happened after April. That means, is the 3000 for the entire year or already 9-month answer? Already 9-month answer. Very good. So therefore guys, delete 9 over 12. If they didn't tell this point, 3000 should be for 9 over 12 because 3000 is for the entire year. But now the paper is adding a point telling that 3000 happened after April. That is guys post acquisition. No? Meaning that 3000 is the answer for the 9 months. So I should not again put 9 over 12. Then my calculation guys will become wrong. Right? So I should remove that then into 9 over 12. That's a very difficult thing to understand. So online children guys, if you didn't get that part, please tell me, I will re-explain. Remember, it happened after April means April to December, that's the 9-month answer now. So if it's already the 9-month answer, again no need to put 9 over 12 now. That's why I deleted 9 over 12. Right. So this is one difficult thing to understand. Now guys, another one difficult thing coming up. Look at this. Third adjustment. After that guys, I'll give you all the break. Right. The investment income of Plank for the year ended 31st of December 2008 includes dividends from strip and arch. That part we already did know. Okay. It also includes 5 million interest receivable on a loan made to strip on 1st of April 2008. Guess what happened? Plank gave a loan to strip. So for that 5 million interest should come with SIMS. But the loan was given on April 2008. First of all guys, tell me, if you give the loan on April 2008, this 5 million interest, is it the interest for the entire year or is it the interest for 9 months? What do you think guys? The loan was given on April 2008. There is a 5 million interest, it seems receivable. What do you think guys? Is it the interest for one entire year or is it the interest for the 9 months? For the 9 months, exactly. Because guys, it was given on April, no? So April to December means that's a 9-month interest. Okay, now what is this 5 million interest? Intra-group transaction. Guys, tell me, if it's an intra-group transaction, what should we do in consolidation? We should remove. Exactly. Now think, who gave the loan? Parent gave the loan. So for him, he has marked it where? Inside investment income. Guys, can you go to investment income and remove and show this one? Minus 5 million, remove from there. Okay. Minus 5 million, remove from there. Okay, right. Guys, for parent, this becomes what guys? Investment income. Because he is going to get the interest. But guys, for subsidiary, what should this become guys? For subsidiary, this should become interest expense. So normally guys, in the income statement, where do you see interest expense guys? You normally see it in finance cost. Very good. Now guys, from the finance cost, you should remove another 5,000 from here. Okay, we should remove that. Right. Okay, now guys, before we go for the break, can you guys only calculate and show me guys working now? See guys, we read the entire question. Everything is done. Okay, right. Can you guys now do and show for me guys this part over here? Can you do and show me working number 3? Only let's complete that. After that one guys, I'll give you a 1 hour lunch break and then we'll continue then 1:30 to 3 or 3:15. Okay, right. Okay, can you guys then try to do that part guys then for me over there? Try to calculate profit share of associate. Just follow the workings. Okay, and you should be able to get the answer. Yes. Yeah, tell you had a doubt, no? Yeah, tell. Yeah, the reason why we are recognizing the parent percentage is because number one, for subsidiary we don't do that way, because in subsidiary we have control. That means all the assets and liabilities will become like our assets and liabilities. But in associate company, because we own them between 20 to 50%, we only have influence. Okay, so that means their assets and liabilities will not become our assets and liabilities because we don't have control. So because of that reason, for the URP, we have to calculate only our share and take. When we do subsidiary accounting, we mark the whole thing, no, right? Because subsidiaries, income, expense, assets, liability, everything is ours because we have control. But associate, it's not that way. Because of that reason, when you compare for the URP, we have to put and take only our share because we are not controlling associates. So only what is related to us only we mark. That's why for the URP, we add another parent share and take it unlike how we do for subsidiary. That's the reason, because we don't have control. Okay, right now guys, I requested you all to do guys working number 3, profit share of associate. Right now guys, see over here, first one, we need the profit share. How to do that one? Like this guys, go to now Arch. Arch is the associate, no? He made a profit of 92,570. Luckily there is no OCI. If there is an OCI, you should take that also. So what you do guys, take 92,570, right? But guys, can we get the entire thing? No, only 35% we have to take. Should I be worried about number of months? No, it's a fully a subsidiary, right? So therefore guys, when you do this answer guys, it should be 92,570 into 35% guys. I think we should round it off and take the answer, no? 32,400, correct. Okay. Guys, this question, did we have any kind of impairment? No. There was a URP, but the problem is guys, who was the seller at that point? Parent, not associate, no guys. So here also it will become 0. So therefore guys, final answer guys will become 32,400. This 32,400 guys, can you now mark it over here? Okay, once you have done with the working, copy this answer guys to the income statement. Okay. How much is the answer? 32,400. Okay. Guys, I need to explain guys another one important point. It missed when I was doing this part. Guys, now can I go back to guys finance cost? Right. This will be a little bit difficult to grasp. Okay, go for this one guys, last part. I'll give you all the break after that. Go to the finance cost. Okay. Guys, now look at this. Very important here. I'll give you the other question also, then you will get familiar with this part. Guys, tell me, now look at this guys. Now, inside your income statement, subsidiaries finance cost is 14,000. Okay, from where did we get 14,000 guys? Here, from the question paper here, I got 14,000. This one, nah? Right. Now guys, originally what did I do? For 14,000 guys, I put into 9/12. Let's now think. This 5,000, what I have guys over here, is it inside the 14,000? Yes or no? Right, 5,000 is what guys? The interest that the subsidiary should pay for the loan he took from parent. Think and tell me, this 5,000, is it inside the 14,000 guys? Yes or no? Yes. Now guys, 14,000 we are putting into 9/12 now, but that 5,000 is already inside this, correct or wrong? Is 5,000 the answer for the entire year or only for 9 months? The 5,000 is guys answer for entire year or 9 months? 9 months. So therefore guys, what you should do, first of all, from this 14,000, can you put guys minus 5,000? Because if you don't put minus 5,000, what will happen? Now you agree, inside 14,000, 5,000 is there. 5,000, is it the answer for 1 year or for 9 months? 9 months. So if it's inside that, again, if you put 9 over 12, then you're doing it 2 times, correct or wrong? So therefore, what you should do, guys, from 14,000, first remove that 5,000. Okay. Why? Because the 5,000 is already time apportioned now, guys. I said, when I started the question, the difficult question, right? Already 5,000 is time apportioned. Now when you remove, that's the finance cost for the entire year. Now you can do 9 over 12, guys. Now again, behind this, add back 5,000. Behind this, add back 5,000. So what's going to happen, guys? Like this, 14,000 minus 5,000 is 9,000. 9,000 is the finance cost for the entire year that you should put 9 over 12. Why I'm adding back 5,000? Because guys, in his records, 5,000 is already there now. So you should add back. Right? And then later, you're again removing the 5,000 because it's about transaction, intra-group transaction you're removing. That's a little difficult to understand. Okay, now I'll be very honest with you. When I did the question for the first time, I didn't do this part. So that's not something that we would actually think now, guys, right? We normally put 9 over 12. So even I got the question wrong when I did first time. It took me a couple of days to actually understand what's happening there. Right? So now I'm a little bit more careful when I do the question. Then there's another question just like this. I keep telling you, right? So then you can practice. So what happened is, guys, 14,000 has 5,000. You should remove the 5,000 first because already 5,000 is for 9 months. If you don't remove, you're checking 5,000 twice for 9 months. So first you remove 14,000 for 5,000. Then see 9 over 12. Then you will get the proper finance cost for 5 months. Then you have to again add back 5,000. Why are we again adding back 5,000? Because guys, that 5,000 is already in subsidiaries records. No? So you have to add. And then yes, later remove as an intra-group transaction. So difficult adjustment. I'm not telling no. Right, guys, have your lunch break. Come back at 1:35. Then we'll finish this question and we'll try to do another one income statement for today. Okay, right. Have a lunch break and come back. Yes, then let's continue. Because I think we did all the calculations. No, right. Then guys, have we then quickly now start totaling it up together and then we can start another one question then guys for today. Okay, right. Right. Then guys, let's start the calculation. Okay. Right. So guys, first one, 70,500 plus 21,800 into 9 divided by 12 minus 39,000. Okay. 705,000 plus 218,000 into 9 over 2 minus 13. So guys, I'm getting 829,500 forever. Correct, no? Okay. Then guys, cost of sale 320,000 plus 81,000 into 9 over 12 plus 2,000 minus 39,000 plus 2250 plus 2001. So guys, cost of sale, is it guys 348,100 or is it slightly different? No? Check. I think as cost of sale, I just checked with the marking scheme and saw it's coming as 348 100. Correct, no? 348 100. That's fine. Okay. Then guys, gross profit should be minus 829 500. 481 400. Yeah, that's fine. Distribution cost guys, and let's check and see. 58,000. That one guys, anyway, no adjustments, no, so no problem there. 70,000 and 113,000. Investment income guys, let's check and see. 46,000 plus 20,000 into 9 divided by 12 minus 15,300 minus 12,250 minus 5,000. 14,950. Yeah, that's correct. Then guys, finance cost 12,000 plus 9,000 into 9 over 12, 18,750. That was correct, no? Then in that case guys, profit before tax 327,500. Tax means guys, there is no problem at all, no? 62,750. Okay. Then guys, profit for the year 264 250. Right. Other comprehensive income 5,800. Then guys, total comprehensive income 270,050. Just check guys up to this part and see whether the answer is okay, and then I will explain to you guys how to find the NCI profit. At that point guys, you have to be a little careful. Okay. Then guys, shall we calculate NCI profit now? Okay, right. Okay, now guys, can all of you all then guys go to working number 2? Right. Let's go to working number 2. Right, now guys, first thing, now here again guys, you all have to be very careful because of that 5,000 interest. Right, that's the thing that is playing a major factor in this question. Okay, now guys, see, first thing I need subsidiaries profit after tax. The question paper says it's how much guys? Subsidiaries profit after tax is 66,000, what we have here, right? 66,000. Right, first copy this one guys over here, 66,000. Okay, guys, now think. Now normally guys, what we do, we take subsidiaries profit after tax guys, and what we do, we put into what guys, 6 over 12. I mean not 6 over 12, we should put 9 over 12. But wait, inside this 66,000, is there a number already which is prorated? Yes or no guys, what do you think? Yes, because guys, see, in subsidiaries profit of 66,000, can you remember inside that 14,000, how much is there? 5,000. That 5,000 guys, is it already for 9 over 12? Yes or no? Yes. Then again, when you put 66,000 9 over 12, then you're checking it 2 times. So therefore guys, what you need to do, this 66,000 is there, no guys. From this, I want you to first add back 5,000. Why we are adding back 5,000? Now guys, for subsidiary, this was interest expense. So if it's interest expense means when he is calculating profit, what he has done with the 5,000, he has deducted. So you add back and then see into 9 over 12 first. Okay, so that's a little bit difficult thing, right? Okay, First check that answer and see guys over there. 66,000 plus 5,000 into 9 divided by 12. Okay. $66,000 plus 5,000, that into 9 over 12. Okay, right. That time guys we are getting how much is the answer guys? 69,750. Now guys what you do, now that you have put this answer into 9 over 12, now from this subtract 5,000. Okay, right. So why guys you have to subtract 5,000? Because remember guys, at the end of the day from that account that 5,000 has been deducted. Now the reason why we added in the first place is because that 5,000 is already into 9 over 12. Right, so add back and then check this one into 9 over 12, and now guys subtract another 5,000 from that. Now you will get the adjusted profit. So guys, adjusted profit is then how much? 64,750. This should be the answer for profit after tax. Again guys, what I did was like this. You take 66,000, put it over here. Okay, the thing is this 66,000 includes 5,000 which is already 9 months now. First you add back and then check income and expenses for 9 months. But this interest is still in his books of accounts now. So you have to subtract it, then get subsidiaries profit after tax. Okay, now it's easy. Right, impairment. We didn't have guys any kind of impairment.
After 63,000 minus plus 5,000.
66,000. Yeah, plus 5,000.
into 9 divided by 12, 53,200.
No, 66,000. How much you got? 66,000.
66,000.
Okay.
After that, 9 divided by 12.
Wait a minute. 66. That means 71,000 into 9 over 12. 53,250. No, correct. 53,250. To that, now guys, again you have to subtract 5,000, because at the end of the day that interest should be deducted. That means guys it will become how much? 48,250. That should be the answer. Okay. Then guys, no impairment. Fair value depreciation. Can you guys remember depreciation was how much in our paper guys? It was 2,000. So take 2,000 then. Guys, should we put the 2,000 into 9 over 12? No, it's already into 9 over 12 now, right? URP, if S is seller, is S seller guys? No, then 0. Right, now guys get the adjusted profit in that case. Then it will become 46,250. Okay. Now guys, what you do for this answer, put the NCI percentage. So guys, NCI percentage in this question is how much? 15%, no? Because they bought 85%, no guys, of the company. Yeah, so therefore you have to see for 15% into NCI. Check this answer and see guys, then into 15%. 46,250 into 15%. So guys, it's coming as a decimal answer in that case. 6,937.5. No, yeah. So guys, in the marking scheme they haven't rounded it off, so here we will go that way. 6,937. Right. Subsidiaries OCI. Now guys, look at the question paper. Subsidiaries OCI is how much guys? It is 3,000. Take 3,000. Guys, for this 3,000 should you put 9 over 12? No, because it's already after acquisition. No, exactly, right? Okay, now guys, add this and take then 49,250. For this guys, again see 15% subsidiaries OCI. So guys, then is coming 7,387. Okay. Right now guys, what you do, please take these two answers now. And guys, now can you copy it and show now in the income statement? Now copy this answer. Right. NCI profit, copy it here, 6937. NCI's TCI, copy it here, 738. Okay. The NCI profit guys, copy it here. NCI's TCI, you copy it over here and show. Okay. Right. Now guys, look at these two. I'm now highlighting two cells. Right. This one and this one. Okay. Right. Now guys, this answer, can you bring it now? The profit is there, no group profit. Bring it down for this 69. 264,250. And then guys, this 270,000, the TCI is there, no? Right. Bring that below this. Okay. Right. Now guys, can you work out and show guys how much is the parent share of profit and parent share of TCI? So what you should do guys, from this answer you remove NCI, from this answer you remove NCI, and then you will get the share. So guys, 264,250 minus 6,937. Here guys, what's the answer? 257,313. Okay, remove this one guys from here. 275, 20,050 minus 7387. 262,663. So guys, with this one, income statement is completely done. Shall we guys finish off that investment from associate working guys? Let's finish that one then. Right, working number B part of the question. Now guys, we said the investment is 145,000. PAR guys, PAR is basically this one. How much profit did we make from this associate for this year? So we made 32,400. Now guys, mark it over here. Okay, right. Minus impairment, there is no impairment. And guys, dividend received. Guys, can you remember when calculating income statement, we got a dividend received amount, right? How much was dividend received guys from associate? I remember it being 12,250. No guys, this one, right? The dividend received from associate. Take this and guys, deduct it, and we are done. 12,250. Right. Now guys, get the last answer. 145,000 plus 32,400 minus 2,100 minus 12,200. What's the answer guys? 163,050. Done. Right. So guys, then let's do one more question. Okay, one more income statement, and then I think we can conclude the class after that. Now guys, can all of you log into your my ACCA platform guys if possible? Okay. I'll tell you guys which paper to upload, I mean which paper to load, and then we can start. Remember guys, there was a paper this way. Just give me a minute. Let me quickly load that one. And then start. Can't remember which year it was. Oh, is it loading any of the past papers by any chance? Is it? And can't start.
All the steps are same.
Same, no? So that was same. No? Start loading. Waste time. We'll do a question on the exam kit video in that case. Okay. Right. What is the next question? Gold we finished now guys, last class. Right, guys, and let's do this question and see guys over here. Per corporation, right? We'll do one more income statement. I want to do guys one question, but the problem is that is not available on the, the site is not loading. So let's not waste time. Right, on the exam kit guys, we'll do then one more question for today. Right, go for this question guys. 437 per corporation. This is another question on what you can say guys, profit and loss account. Right, okay, let's quickly then have the structure ready guys in that case. Okay, right. So guys, then once again, then can you start like this, will you? Okay. Right. Okay. First, we'll put the heading, will right side. Put the heading, guys. Then what's the question number? 437. Question name. Okay. So guys, per corporation, right? Let's start doing that one. Right. So first thing guys, working number one, can you do the group structure and guys show it to me? Right. Get me the timeline and the group structure both. Okay. Get me the timeline and the group structure. So guys, these are the third income statement but we are practicing, right? Okay. Put the heading really, right? Working number one, group structure. Now guys, this question, it's starting on 1st of April 2007. Okay. And guys, this question will go all the way until 31st of March 2008. Okay. The question paper says, Perd Corporation acquired 80% of Sebastian on 1st of April 2006. That means guys, should we be worried about the number of months? No, this is a fully a subsidiary. Right? So guys, show it over there. P acquired 80% of S within brackets, fully a subsidiary. Okay. Right. And guys, below this write down, it's a 20% NCI. Now guys, we know what is the first question guys. They are asking profit and loss account and other comprehensive income, right? So let's then guys quickly then set up the format and show it over there then. So let's start writing P group. Okay, right. Consolidated. Profit and loss and other comprehensive income year ended 31st of March 2008. Then guys, let's start marking. First one guys, revenue. Copy parent plus subsidiary. Then guys, next one we have cost of sales. Parent plus subsidiary. Okay. Then guys, we have gross profit. Okay. Then operating expenses. 18,040 plus 7,130. Then guys, they have given profit from operations, right? Then guys, we have investment income. So guys, investment income, safe side, I would recommend you to keep a line. Don't know whether we have associates, no? Right. Then guys, finance cost, 3240 plus 1600. Then guys, we have profit before tax. Then taxation, copy parent plus subsidiary. Then guys, we have profit after tax or profit for the year. Right. Then guys, put the heading other comprehensive income. Leave one line. Total comprehensive income. Okay. Right. Then guys, after total comprehensive income, what do we have? Profit attributable to parent, NCI. Then guys, again total comprehensive income attributable to parent and NCI. Right. So first guys, we'll focus on the main requirement, which is doing the income statement. After that, we'll look at the other requirement, which is to do the which one? Asset section. Okay. Right. So below this, then write down guys, working number 2, NCI profit. Okay. So write the equation, subsidiary profit after tax minus impairment minus URP if S is seller and minus fair value depreciation. Okay, right. Now guys, once you have set up everything, first I'll give you a few set of adjustments for you to try on your own. Right. Can you guys try adjustment? Okay, first of all guys, now when I zoom out, problem is some students can't see it clearly. Right. Okay, can you guys do and show me this one and this one guys on the income statement, whatever that is needed to be done, just try and see. I'll give you around 5-10 minutes. Actually guys, first adjustment, second adjustment guys should not take you that long. Within 5 minutes you can finish it up. Okay, right. Just try those two and see guys first if possible. In the first adjustment from your side, what is the only thing guys that you should do? You should do what? Unwinding, no? You should do the unwinding, or you can minus and it even take the answer. That's true. Okay, right. Guys, second one you have to read very carefully. They have given you two numbers. Now I want you to focus. You're doing income statement for which year? Only mark that and show. Okay. Now they have guys given you two values because understand this paper has another requirement. Calculate the value of total assets. Right? So some of the numbers what they give is for that part. So think carefully and guys, I want you to do the question. Follow me guys, shall we discuss those two? Right now guys, what happened is this, right? Now there is a deferred consideration where guys you have to pay 8 million on 1st of April 2008. They have correctly calculated the answer for 31st of March 2007. Right now guys, tell me 8 million should be paid in April 2008. In 2007 guys, the answer is 7.547 million. Now if you are to unwind, okay, you should guys only unwind for how many years? If you have to unwind only for 1 year, which is basically guys this one minus this one. Okay, now it's like you have two options. One thing like how we always do in class, you can take this and put 6%. But understand guys, this is due in 1 year now. So when it's due in 1 year, it has to become how much million? 8 million after unwinding. So rather than putting the percentage, you can just check the difference as unwinding of discount, right? Check the difference guys between those two. 8 million minus 7,547,000. So guys, what's the difference between those three numbers? 453. The paper says we should go and mark it where they don't say where to mark. Right now, normally guys, unwinding, where do we go and mark guys? What expenses? Finance expenses. So guys, what you do, right? Please go to guys finance expenses. Right, and guys, can you add over there 453? If not guys, what you can do for 7547, check the percentage for 1 year. It will be an answer very similar to this. You can add it to finance expenses. Okay. Guys, now next part regarding impairment. Which impairment guys should we show in the income statement? The 400,000 or 300,000? There are two impairments now. One is for 2007, other one is for 2008. Which one guys we should show on the income statement? 2008 one. 2007 one guys, you know why they give? For you to do the total asset section. Okay, so therefore guys, we have to only focus on the 2008 one, right? Mark it guys for 2008 one, then how much? 300,000. We should mark it to where? Operating expenses at 300. Yeah. Okay, right. So guys, remember this is the only thing which you needed to mark on the paper. First paragraph, the unwinding of discount goes to finance cost. Second paragraph, two impairments, only the impairment related to 2008 should go inside the income statement. Are we guys all okay with this? Right, let's go for the next page guys then. Right, because adjustment number 3 is the difficult one. We'll leave it for the last video. Okay. Now guys, can you do and show me guys then these three? You can do it on your own. Fourth one, intra-group sale purchase URP. Fifth one, there's a revaluation. Sixth one, subsidiary paid dividends. So I explained you guys how to do when subsidiary paid dividends. You have to be careful at one point. Right, try those three and see, no? Third one don't do, third one I'll explain. First thing guys, what's happening there? Bird made a sale of 9 million to Sebastian. Parent is selling to subsidiary. So guys, first thing what you should do, remove this from revenue, and you should guys then remove this from cost of sale. Exactly. Now guys, you know always if it's a sale, we have to calculate URP. Guys, these people are paying 2 million now. The payment of 2 million guys will become relevant when you do the asset section. Okay, unless otherwise this one is guys not needed to be recorded. So that's given for the next part. Don't worry about that. Just calculate URP. So guys, URP is profit into inventory held. Sebastian holds 1/3, 1/3. How to get the profit? Profit equals selling price minus cost. What's our markup? 25%. That means selling price is 125, cost is 100. If we are selling for 9 million, that means 9 million is 125. Multiply by 25 and take. Okay, right. So therefore the answer will be 9 divided by 125 into 25. How much guys? Is it 1.8? Yeah, 1800. No? Take 1800 guys, that into 1/3. What will be the answer? 600. This 600 guys, what you do, add to cost of sale, but keep in mind parent is the one who sold, right? Adjustment number 5 guys, revaluation has not been recorded. Then guys, you know what you should do? Go to other comprehensive income, write there gain on revaluation. Okay, so guys, one person will become 4.1 million, the other person will become 0.7 million. Add together, the answer guys will become 4,800. That's why guys here it only says until profit, because the revaluation has not been recorded. That's why we made a new topic called other comprehensive income. Right guys, next one, make sure you didn't do that careless mistake what I said you. Now these people are paying a dividend of 1 million. Now guys, we should calculate the dividend only for how much? Subsidiary is paying 1 million. Can we get the entire 1 million? No, we should only see for 80%. Exactly. So therefore answer will guys will be 800,000. Both companies recorded. That means guys, Sebastian is paying, for him it's dividends paid. That's retained earnings which we don't have to worry about. For PERD, this will become dividends received. That means it's a part of investment income. Remove this one from investment income, 800. This is what you should do. So far all good, no guys? So this paper is very much approachable than the one that we did. Okay, now guys, this paper, this is the most difficult adjustment. Adjustment number 3. Right, now guys, let's have a look at this one then. Okay, let's start. Now guys, read carefully this part. On 1st of April 2006, Sebastian's property had a carrying amount of 11 million. But the fair value is 14 million. At this date, they had a remaining life of 15 years. Sebastian sold the property for 15 million on 31st of March 2007. Okay. Guys, first of all, can you quickly mark it on the paper or decide guys in your mind after how many years did they sell this one? They had the property in April 2006. They sold it in April 30th September 2007. After how many years guys did they sell? Like after how many years and how many months? So after how many years these people have sold? 1 year and 5 the 6th. 6, no, exactly. So guys, we have sold the property after 1.5 years. But mistakenly, Sebastian recorded historic cost of depreciation and historic cost on profit on disposal. In simple words, he did the accounting for 11 million rupees. What and what accounting? The depreciation and the historic cost on profit. He should have guys actually calculated it for 14 million. That's the problem in this paper. Understood? 11 million property whose fair value is 14 million. He did the accounting for 11 million without doing it for 14 million. And the wrong answers he went and recorded. So now we have to do two things. First, we should see the wrong answer and remove it from the accounts, and then we should see the correct answer and mark it and show. So where has he guys gone and marked it? He has gone and marked it inside operating expenses. Right, guys, first we will do the wrong one. Then slowly we'll do the correct one after that. Okay, right. Now guys, first of all, it's a disposal. So it's two things, historic profit on disposal and depreciation. Right, first of all guys, can you have like a small depreciation disposal account ready? Right, we'll start. First have a small disposal account ready. Okay. So guys, now listen, first of all I'm going to do the wrong thing. First of all I'm going to do the wrong one and show. Okay, guys, now normally when you do a disposal, guys, what is first step? We should mark what and show? The cost. So you take this as the cost value, carrying amount. So we are doing the wrong one. So wrong one is where he did it on historic. Historic means on 11 million, right? First mark guys over here, cost is 11 million. Done. What is step 2 guys of disposal? Sales proceeds, step number 3. But before the sales proceeds guys, what we should mark guys? Before cash, exactly, we should mark the depreciation. Right now guys, then start marking step number 2, provision for depreciation. Guys, now listen, you should now calculate the depreciation for 11 million because he did it on 11 million. Now for how many years guys, now we have to calculate the provision and take? We decided that now for how many years we have to calculate. Provision means normally guys, what depreciation? The total, no? Right, it's previous, so the total. So for how many years we have to calculate and take the provision now guys? 1.5 years, exactly. Start calculating guys now provision for 1.5 years. For 11 million, calculate for 11 million for 1.5 years. So guys, how to get the provision? First take the cost or carrying amount as 11 million. What's the remaining useful life guys? 15, and we should check the provision for 1.5 years. Right, so just check and see guys, sometimes the answer might come in decimals. Yeah, answer is coming in decimal. No, properly, no, 1100. Okay. Now guys, step number 3 for how much we sold, cash. So guys, for how much we sold this? 15 million. Now guys, can you mark 15 million? Right, close the account and guys get me what is the profit that he got guys over there. Now close the account, check and see what is the profit that he got. How much guys? 5,100. Correct, no? The profit is 5,100. Okay, now guys, we got one wrong answer. What they did, they took the historic value of 11 million and did the disposal accounting according to that. So their profit is 5.1. I'll tell you guys what to do with this. Just keep it. Guys, not only they did historic profit on disposal, they also did historic but depreciation for this year. Guys, now think carefully and tell me that historic depreciation for how long have they calculated? That means now income statement guys, we are doing for this year now. Depreciation is for the income statement. Tell me guys, historic depreciation for how long have they done? Like is it for 1 year, 1.5 years, or tell me guys how long have they done the historic depreciation for? Mistakenly, remember guys, they sold the property on 30th of April 2007. Now think and see guys again. the historic depreciation they have done for how long? I mean, yes, they have done it for 1.5 years, right? But when you are doing the income statement, we have to only be worried about last 6 months. Exactly. We should guys only be worried about 6 months. Guys, understand, for 1.5 years they have done the historic depreciation. No, depreciation means what we mark for the current year account. So guys, for the current year account, only that half a year depreciation only will become relevant. 6 month depreciation they have incorrectly record, because guys, if they sell on 30th and if our question starts on April, 6 month depreciation, guys, these people have done it on the historic rate. Right now, guys, then can you calculate and show me, guys, depreciation for 6 months, please? Right. Now calculate and show me, guys, depreciation for 6 months. Right. So, guys, depreciation for 6 months, guys, will be how much then? 11,000 is the value, divide by 15 years, and that into, guys, 6/12. Okay, right. So, guys, I think answer will come in decimals. Yeah, no, 1100 divided by 15, that divided by 2 again. Is it, guys, 367? Yeah, 367 is the answer. Now, guys, remember, these are the wrong answers. Now we should remove from the books. Now, guys, listen carefully what happened. This answer and this answer, the profit and the depreciation, these people, guys, have marked it in operating expenses. Okay, now, guys, think carefully and tell. No need to rush. Depreciation, they have marked in operating expenses. What should I, guys, do from operating expenses? Then should I add or should I subtract, guys? The depreciation, what should I do? We should add, exactly, because normally when calculating operating expenses they put it as an expense. No, so first thing what should we should do, very good Hazik, right? The depreciation, guys, we should add back. Can you guys now add back 367? Okay. Oh, no, wait, guys, wait. I think I'm making a mistake. Now see, depreciation, guys, is an operating expense. Now we are not calculating profit now. Now depreciation 367, guys, they have put it as an operating expense. That's wrong. No, so what we should do, we have to remove, exactly, guys. 367 we should remove, because, guys, understand, we are not charging depreciation, we are trying to remove the incorrect one. My bad. Okay, we are trying to remove the incorrect one. Okay, so it has to be minus 367. But that profit on disposal is there. No, guys, that one you should add back 5100. Why we are adding back the profit, I'll explain. Guys, listen, if there is the profit in operating expenses, when we put, what happens to expenses? Expenses will go up or go down. Profit, they have taken it to expenses, that means expenses will go down. But now to correct it, what we should do? Reverse. That's why we are increasing. Now, guys, what we did was we corrected his mistake. Disposal we did for 11 million, depreciation we did for 11 million, he put it in operating expenses. Now we have corrected. But now, guys, again you should do both the calculations now one more time, using how much now? 14 million rupees, because 14 million is the correct answer. Now, guys, like how I did this, can you guys prepare disposal account, but this time the carrying value is how much? 14 million. I want you guys to again calculate depreciation also. This time I want you guys to calculate for how much? 14 million. Mark those two and show inside operating expenses. Right now, guys, can you try this part then? Guys, do the same thing but for 14 million. And once you do for 14 million, guys, I want you to mark it and show inside operating expenses one more time. Okay. Right. Just can little bit check and see, guys, your answer for 14 million, whether you got it correct. First, prepare the disposal account. Cost is 14. Provision, guys, will be 14 million divided by how many years, guys? 15, and that into 1.5. Same thing, but now do it for 14 million. 14 divided by 15 into 1.5. Then, guys, 1400. And, guys, we sold it for cash. How much, guys? We sold it for 15 million, no? Okay, right. So therefore, guys, what will happen? 16,400, 16,400. Now, guys, profit on disposal, guys, was it 2,400? Correct. No, profit on disposal is 2,400. Now, guys, calculate depreciation for 6 months. Take 14 million, divide by 15 years into 6/12. Right. Check and see, guys, what will be the answer then? 14,000 divided by 15 into 6 and divided by 12. What's the answer, guys? Is it 467 at that point? Depreciation. Right. Now, guys, remember these are the correct answers. Now the correct answers must be taken to the consolidated P&L. Right. Now, guys, start taking this one. Right. Go to operating expenses. Guys, now we are marking it properly, no? So depreciation is now an expense. Add 467, guys, to this one. And profit on disposal will reduce our operating expenses. How much, guys? That's 2,400. No? Yes. Right. That's it, guys. Question is over. Can you guys now quickly start getting me the profit for the year, guys? Quickly. That's it. All the adjustments are completed. Okay. Right. Now, guys, let's start then marking the answers and let's finish it off, guys. Okay. First of all, can you get the revenue? 58,200 plus 34,300 minus 9,000. 83,500. Cost of sale, guys, get your answer then. 34,340 plus 20,400 minus 9,000 plus 600. 46,340. No? And, guys, gross profit 37,160. Get the operating expenses, guys. Operating expense how much, guys? 28,270. Yeah. Profit from operations 8890. Investment income 2200. Finance cost 3240 plus 1600 plus 453 5293. $8890 plus 2200 minus 5293 5797. Okay. Profit 1560 plus 143040 minus 5797 2757. Let's check and see, guys, is that answer correct? Yeah, correct. Then, guys, other comprehensive income 4800. If you add that one, 7557. Okay. Right. Now, guys, once again, you're going to learn something a little bit new, guys, over here. Let's check and see what's happening. In CI profit, first thing, guys, we need subsidiaries profit after tax, right? Can you guys first of all copy subsidiaries profit after tax, guys, from the question paper? From the question paper, subsidiaries profit after tax. Okay. So, guys, what's going to be the answer, guys? 3690. Okay, first copy this. Guys, now like last time, can you remember? First of all, anything to do with number of months should be worried about. Unlike now, can you remember, guys, last question from the 36 from the profit, I removed the interest because it was already for 9 months. Like that, guys, tell me this question 3690. Should I be worried about anything for number of months? No. But guys, tell me subsidiaries profit after tax. Is this answer correct, or was there any kind of error when they calculated this answer? Yes. The third adjustment, guys, what we did, they made a mistake, no? Right? So that mistake, guys, now we have to correct it and show. Understood, guys? So what happened here? When they are getting 3690, they made a mistake because adjustment number 3, without doing the disposal and depreciation for 11 million, without doing it for 14 million, they did it for 11 million. So that mistake, we have to now correct it and show. Right? I'll make it easier for you. Right? Now, guys, tell me like this, feel it. Right? Now go to operating expenses. The wrong depreciation was 367. So you remove that. Correct depreciation was 467. That means, guys, what is the gap between those two numbers? 100. So 100, did we put extra for depreciation or did we reduce depreciation? Check carefully and see, guys. Reduce means you're telling that reduce from the profit, is it? Yeah, that's correct. That's correct. Yeah. So, guys, see, I removed 367 and I added 467 means I am adding 100,000 depreciation extra. So, guys, if I add 100,000 depreciation extra to correct this profit, guys, what should I do? I have to minus 100,000. That's one mistake that these people made. Right. Guys, second mistake, profit on disposal. I added to 5,100 for expenses. I removed 2,400. What's the gap between these two numbers, guys? 2,700, guys. I added to expenses to make my profit. That means from my profit, what should I do? We should add those subtract, guys. What's going to happen? We have to know. What happened was 5,100 we added to operating expense and we removed 2,400. So technically, guys, we have added 2,700 to our expenses. That means profit will go down again. Exactly. Profit should go down by 2,400. Okay, right. Now, guys, can you get the adjusted profit, guys, in that case? Because, guys, remember, subsidiary made a mistake in his financial statement. So we have to correct that mistake when calculating in CI profit. Sorry, 2,700. Correct. 2,700 we added to expenses. That means, guys, our operating profit will fall. 3690 minus 2,700 minus 100. Okay. So, guys, I am getting then 890. No, subsidiaries corrected profit. Guys, impairment. we had an impairment, no guys, for this year, right? So how much was that, guys? I remember 300,000. Yeah, 300,000 impairment. URP, guys, was it there? Let's see, guys, who sold to whom in that paper. Yeah, parent no sold, so that won't come over there. Okay, right. Now, guys, fair value depreciation. Did we have any fair value depreciation? No, we did not have that. Okay, now, guys, can you get the adjusted profit, guys, in that case? So it will become how much? 590. But, guys, remember, do we have total comprehensive income, any OCI for in subsidiary? Right, adjusted profit is 590. Now, guys, we have to see, do we have any OCI? Yes, no. Can you guys remember these people revalued, but they forgot to take it into account? Then subsidiary 700 must be taken. Exactly. Take that one, guys, down. Right. OCI, that is 700. Then, guys, adjusted TCI 1290. Right now, guys, for these two, the profit and the TCI, guys, now put the NCI percentage for me. Okay, so guys, NCI percentage is 20%. No, guys, in this question. Okay, so guys, 20% of this guy's answer will be how much? 118. 20% of this one, guys, check and see what will be the answer then. 258. Now, guys, last part of the income statement. Please take these two answers and now, guys, copy it here on the main page. Adjusted profit for NCI is 118. Adjusted TCI for NCI is 258. Okay. Now, guys, what you do, income statement profit, take that. Income statement TCI, take that. Copy that down. And now, guys, what you do, find the parent share. That's it. Okay. All okay, no, guys, right? So I think with that, then we can conclude today's class, guys. We did quite a good amount of questions. So again, guys, I'll see you next Sunday. Same time, next Sunday, guys, we'll focus on doing individual. Right. Now, guys, today I'll be teaching you something very important, right? Now, you may already be aware of this, that there is a small change in a particular standard, right? So earlier we used to have a standard called IAS 1, presentation of financial statements. Basically, guys, the formats, income statement format, SOFP format, that. So now IAS 1, what has happened? It has got replaced with another standard called IFRS 18. Right, so a lot of students had asked me, right, now what are the key changes that's going to happen? Right now, yes, there is a change, but these are very minor changes is what we are looking at. So today I'm going to teach you what's the difference between IAS and IFRS 18, right, and how it will affect our question, how it will affect our particular exam is what we are going to look at today for the first half an hour. So once I teach you IFRS 18, today, guys, I'm going to practice 2 past papers using the new standard, IFRS 18 itself. Right, because in your exam, if a question comes, it will come from the new standard. Right, so today our focus will be only on single entity financial statements. Right, one company where we'll be discussing the formats plus the standards. Right, next week we'll be putting our focus into consolidated ratios because last week we were purely focusing on consolidation. Then next week we'll keep it for consolidated ratio. Then properly we would have done everything. Right, now, guys, in your writing book, I'll give you all the key changes. Right, okay. Can you guys take a heading over there as, right, IFRS 18. Okay, so first I'll discuss a little bit of theory and then, guys, what I will do, I'll quickly, or wait till you guys, without writing IFRS 18, I can just share this technical article with you right? And I think that should be good to go, right? Only try the notes. Wait till guys, I'll share a small technical article with you all. Okay. So I'm sharing this to the WhatsApp group. Okay. Right. Okay. Now guys, remember to your WhatsApp group, I shared a small article that's directly from the ACCA website that is written by a FR examiner. Okay. So whatever that I'm going to explain to you all now, guys, will always be mentioned in that particular note, right? Whatever that I'm explaining is over there. Okay. So, right. Now, guys, point number one, the earliest standard what we need to focus is called IAS 1. Okay. So IAS 1, guys, what is the standard name? Standard name is basically presentation of financial statements, right? This will be the standard name, right? This standard, right, from this year, okay? So when was this standard actually guys introduced? This standard was introduced in April 2024, right? So this standard got replaced with something called IFRS 18. Standard name again, presentation and disclosure of financial statements. Okay, so this is the new standard name. Now guys, in the real world, this will be applied in 2027 January onwards, right? Real world companies should implement this from January 2027. But for ACCA exams, this particular standard guys will be tested from September 2025 exams. From this session onwards, this is the new standard that we will be talking about when it comes to the formats. Now guys, I shared you an article now. In that article guys, they have clearly said there will not be any significant changes to FR exams. Right? Now when you go through, right, once I'm done explaining, please read it through one more time on your own. In that case, there's a paragraph that says IFRS 18 is not significantly impacted to what you can say guys, our FR exams. Now even guys, when I have a look at 2025-26 Kaplan version, right, the answer script also, not much changes have taken place when it comes to the format. There is a big change to the format, but even in the marking scheme, they're not doing much changes. So remember guys, it's not something big that you need to change, just a few minor changes only you have to get used to. Okay, so that's the new stand, IFRS 18. Right, now guys, remember when it comes to financial statements, we have 5 sets of financial statements. One is called statement of profit and loss and other comprehensive income. SOFP, SOCE, cash flow, okay, plus notes to financial statements. Now guys, these are the 5 elements of financial statements. Under IFRS 18, notes to financial statements, there are no changes at all. Statement of financial position, no changes at all. Statement of changes in equity, no changes at all. In statement of cash flow, yes, there is a small change which I will discuss with you all at the end of today's class. Because normally guys, cash flow is not something that we get as a major question in our exam. No, a very minor question will come. Sometimes question will not come at all. There's a small change. You will quickly understand what's happening there. The biggest change happened guys over here in the statement of P&L. This is where now you need to learn. Now guys, remember under IFRS 18, we don't call it statement of profit and loss and other comprehensive income anymore. Right? Under IFRS 18, this is called guys the statement of financial performance. This is the new name of the profit and loss account. But still, in our ACCA exams, they will still be using what word for this session? Statement of profit and loss. Right? Now, going forward, the new name will be what, guys? Statement of financial performance. Because anyway, guys, income statement shows the performance of the business, no? So we call it statement of financial performance. But in that article, they have not mentioned that name. They are always using what name? Statement of profit and loss and other comprehensive income. So for our exam also, that word only they'll be using. Statement of profit and loss. But going forward, maybe next year, or maybe guys, when you all move to SBR level, it will be called statement of what, guys? Financial performance. Right. Now, guys, what are the key changes that you need to learn as a student when you do the FR exams? It's like this. Small changes. Right. Number one, under IAS 1, this is what we guys studied earlier. We have revenue. Then we have cost of sales. Right. Then what do we have, guys, after cost of sales? Gross profit. Then we have distribution expenses, administration expenses. Then we have operating profit. After operating profit, guys, what did we do? We added investment income. Then we subtracted finance cost. Then the answer what we got is called, guys, profit before taxation. Then we have taxation. After that, guys, we have profit. Yeah, for the year, or maybe profit after tax. 1 minute, let me delete that. Then we have profit after tax, and then guys, we have other comprehensive income, right? Okay. Now guys, remember, now when it comes to guys, this standard over here, right? IFRS 18, again, minor changes only taking place. Okay. Number one, guys, we have to have something called, right? Revenue. That's normal, no? Right? We need to have revenue. Right. After revenue, guys, we need to have, once again, cost of sales. After cost of sale, guys, we used to have, we have over here also gross profit. Now, after gross profit, guys, a new topic is going to come in called other operating income. Okay. So, other operating income, guys, is basically the normal, what you can say, income and expense, income that you have studied for advanced level. Right now, guys, normally for advanced level, what are the other operating income that you might have studied? You might have studied commission receipt, discount receipt, profits on disposal. So all the other incomes that we get from trading activities, we still go and mark it inside other operating income, just like our advanced level. Right. After that one, guys, we have something called operating cost. Okay. Now, under operating costs, guys, if you are going to ask me, what are we going to record? Again, guys, basically operating expenses means, guys, normally what and what expenses together, normally we take operating expenses means administration and distribution expenses. Here also, guys, what's going to happen? We are still going to have inside this administration plus distribution expenses only. All okay, but remember, guys, now when you take the old format, what's going to happen? You're separately showing administration distribution. No? Under the new format, guys, you have to put operating cost and write everything inside that. Okay, so that's change number one that you have to know. So this is one of the major topics that have come over there for IFRS 18. After that one, guys, after operating cost, you are then going to get something called operating profit. Okay. So guys, operating profit means what? Take the gross profit, add your operating income, subtract your operating cost. Then that answer what you have, guys, over here is what we call operating profit. Right? So this is change number one. So guys, I introduced two new things. What is the first one, guys? Anyway, guys, don't worry. I will send you all the format, right? I have a format. I'll send it to the group so you all can check on that. So remember, guys, change number one, we have something called operating income. What is operating income, guys? The incomes that we get from normal trading activities. Okay. Right. Then, guys, we have a new topic called what, guys? Other operating cost. Operating cost is basically what, guys? All our administration and distribution expenses. Right. Then, guys, the next topic that you need to know is something called, right, income and expenses from investing activity. So this is like cash flow statement. Okay, now cash flow statement, guys, we have investing activity now. So like that, you are going to have a new topic called income and expenses from investing activity. Okay, right now, guys, inside this, what you are going to have all incomes and expenses related to investment activity. Now, for an example, let me list out a few and give for you. Right, number one, guys, when you do consolidation, can you remember, guys, there is something called associates. Right. So when you do consolidation, below this one, guys, one thing that you are going to get is called profit share of associates. All okay? You're going to get that. That's only for consolidation. Okay, now guys, think of it like the cash flow statement. Will you right? Now, guys, can you list out for me in cash flow statement, guys, what comes normally under investing activity? Purchase of non-current asset. But once again, guys, purchase or sale of non-current asset, guys, what's going to happen? It's not an income or expense, no. So it will not come under profit and loss account. But guys, I want you to understand a small thing. Now, when you take non-current assets, guys, we have two types of non-current assets in accounting. One is called PPE. Other one is called investment property. Right. So guys, remember, yes, under investing activity, one of the main components are purchase of PPE and sale of PPE. Okay, so PPE, guys, we can break it to two parts. One is PPE, the other one is investment property. Guys, remember, anything related to PPE. When I say anything related to PPE, repairs, depreciation, profits on disposals, loss on disposal, all those PPE items will come inside operating cost and operating income. That means when you sell PPE, there is a profit, no? That is other operating income. There's a depreciation, impairment losses, then things like what you can say, guys, over there, what I said, loss on disposal, those things will come under operating cost. So what I want you to understand by now, all costs related to PPE, that will come inside which one, guys? Other operating expenses and income. Good things and bad things related to PPE, guys, will go inside that. Then, guys, things related to investment property. Now, guys, you have studied now IAS 40. We have investment property. Now, guys, in investment property, if you use fair value model, old syllabus, right? Now, if you use fair value model, any increase, where do you record earlier syllabus? Profit and loss account inside other income. Nowadays, guys, we don't have something called other income now under IFRS 18. So that means increasing fair value, you're going to write inside this and show income and expenses from investing activity. Okay. Earlier, when fair value increases, guys, I thought you should mark in P&L inside other income. No. Under IFRS 18, guys, we don't have anything called, guys, what you can say, other income. We don't have that. So because we don't have other income inside IFRS 18, you should mark it inside income and expenses from where? Investing activity. Same way, guys, sometimes when fair value drops, okay, when fair value of investment property is dropping, old syllabus where I ask you to go and mark in P&L inside where, guys? Expenses. But now under new syllabus IFRS 18, you all should mark it, guys, inside this investing activity. Any gain or losses on fair value on investment property, you should mark it here. Right. Then, guys, I'll list out some more few things, right? Interest received, right? And normally, guys, in cash flow statement, interest received and dividends received, guys, we normally mark it inside which activity, right? Okay. Cash flow statement, guys, we normally mark it inside which activity? Investing activity, no? Here also, guys, what you should do, interest received, dividends received, you should mark it inside investing activity. Because, guys, these we normally get from investments, no? Right? So you have to mark it inside investing activity and show. Right. So once again, guys, let me recap whatever I have explained so far. A new topic called investing activity is going to come now inside your income statement. Right? Investing activity means what? Income and expenses from investing activity. So inside this, what are you going to record? When it comes to consolidation, guys, you are going to record what and show? Share of profit from associates. Okay. What are the other things that can come inside this topic? Increase or decrease in fair value of investment property. Interest received, dividends received, and also, guys, I forgot to mention one more thing. Can you guys remember we studied a lesson called financial instruments? Right. In financial instrument, guys, we studied how many topics, guys, over here? We studied 4 instruments. What are the 4 instruments we looked at? First one, guys, we looked at financial liability. After that one, guys, we looked at compound instruments. Compound instrument means what, guys? Convertible loans. We looked at that. Then we looked at financial assets. Then, guys, we also looked at financial assets, investments in equity. But is other one, guys? Financial assets, investments in debt. Right. Now, guys, can you remember in financial asset equity, there used to be 2 kind of position. What and what position, guys? One is default position, other one is alternate position. Now, guys, tell me default position, forget the new syllabus. Default position, old syllabus, where we used to go and take the changes, issue cost and changes. Where do we mark for old syllabus? Inside OCI or PNL? PNL. In new syllabus, in PNL, you all should mark it here under investing activity. Are you okay with that part? Then under financial assets, investment in debt, there also, guys, there are some instruments where you take it inside PNL. No? Those PNL also you have to take it inside where? Investing activity. So, guys, if I am to put it simply, it's like this. When you make an investment, any income and expenses that you are getting from investments should go inside this topic. It's as simple as that. Okay. Any investment income. So any investment income, once again, guys, let me lay it down. Profit share of associates, interest received, dividends received, IAS 40 investment property related stuff, financial instruments, financial assets, investments in equity, financial assets, investments in debt, the P&L related items, everything should go inside this one under investing activity. So basically from investment, any income and expenses you are going to get, guys, you are going to mark it inside this particular topic can show. This is what this topic is open for. And also, guys, I forgot to explain why they have made so many changes. Why now so many topics? Actually, guys, under IFRS 18 new P&L, 5 new topics they have introduced. One is operating cost, other one is investment cost, right? Then we have taxation, right? And then we have non-current assets held for sale. Like that, they have introduced 5 topics. Why these people have introduced so many topics is simply because, guys, this is the reason. They introduce these topics because when a person looks at the financial statements, he will now have a better understanding. Now, earlier what we did, any income we put inside other income, right? All expenses we used to categorize inside 3. The reason why the standard change, the reason why there are so many topics is because when a person looks at the financial statements, he wants to have a better understanding from where did this income come? Is it from investment? Is it from operating? Right? So to have a better breakdown of expenses, to have a better understanding on financial statements is only, guys, why this new standard was introduced. Guys, listen, in the new standard, how many topics came newly? 5. What are the 5? Operating cost, this one. Okay. Investment activity, income and expenses. Finance cost, to be very honest, guys, finance cost, nothing much is changing. Earlier finance cost, what did you take? Interest, unwinding of discount, basically the same thing. To be very honest, guys, this is the only new topic that you have to get used to. Right? Now tell me, guys, operating cost, you anyway know we are marking what and what? Administration, distribution, no? Same thing. Right? So then, new topic, what you should get used to is this one, investment activity. Then, guys, third new topic is what, guys? Financing activity. Financing activity, to be very honest, there are no changes at all. Earlier, what you used to take only, you're going to take now. Interest, unwinding of discount, financial liabilities, all of that. Then, guys, fourth topic is what? Taxation. Guys, tell me in the whole syllabus taxation, what are things that you normally took? 2 types of taxes. What and what tax? Current tax and deferred tax. Same thing only you're going to take over here. No changes at all. Understood? Right. And then, guys, last topic is what? Number 5, discontinued operations. Guys, tell me discontinued operation. Are you showing it on the main face of financial statements? No. What you will do? Separately, you will prepare. That one's final answer you will show inside the profit after tax. Correct or wrong? Here also you are going to do the exact same thing. That's why I said you, though the standard changed, not much has changed. What is simply happening? A new topic called investment activity is happening. So it's not much for you to get changed or for you all to get used to. All okay. Right. But guys, listen. There are 3 compulsory answers that you must show in your exam. Okay. Did you know, guys, after the standard change, showing gross profit is not compulsory, right? But the examiner, in that article what I shared to the group, they are telling showing that is better, but it's not compulsory. So my recommendation, let's not change what we have been doing. Let's do it in the normal way. But remember, guys, in the new IFRS 18 P&L, there are 3 important topics that a student must show. What are the 3 important topics? First one, guys, we have something called operating profit. Guys, what is operating profit here? Revenue minus cost of sale is gross profit plus operating income minus operating expenses. Then, guys, that's another important topic that you have to show, what is called, guys, profit before finance cost and income tax. Okay, profit before finance cost and income tax. What is that? Listen, guys, you have your operating profit now. After that, what activity you have? Investing activity. Once you combine those two together, that is what we call profit before finance cost and income tax. Then, guys, after that one, what you are going to do? Profit before finance cost and income tax. After that one, guys, you are going to show profit before tax. What is profit before tax? From this answer, you're subtracting what cost? Finance cost. That is what we call profit before tax. So these are the 3 important topics that you must compulsorily show in the exam. If you don't show these, you're not going to get full marks. Are you guys okay with that one? Right? You're not going to show full marks. So that's a few changes what you should know. And guys, last and most, and also guys, remember, after IFRS 18 change, 2 major changes came. One is the income statement format change. And there is something called, guys, management performances. Right? In the article, it's mentioned. Remember, guys, management performances is not for you all. That's for SBR level. Right? In that article, they have specifically mentioned not tested for FR. So you as an FR student, for IFRS 18, what you should know, only the new format. That's pretty much it. 5 major topics. But for you as a student, what's the new topic? Only this investment activity, income and expenses, only what you all should know. Are we guys all okay with that part right now? Guys, last thing, there is one more thing. In this standard, guys, they have introduced, after the 5 topics, in between the 5 topics, guys, they have introduced something called aggregation and disaggregation. Okay, something like very different. Aggregation, disaggregation. Now, what is this aggregation, disaggregation? It's like this, guys. Aggregation means there are some expenses which are very similar to each other. If I am to put it in simple words, these are not one-off items. These are not special items. Let me give a few examples. Rent, salaries, electricity, insurance, advertising, marketing, selling expenses. Are these guys one-off expenses? No, these are things that happen in every single year, right? It's like very common to business. So those expenses which are common to business, standard says you can aggregate them. What is the meaning of aggregate them? Now see, rent, insurance, salaries, electricity. These are, guys, actually what kind of expenses when you take this income statement? Administration. Administration means under new syllabus, we call it what cost? Operating cost. So listen, guys, very carefully, small thing. What is the meaning of aggregation? Aggregation means that rent, electricity, salary is there. No, don't need to show it one by one. You can add everything together and show it as, below this you can write administration and general expenses, or you can write it other operating cost. You don't need to name it one by one. You can just add everything together and show it as other operating cost, because they are very similar to each other. It happens in every business. It's not something very special. So you can aggregate them and show it as one line, the total. No need to show separately. Rent, electricity, like that, no need to show. Just you can add them and show. Disaggregation means, guys, remember, there are some expenses which are one-off. Those don't happen every year. Let me give you some examples. Number 1, impairment loss. Impairment loss is not going to happen every year, no, guys. It happens in some years, doesn't happen in other years. Research and development. We don't do research and development every year, no. In some particular years only we do. So certain types of costs which are one-off, certain types of costs which don't happen every single year, you need to disaggregate. What is the meaning of disaggregate? In simple words, separately you have to write that and show. Okay. Now, guys, rent, insurance, electricity, do we have to write separately? No. Add everything and show it as what? Other operating cost. Research and development impairment, those standard says we have to disaggregate. Disaggregate means what, guys? You have to show it separately in your income statement. But guys, don't worry. In the FR exams, that article specifically said, if your examiner wants something to be disaggregated, that means if your examiner wants you to show an expense separately, they will mention it and show it to you, it seems. Right? Now, I said no, there are some expenses which we disaggregate. You don't have to worry. In your FR exam, anything to be disaggregated. Disaggregated means simply what, guys? Show separately. Right? Anything to be shown separately, paper will mention. So you just read the paper carefully and mention it separately. Simple as that. And also, guys, listen, in that article, another one thing what they have mentioned is that for students, you don't need to memorize the format and go. They will tell you where to go and mark. Now, guys, previously we did a lot of past papers, no? Okay, depreciation. Did we have to memorize? No, they will tell no where to go and mark. Then if they tell depreciation is supposed to go to cost of sale, you should mark it inside cost of sale. There is no argument. Impairment loss, guys, did we memorize? No, the paper always said where to go and mark administration expenses. Like that, guys, though the syllabus changed under IFRS 18, in that article they have said in the FR exam, like earlier, they will still tell you where to go and mark. Right? If it's to be marked inside operating cost, they will tell you. If it's to be marked inside cost of sale, they will tell you. If it's to be marked inside investment activity, they will tell you, it seems. So this session for September exams, it's not much where you need to get changed. Only one new topic is going to get introduced called investment income, but don't worry, guys, everything they will mention it to you over there. Okay, now you must be thinking, okay, now if these are changing, what's going to happen to our ratios? Don't worry, I will tell you, to be very honest, nothing much is changing in accounting ratios. Understood? Because now if income statement format change, then the ratio also will get affected, no? But don't worry, nothing much is changing. That I will explain to you next week. How to do. I actually thought let's do it today, but then it will be too much. So I'll tell you one thing, don't worry about ratios, it's going to remain the same. No changes. Only cash flow statement, there is going to be a small change, which I will explain to you at the end of today's class. Right, now guys, let's quickly recap whatever that we had said so far. IFRS 18. Right, number one, IFRS 18 is replacing whom, guys? IAS 1. This will be tested in September exams. But though it's tested in September exams, the article says not much changes will happen, not much significant changes. So under IFRS 18, guys, we have for profit and loss account 5 topics. Operating cost, what do we mark inside that, guys? Administration, distribution, expenses. Then we have a topic called operating income. What do we mark inside operating income? Trading income, right? And normally, guys, when you sell, you get discount received, okay, commission received, profits on disposals. Those trading incomes is what we mark inside operating income. Then a new topic called investment activities coming. All income and expenses related to investment, you should mark it inside that. Example, profit share of associate, dividends received, interest received, financial assets, changes like issue cost, increasing fair value, decreasing fair value, investment property changes, fair value model, financial assets, investments in debt changes to P&L is what we mark. So in simple words, anything to do with the investment should come inside that. Then the third topic, finance cost. Is there any change? Not really. Whatever that you used to mark early on, you are going to mark it now also. Right? Interest, unwinding, all of those. Then we have a topic, guys, over there called taxation. Taxation, what will come? Deferred tax and current tax. And discontinued operation, you do it separately, show the last answer. So like I said, guys, as a student, you only need to know this particular activity only. Right, Rishma, you had asked me a question. Profit and loss on disposal on PPE will still come under operating cost. Profits or losses on investment property will come inside investment activity. So inside investment activity, you're only taking investment property related stuff. Property, plant and equipment stuff, still we should take it inside operating cost. But if your paper says inside cost of sale, then you should take it inside cost of sale. And also, guys, remember in the exam, they will mention to you, like in the previous papers, where to go and mark the expenses. So it's not much you as a student should get worried about. They will tell you where to go and mark. So guys, my advice, I shared an article. No, please read that article one more time. Whatever I mentioned only, it's coming over there. On top of that one, guys, you don't worry. I'm now also sharing you a photo of what you can say, guys. Your income statement new format, I'm also sharing a photo. This photo also, guys, is from the article itself, right? I'll share to the group, right? Okay. Okay. Guys, I'm sharing you the updated format of the income statement. Okay. This is the new format. Yeah? And guys, also remember one more small thing. Today in class, I'm going to do 2 past papers using the new format. Then you all will get more confident with this part. And guys, I'll tell you a small thing. Usually what ACCA exam, this is what they do. When they introduce a change, that change they will most likely test. Okay, so I would recommend you to be thorough with the format because this is something that changed this year now. Very likely to be tested in your exams. Okay, so make sure guys you go through the format. Okay. And also guys, remember now IFRS 18, now the new change I have explained to you all completely, right? But guys, remember from my end, still 2 things should be covered: conceptual framework measurement and sustainability standard. I haven't covered that, which I will do. Okay, don't worry, I will definitely cover everything and only let you all do the exam. Okay, guys, now can you all guys take the exam kit quickly? Right, we'll practice a question and see on the new format. Right. On the exam kit, guys, could you all please go to question number, we'll do profit and loss account. Okay. Guys, can you all go to guys this question? I think Gibletto or Gilberto, there's some question like that. Can you search for that one, guys? Yeah. Guys, in the 2024-25 version, that's the last one. All right, okay. Krishma, can you drop me WhatsApp? Do you have my number? Can you drop me WhatsApp message? I'll share that article with you with that photo. Okay. So guys, listen, again, I'm telling you what's the only new topic? Investment activity. Understood, guys? All the others are same. Right. Now, guys, those who have the exam kit and also you all guys, now I explained, no, if you all have any doubts, you tell me. Online students also, guys, please ask for any doubts that you have on the new standard, mainly the changes. Okay, now we are going to do 2 questions on the new standard, but if you have doubts, you should ask me, then I will clarify. Right, can you guys please put the subheading for me? Right, question number 430. Right. Question number 430. Right. Shall we guys now see? Now look at the requirement, guys. Requirement: prepare profit and loss account, statement of changes in equity, and also guys, they are asking you to calculate or restate the EPS. So what is the question number, guys? We did this question then. Gipleto. Is it? Markup margin, this one. We did the 430. Okay, if that's the case, then we can go for this question. Right, there's another question, guys. Just can a little bit check and let me know. This one, did we do? Print corporation, did we do, guys? No, but that one we finished, no? Okay. Okay. So if that's the case, guys, then we'll go for this question then. Right? Can you guys then put the heading 428 print corporation? Right? Let's do that one, guys, then over there. 428. Right. Print corporation. Okay. Now, guys, listen. In this question, guys, when you look at the requirement, prepare statement of profit and loss, and also guys statement of financial position. Now guys, hereafter profit and loss means don't draw the old format in the exam, you should draw the new one. Okay, right. Shall we guys now quickly now can you guys start copying the format what I'm putting on the screen? Put the heading then. Print corporation. Okay, statement of profit and loss. I'm not sure guys whether these people are going to have other comprehensive income. Doesn't look like they are going to have other comprehensive income. Statement of profit and loss for the year ended. So guys, remember what's the new name? Statement of financial performance, right? That's the new name of profit and loss account, but they won't be using that term in the exam. They'll be using the old word only. Okay, like statement of profit or loss for the year 30th of June 2002. Okay. Okay. Right. So guys, as usual, please put the heading guys over there, revenue. Okay. Right. Then guys, we have after that one, cost of sales. Then we have gross profit. So guys, hereafter gross profit is not compulsory, but I would still recommend you to do the gross profit part because for ratios and all, we may need this, right? Gross profit. Right. After gross profit, guys, put the next topic, other operating income. Right. Then guys, we have other operating cost. Okay. Then leave a line, operating profit. So guys, operating profit topic is compulsory, yeah, hereafter. Right. Then guys, we have income and expenses from investing activity. That's a new thing. Okay. All right. Then guys, after that one, can you put the next heading over there? Profit before finance cost. What we'll do guys, we'll do it this way. 1 minute. Shall we leave a line? No, let mark will okay. Profit before finance cost and income tax. Right. Then guys, we have after that one finance cost. These people are using the new word income and expenses from financing activity. This is basically like cash flow statement actually. Okay, right. Then guys, profit before income tax. Then guys, next one, income tax. Okay. Then guys, we have profit for the year. Okay. Guys, remember after this one, we will have discontinued operation, but in this question, guys, we don't have any discontinued operation. Okay. So because we don't have discontinued operation, we are not going to mark that. But if there is, you should write below this profit or loss from discontinued operation. Right? Okay. Right. Now, guys, once you're done with this part, then remember, guys, for statement of financial position, there are no changes at all. Okay, right. Then put the next heading, guys, over there. Right. Statement of financial position. Right. So under that one, guys, statement of financial position. And print corporation as at 30th of June 2002. Right. Non-current assets. We have guys over this property, plant and equipment. Leave a few lines. Then guys, current assets. After current assets, guys, leave another few lines. We have then guys over there, total asset. Okay. Then guys, we have equity and liabilities. Then equity, leave some space there. After that one guys, non-current liability. After that one guys, we have current liability. Then we have after that one, total equity and liability. So like I mentioned guys, SOFP, there are no changes whatsoever. Copy this down guys, we'll start the question. So that means if we have done print, we would have done MIMS also. Guys, we haven't done these two questions, no, guys, in class. Duggan and Vernon, I don't think we have done those two questions, no. No, those two we haven't done, okay. Because today, guys, I want to practice questions on profit and loss. Because that's the new change, no, right? That's the one that I want to focus on. So guys, keep the format ready, okay? Then we can start the question. Okay, right. So guys, then let's start the question, right? Can you guys go to then adjustment number 1, guys, quickly? Okay, right. Can you guys first go to adjustment number 1? Okay, right. Let's have a look at this. Right, guys, now keep note, right? Now our question is finishing on 30th of June 2002. Okay. So guys, if the question is finishing on 30th of June, that means guys, when it has to start, 1st of July 2001. Okay, so this is starting date of the question. So remember that. Okay, so any question guys that you start, always make sure that you're clear with the financial year start and end. Okay, so the paper started on July and question is finishing on June. Okay, now read the first adjustment guys, what they have mentioned. Right, let's see. On 1st of Jan 2022, guys, 1st of Jan, question is finishing on June. First of all, guys, can you quickly make a decision how many months we are looking at, guys, over here? Right? Question is finishing on June. This is starting on Jan. How many months, guys, then? 6 months. Okay, so do keep in mind, this is a 6-month related adjustment. Print Corporation raised funds of 30 million. the full amount was recorded in the nominal ledger as a bank loan. Okay, so where is our bank loan? Right here, guys, can you see 30 million bank loan these people have shown? Okay, let's continue. The funds actually consisted of a bank loan 16 million and 14 million from the issue of 1 million ordinary share. The interest is payable at 5%. An accrual for 6 months interest has been included in trade and other payable and recognized as finance cost. However, the calculation was incorrectly done based on the nominal ledger balance on 30th of June. Okay, guys, let's go step by step, right? Let's break it down. Guys, first of all, these people collected how many million? 30 million. But the problem is 30 million includes what and what? 16 million bank loan and 14 million shares. Now, guys, you have to look at this carefully. Look at this. 14 million issuing 7 million £1 ordinary share. Okay, now, guys, what these people have done? From 30 million, guys, 16 million is loan, 14 million is shares. No, these people accidentally went and put the entire thing from where? Inside the bank loan. Exactly. Entire 30 million they put in bank loan. But that's wrong. No. How much is the bank loan, guys, actually? 16. That means inside this bank loan, guys, first of all, tell me how much extra is there? 14. Right now, guys, I'll give you time because anyway, you can't do this in the exam. So remember in your mind, 14 million I'm removing from bank loan because that's wrong. Okay. Tell you guys now it's update it and show. Right now, guys, can you go to non-current liability faster? Right, go to non-current liability. Okay, put bank loan. Go to non-current liability, put bank loan. Now show the working. Okay, so bank loan is how much, guys? 30,000. And from this, we are now removing 14,000. We are removing. Okay. Right. Let's now tell me this 14 million. Actually, we should go and mark it inside where? We have to mark it inside shares. Yeah, but guys, you have to be a little bit careful. Now, there's some common mistake that students make. Guys, look at this. 7 million share you're issuing and collecting 14 million. Okay. 7 million, $1 ordinary share you're issuing and collecting 14 million. So I want you to take that into account. And now, guys, can you mark and show me in equity how it will work? Here, guys, let me show you. Right. Equity share is 29,600. Other components of equity, share premium 15,500. Now, why did I select that? Because, guys, this company is doing what? Issuing shares. That's why I'm selecting those two. Right. First of all, guys, can you copy this and show inside equity faster? Right. Equity share 29,600. And then other components. What's the answer? 15,500. Okay. Now, guys, all of you understood the adjustment. What's happening? 14 million shares we put inside bank loan. So you removed from bank loan. No. Now properly can you mark it and show inside equity? Issue of share. Can you now properly think and mark it and show inside equity how it will work? Guys, now can you check your answer? Okay, now when you're guys marking inside equity, how you should mark? Guys, under equity share, can you directly go and add 14 million? Can't. How you should add? 7 million you should add to equity share. 7 million you should add to other components of equity. How did we break it to 7 million? Right now, guys, those who didn't understand, see, look at this, guys. We are issuing 7 million shares. One share is $1. Then, guys, this is nominal value, no? Right? So that means 7 million into 1, we are collecting 7 million. But the paper says we have raised how many million? 14 million. So, guys, $1 share, if it's 7 million, in nominal value, you can only collect 7 million, no? If you have collected 14 million means, what does it mean? a share, you gave it for 2 rupees, you doubled it. Okay, so that means guys, another 7 million is missing now. This 7 million is the share premium, but I have marked over here and shown. So basically what happened, 7 million share, we gave it for $2. $1 nominal, $1 premium. That's why we were able to collect how many million? 14 million we were able to collect because of that. Are you okay with how that 7 million came? What happened guys? See, 7 million $1 share, you issued and collected 14 million. So guys, 7 million, how do we make it 14 million? By issuing for double the value. Right? That's how over there guys, I broke it down to 7 million separately. Okay. So guys, this is the first mistake that these people did. Okay. The bank loan, inside that they went and put the ordinary share. Mistake number 1. Now guys, look at this mistake number 2. An accrual for 6 months has been included in trade and other payable and finance cost. What do you think about the topic guys? Correct or wrong? Interest for 6 months is accrued. They haven't paid. They put inside other payable. Correct or wrong? Correct. Normally when you don't pay, it's accrued interest. No guys, current liability, other payable is correct. Also they put in finance cost. That is also correct. Topics are correct. But the problem, the calculation was incorrectly based on the nominal ledger balance on 30th of June. Guys, these people have calculated the interest for 30 million rupees. Because the accountant put 30 million no as bank loan. So for 30 million only they have calculated the interest. Correctly guys, these people should calculate interest for how many million? 16 million, because 16 million is the bank loan guys. For 16 million only you have to calculate and take. Right now guys, can you do the correction and show it to me guys faster? What happened? They calculated the interest for 30 million, which is wrong. You have to calculate the interest for only how many million? 16 million only guys, you have to calculate the interest. So therefore guys, now can you correct it and show it to me faster? Right, from those two places, the accrual and the finance cost. Right, so I want you guys to correct it and show for me from here as well as here. Right. So start calculating guys. See how much extra they put. Why do I say extra? Bank loan is 16 million, no? Without calculating for 16 million guys, these people calculate for how many million? 30 million these people have calculated, right? So therefore guys, please correct the interest from where and where? From the finance cost as well as the trade and other payable. Correct it and show it guys faster. Let's can little bit check and see guys with your interest. Right now guys, this is what happened. Guys, they calculated the interest guys for how many million once again? 30 million. So guys, see 30 million interest. Okay. These people calculated for how many months? 6 months at how much percent guys? 5%. Then these people guys have got an answer, if I'm not wrong, 30,000's 5% guys is half is 15,000. No, 15,000 into 5%. How much guys? 750 they got. Yeah, they got the answer as 750. Remember guys, this is wrong. Correct answer should be for 16 million, these people should see for 6 over 12 into 5%. Based on this one guys, what's the correct answer? I believe it's 400. No, 400 is the correct answer. So guys, their topics are correct, but they have taken 750. Correct answer is 400. That means how much guys they have taken extra? 350 they have taken extra. So guys, from your side, what you should do, first of all guys, the paper said they have gone and marked this inside other payable. Right? Can you guys check your current liability? Right, trade and other payable. Make sure guys you have done it this way. Right, 4,170 minus how much? 350 guys should be deducted, because they put 750. Correct answer is 400. Then we should remove the extra. So from trade and other payable guys, you should remove 350. That's point number 1. Okay, right. Second thing guys, what you should do, after marking there, these people guys also put it inside there, finance cost. No, right now guys, you go and mark this inside finance cost also. Finance cost means guys, now guys, can all of you go for your income statement? Right, put the heading guys below this, finance cost. Below what? Income and expenses from financing activity. Right there guys, can you write finance cost for me? Okay. So for finance cost, I see already in the paper, finance cost is 750, right? 750. From this guys, I want you to remove 350 and show. Right? So this is the adjustment guys that has to be done. Okay. Are all guys okay with the first adjustment? All good? Right. Right. Now guys, let's move on to the second part. Okay. Now guys, listen. This is an adjustment related to inventory. Right? Okay. Now, guys, can you quickly find and give me the stock loss, guys, faster? Okay. Adjustment number 2. I want you to read. Get me stock loss. Before you start, guys, IAS 2. How do we guys normally value inventory? On the lower of cost of NRV. Correct. Guys, normally NRV is equal to guys what minus what? Selling price minus selling expenses. So when you read the paragraph, you will understand the cost. Then you will understand selling price. I want you to compare those two and get me stock loss. You get me the stock loss. I'll teach you what to do after that with that adjustment. If you want, you can do and show. Stock loss means, guys, you have to adjust inventories. No? So the adjustment has to take place in 2 places. Right? If you can, you do that part. If not, only calculate and give me stock loss faster. Right? IAS 2. Let's start this adjustment, guys, over there. Adjustment number 2. Let's little bit look at the inventory adjustment, guys. Now what happened? Our inventories are valued at 5.7 million. But out of the 5.7 million, guys, there are 700 units whose cost is 1,400. But to sell that, there should be an additional process that costs 400 per unit, at which point they can be sold for 1,600. Now, guys, that 400 additional 400 is what, guys? That is our selling expenses. Good. But if you spend that 400, you will be able to, guys, then sell it for how much? We'll be able to sell it for 1,600. That means, guys, our NRV is how much? 1,200. So standard says, guys, always if there is a problem between cost and NRV, we should always go for the lowest. Now, guys, tell me, when you select the lowest for inventory, okay, what is the loss that you are facing? Right, when you select the lowest, guys, there now you bought it for 1,400, but then when you select the lowest, it's 1,200. Okay, so how much of a loss you are facing, guys? 200 loss you are facing. But understand, loss of 200, guys, we are facing for 1 unit. Like that, how many units do we have? 700 units, guys, we have in our hand. Okay, so multiply this one, guys, by then 700. Right, now check and see, guys, over there. Okay. 200 into 700. So, guys, 140,000, we are facing a stock loss. Right? Okay, 200 into 700. So, therefore, guys, it will become a loss of 100 and correct, no, guys? 140,000, no loss, 200 loss. Okay. All okay. Right. So, guys, we have a loss of then 200 into 700, guys, 140,000 stock loss. Now, guys, it's stock, no? What should we do, guys, from our stock? Add or subtract, because the loss we have to subtract, right? That is the first thing that we should do. It's a stock loss, so stock we have to deduct. Okay, now, guys, can you go to current asset and do the adjustment and show it to me? Right, go to current asset. Right, start writing, guys, over there inventory. Right. So in our trial balance, how much is the inventory? Right, in our trial balance, guys, the inventory is how much? It's actually okay. Now, guys, in the trial balance, they have given me inventory on 2001. Then that's opening stock now. I should not do this from opening stock, guys. If I am to adjust, I have to adjust from where, guys? Closing stock. So over here, guys, our closing stock is going to be how much in that case? Our closing stock will be 5.7 million. So, guys, from this only, then we have to adjust. Okay, 5,700 minus 140,000, guys, we have to adjust. Okay, right. And then, guys, remember, now you have subtracted from inventory now. Okay, when you subtract from inventory, guys, what's going to happen? Inventory will become credit. Okay, so it's stock loss. Stock loss on inventories now. So inventory is current asset. So I have adjusted that. Guys, tell me, closing inventory, where else, guys, we will mark this in accounting, guys? Closing inventory, we are also marking inside cost of sale. That means, guys, inside cost of sale only, the other entry has to be done. But, guys, remember, now I noticed in this paper, they have given us opening stock. When I go through the paper, I don't see anything called, but, guys, cost of sale is not there. So, because cost of sale is not there in our trial balance, I will have to open a working for that. Right, so, guys, can you mark the heading, guys, over here? Cost of sale put over there, working number 1. Let's prepare, guys, this one separately and show, right? So on the side, if you want, guys, we can do the working, right? So let me, guys, now open over here. Put the heading, guys, for cost of sale, then working number 1. Right, okay. Now, guys, then can you start writing over here, guys? Number 1, we have, right? Cost of sales, right? Okay. So, guys, cost of sale, guys, we normally have like this, no? Okay, we have opening stock, right? Then leave a few lines. And then guys, can you mark here then for me closing stock or closing inventory? Right. Okay. Right now guys, can you update and show me the closing inventory guys over there faster? Right, update and show me the closing inventory value. So guys, remember what happened from closing inventory is how much guys? 5.7 million. No? Okay. Right. For 5.7 million guys, we have how much? We have to deduct 140,000. Right. Deduct 140,000 guys from that one. Right. Then guys, what will be the new closing stock answer? 5,560. This should be the answer. Okay. These are our new closing stock after stock loss. Right. Now guys, once again, let me quickly summarize what happened over there. Right. This is what happened. First one. Guys, there is a stock which we bought for 1,400. So that's the cost. But then we need to sell this for 1,600. So that's selling price. But to sell this for 1,600, guys, we have to spend an additional 400 selling expense. So the NRV became 1,200, cost is 1,400. Standard says we have to always go for the lowest. So the lowest is 1,200. So I bought for 1,400. If I'm selecting 1,200, guys, I'm facing a 200 stock loss. So guys, when I'm facing a stock loss, what happens? Double entries, expenses account debit, inventory account credit. So inventory account credit is guys what I went and did over here. Okay. From current assets, I'm subtracting this inventory. My current assets is 5,700. There is stock loss, so stock will reduce. And that same answer, I went and guys then adjusted inside my cost of sale. Because when closing inventory goes down, it should affect your cost of sale also. So for cost of sale, guys, I have gone and marked it over there. That's it. This is how guys we have to do the adjustment. At online children, guys, if you're having a doubt, send it. I will explain. Even physical class, I can redo this, no problem. Right. Others, guys, what you do, right? Go to guys now adjustment number 3. Okay. Now remember, guys, this is a new adjustment. I don't think, guys, in papers what we have done previously, this particular adjustment has come. Right. This area is getting tested from IAS 37. Right. IAS 37, guys, what's the accounting standard? Provisions, contingent liability, contingent asset. This is where the standard is getting tested from. Right. Now, guys, I want you to do a small work for me. Okay. Read the entire paragraph. And guys, I want you to calculate and give me 2 things. I'll teach you how to do the adjustment, right? Read the entire paragraph, guys, and I want you to calculate and give me 2 things over there. Right. Number 1, guys, I want you to calculate and show me like this. First one. Okay. If we are continuing this contract, how much will go from your hand? If we are discontinuing this contract, how much is going to go from your hand? I want you to calculate those 2 and show. If we proceed the contract, what's the cost we have to bear? If we discontinue the contract, what's the cost we have to bear? First of all, guys, can you calculate and show me those 2 answers faster? Okay. So guys, you'll only get me those two answers, then I'll teach you where to mark, because guys, this area, if I'm to be specific, is coming from a place called guys onerous contract. What's an onerous contract, guys? I'll explain. We haven't got this adjustment in the previous papers. This is the only paper which I can remember where the onerous contract got tested. So you calculate and give me the answers, then I'll recap the standard and I'll teach you what to do over there. Okay. Right. Guys, do keep in mind this is a contract for 3 years. Okay. So when you're calculating, guys, take that into consideration. Okay. Now, guys, can little bit see how far you have been doing it? Right. What happened, guys? We have a contract to purchase 22,500 electric equipments over the next 3 years at a cost of 450 each. Right, these purchases are made at a constant rate. That means, guys, over the 3 years, we'll be making it equally. Okay. These components are no longer required for the initial purpose, but they do have an alternative use, which will require an additional cost of 600. That means, guys, you have to pay to your supplier 450. But then if you want to make use of it, guys, what's going to happen? Another 600 you have to spend on this. All okay? You have to buy it for 450, but now this one has no purpose. If you want to make it having a purpose, you have to spend another 600. That means for supply, you have to spend 450. Another 600 rupees you have to spend additionally for that manufacturing part. Right. Then, guys, what's going to happen? Thereafter, this can be sold for 900. Okay, guys, after spending this much, 1 minute. First of all, guys, I'll clear the screen. Right. Wrong, guys, with this one. Okay, anyway. Right. So, guys, I'll do the working on this side and show you because it's not getting erased. Okay. Now, guys, what happened is like this. See, if I'm to continue the contract, this is my total cost, right? I have to buy 22,500 items at 450. But if I am to make it useful, I have to spend another how much, guys? I have to spend another 600. I have to spend from my hand. So that means in this one, my total cost of spending will be how much, guys? In that case, 22,500 into 1,050. Okay, then, guys, what will be the answer? 23,625,000, guys. I have to spend it from my hand. But then if I spend for this much, I can sell this for how much, guys? 22,500 worth of items. I can then later sell it. The paper says we can sell it for $900. So what you do, guys, you multiply this one by 900. Okay. 22,500 into 900 we can sell. Right. That time, guys, what will be the answer? We can then get 20,250,000 to our hand. So, guys, listen, this is the cost, right? This is selling price, right? So that means if we continue the contract, what's going to happen? My cost is 23 million, but my revenue is 20 million. So that means at the end of the day, there will be a loss of how much? 23,625 we have to spend to gain 2250. We will be, guys, having a loss of 3375 loss if we continue the contract. 3375 means 3375, guys, million. There will be a loss if you continue the contract. But then, guys, on the other hand, what's going to happen? If you discontinue the contract, what will happen? Right? If you discontinue, you can cancel the contract immediately. But if you cancel, guys, we have to pay how much? 4 million we have to pay. So if you discontinue the contract, guys, you have to pay from your hand a 4 million. So there will be a loss this way. This is what we call, guys, an onerous contract. An onerous contract is where if we continue the contract also, it's unfavorable. Right? That means an onerous contract is something like this. Right? When you perform the contract, it's going to result in an unfavorable situation. Because see, guys, if I perform the contract, what's going to happen? My cost is more than my selling price. right? So this is what we call an onerous contract. In these contracts, what we have to do, the standard says when you have an onerous contract, see the cost of continuing it, then see the cost of discontinuing it. When you compare both the costs, you have to record this and show at its lowest. This is what the standard says when it comes to onerous contract. So guys, again, two key points. Number one, what's an onerous contract? That is where, guys, when you continue the contract more than the income, your expense is high. So it's a loss-making contract. So when you have a loss-making contract this way, you should check for two things. If you continue, what's your loss? If you discontinue, what's your loss? Out of those two losses, you should recognize this transaction at its lowest. So guys, at our given point, guys, we should recognize it at how much then? 3.375 million, which is the loss of continuing. Right. So guys, this is the answer that we should recognize. For this one, guys, can you start writing the double entry? Expenses account will become debit and provision for loss will become credit. Right. Mark the double entry and keep guys over there. Expenses account will become debit. Provision for loss, guys, will become credit. Okay. So these are double entry, guys, for that loss-making contract. Okay. Now, guys, expenses debit. Which expenses should we mark? Guys, can you see here? What does the paper say? Right? Any adjustment resulting from this information should be made to, guys, what expenses? Administration expenses. Because, guys, the paper specifically says administration expenses, guys. Now I want you to go and mark it over there, right? Now, guys, go to administration expenses. Guys, under new syllabus, administration expense means what? Other operating costs. Guys, think and tell me, is this something that happens always or is it a one-off item? One-off item. So under the new syllabus, one-off item should be disaggregated, meaning you have to specifically show this. Right now, guys, below this, can you start writing, guys, over here? Loss from onerous contract. Right? Separately, I want you to show the answer. Right. So, guys, mark it over there. What's our loss in that case? 3,375,000. Okay, loss from onerous contract. So guys, when you write it here, what's going to happen? Expenses account will become debit. And then, guys, what does my paper say? It then says provision account should become credit. Now, guys, listen, this is something that most students will miss out on. And it's very understandable as well. Right now, guys, listen, provision credit. Normally, guys, when I say provision credit, it's an asset or a liability. It's a liability. Now, guys, problem is in our SOFP, how many liabilities do we have? Two. Non-current liability and current liability. Then where should we mark? Is it current or non-current? Guys, look at this carefully. This is a how many year contract, guys? This is a 3-year contract. So because this is a 3-year contract, what they have done in this paper, 3,375 is a loss that you have to bear over the next 3 years. No, what they have done, guys, they have divided this one by 3. Right. Can you also, guys, check and see then when you divide by 3, then what will be the answer, guys, over there? 3,375 divided by 3 years. It will become how much? 1,125. Okay. 3,375, guys, is a loss that you have to bear over how many years? 3 years. No. So divide by 3. That means per year loss is how much, guys? 1,125. So why they are dividing by 3? That means 1,125 is a loss per annum. No. So 1,125 is a loss that you have to bear in the next year. So because you have to bear that in the next year, what these people have gone and done, they have marked 1,125, guys, inside current liability. Start writing, guys, over here. Provision for loss 1,125 they have put to current liability. And then what they have done, the remaining balance, they have put it inside non-current liability, guys, over there. Provision for loss 1,125 into 2, which is 2,250. Mark it inside non-current liability, guys, the balance 2,250. Right. Once again, guys, if I am to explain that, guys, listen, this is what happened. The provision for losses, guys, how much? It's 3,375. in this paper, guys, because it's going to be borne over 3 years, but you're going to bear next year, you're putting inside current liability. But you're going to bear over the next 2 years, you're going to mark it inside non-current liability and show. This is what, guys, they have done in this particular paper. Right? Can you also, guys, then mark it and show this way, please? 2250. Normally, guys, students will go and mark this inside non-current liability because it's 3 years now. But the thing is, you have to split and show current and non-current liability. Now, when I did the paper for the first time also, I went and put inside non-current liability because it's 3 years now. But then part of it we are going to bear next year. So that means one should go for non-current liability. You have to split it and show. Right. So this is how, guys, that particular adjustment should be done. Please ask me, guys, for any doubts that you have. Okay. Right now, guys, let's go for the next page. Right. Guys, can you mark and show me number 6 faster? In this paper, guys, we don't have any deferred tax. Can you mark and show this in 2 places for me? Income tax refund. Mark it and show in 2 places. When I say 2 places, income statement and SOFP. Copy it and show. This paper doesn't have deferred tax, guys, so we don't need to worry. No, we deduct the 1 year loss and we are putting inside current liability because that's to be born next year. The balance 2 year loss, we are still keeping it inside non-current liability because it's a provision for loss. Okay. In the income statement, we have to charge fully because income statement, guys, if there are losses, even if it's for the next year, we have to charge it immediately. Prudence consent. But in SOFP, guys, we are breaking to 2 parts and showing because a part of the 3 year loss we have to bear next year. No, that's why we are showing in current liability. Okay. So what happened was out of 3 years, 1 year answer only I put inside current liability. 2 year answers I'm showing it inside non-current liability. That's what I did over there. If the contract has been made at the beginning of the year, then what's going to happen? That means under non-current liability, only 1 year loss will be shown. Because then already 1 year loss we have incurred. No? Now you had asked me if it happens at the beginning, but then out of 3 years, 1 year already happened this year. No? That means only 2 more years to go. So out of 2 more years, 1 year will go to current, 1 year will go to non-current. Because 1 year loss we have already incurred. No? That's how it's supposed to be done. Okay. Right, so guys, the 2 students who had asked me those 2 doubts, just check and let me know, guys. Are you all okay with what I explained? If not, I'll explain it differently. Okay, just check and let me know. Okay, clear, no? Guys, income tax refund, where and where you have to mark. Okay, now guys, income tax refund, first of all, guys, you should mark it in the income statement. Right now, guys, can you mark it in the income statement? Guys, tell me if it's a refund, positive or negative? It's a positive answer. Put, guys, over here 2530, right? It's positive. 2530. Guys, I want you to understand one small thing. Listen, guys, in your paper, when they get income tax refund, you know what that means? The question is a loss, right? It will become a loss. Income tax refund will only be given by the government if the company makes a loss for this year. So when you see the word refund, you should know when you're calculating, you're going to get a loss hereafter. And because it's a refund, think and guys, let me know, is it a current asset or current liability? It's a current asset. Very good. Now guys, go to current asset, leave a few lines. Right here, guys, tax refund. Copy it over here, 2530. Okay. So guys, then that part is done. Okay, then guys, let's go for the then last 2 adjustments. Okay, now guys, can you read this one for me, guys, over here? Adjustment number 4. Okay. Okay, so guys, what's happening guys over here? What's the standard number? IFRS 5, no? Non-current assets held for sale. Okay, now guys, what happened here? The machine which cost 2.4 million and a carrying amount of 1.4 million was classified as held for sale. Guys, first point. When you classify something as held for sale, you should first remove it from PPE. Okay, so it's basically like a disposal, right? When you classify it as held for sale, you should remove from PPE. Right now, guys, number one, the cost is 2.4 million. So first thing what you should do guys on the paper, right? You have this machine cost now guys over here. Can you see in the paper, right? From this first you should remove 2.4 million cost. Guys, can you tell me those who have not studied the standard, when you guys classify something as held for sale, where do we show in SOFP? When you classify it as held for sale, we are showing it under what topic in the SOFP? Current asset. So when you are guys showing it inside current asset, you should then remove it from non-current assets. That's what we are doing there, right? Step 1, we remove the cost. Step 2, guys, you should remove the provision. Guys, they haven't given the provision for you. Can you guys quickly work it out? It should not take you that long. Cost is 2.4 million. Carrying amount is 1.45 million. That means, guys, tell me, guys, what should be the provision of the asset in that case? Cost is 2.4, carrying amount is 1.5. What should be the provision, guys? 0.9 million, no, 900,000 should be the provision. Then guys, that also you should remove from your balance, right? From this accumulated depreciation, guys, you should remove that minus 900. Right, mark it over there, guys, minus 900. So those things, guys, if you want, you can show working or maybe do it in your mind, okay? Or maybe in that working space, you type these and keep, right? 900 minus provision, 2,400 minus cost, okay, right? Guys, now listen, let's recap on the standard quickly, right? Now, guys, see, under IFRS 5, okay. When you guys classify something as held for sale, number one, you should show this inside current asset. Okay, that is point number one. Now, guys, when you're showing inside current asset, at what value should you show it? You should always show it exactly at the lower of what guys? Carrying value or else fair value minus selling cost. No, that's basically, guys, again NRV, fair value less cost to sell, right? So these are the rules that you should know, guys. Okay, when you classify it as held for sale, you should put it in current asset. Guys, tell me, when you classify it as held for sale, that particular item, will you be depreciating? No, when you classify it as held for sale, guys, you will not be depreciating that asset. And the good thing is, these people classified it at the beginning of the year. So for that full year, for this particular asset, we should not charge depreciation. Put it inside current asset. At what value should we show it in current asset, guys? We should always show it at the lower of cost or NRV. Now, guys, you read the paragraph. Tell me, guys, what's the cost of this? Sorry, my bad. What's the carrying value of this asset, guys? 1.5 million. Good. 1.5 million, guys, will become the carrying value. Right. Now, guys, next part. NRV. Guys, read the paragraph. There are two NRVs. Tell me, guys, what should be the correct NRV that I have to take into consideration? Right? There are two NRVs. Check and let me know, guys, which NRV I should be taking it into consideration. Guys, will the NRV be 1.14 or 1.1? What should be the correct NRV, guys? It should become 1. No, guys, it has to actually become 1.1 million only should become the correct NRV. I will explain why. Okay, right. Can you guys mark it over there? Right, correct NRV is 1.1 million. Right. Now, guys, most of you were partly correct. Now, when we are classifying this as held for sale, that time, yes, the NRV is how much? 1.14 million. When did we sell the asset, guys? July 2002, which is next year. Next year only we sold the asset. So disposal is not for this year accounting entries. The disposal will happen for next year accounting entries. But guys, this is what's going to happen. See, if you're able to sell this on 1st of July 2002, this year did you sell the asset? This financial year we did not sell the asset. So guys, technically, if you're able to sell it for 1.1 million in July 2002, in June 2002, guys, then what should have been the NRV? It should have been almost the same, no? Now see, you're selling this at the next day of the financial year. When the financial year is ending, next day only we are selling. So disposal entry should actually guys happen for the next accounting year. The argument here is this. If you're selling this on 1st of July 2000 X2, on 30th of June, the NRV should have been this. Guys, this is the NRV when you started the question. No? Do you understand, guys? So if you're selling on the next day, that means end of day, the NRV should have been 1.1. Because within a day, NRV can't change. No? So this should have been the more accurate NRV. So guys, NRV is 1.1. Now guys, can you tell me out of this, the standard says we are going to go for the highest or the lowest, guys? The lowest, select 1.1 million. Where should this 1.1 million be shown? This should be shown inside current asset. Now guys, can all of you go to current asset? Start writing guys over here. Non-current assets, held for sale. Or you can just write held for sale even, no problem. So guys, once again, why we are taking 1.1 million without taking 1.14 as the NRV? Because 1.1 million is the recent selling price. So that's the recent NRV. So we should go for that value rather than going for 1.14 million. Because the sale happened on first. So previous date, this should have been the NRV. Okay. Right. And guys, can you write here now, non-current asset held for sale, 1.1 million. Okay. Guys, now when you classify it as held for sale, guys, you should see, are you making a loss? Guys, the carrying value was 1.5, but now you are showing 1.1. Are you making a loss by any chance? Yes, you are making a loss. How much of a loss, guys, are we facing? 400,000, guys, loss we are facing in this question. Because carrying value is 1.5, no? But if you are showing 1.1, you are facing a 400,000 loss. Guys, tell me, guys, in this paper, loss is expense, no? Which expenses, guys, can we go and show this inside? Yes, kind of, exactly. Little bit connected to that standard only, we are taking 1.1 because that's the most recent NRV, correct? Right. Guys, which expense can we take this inside? Now we have expenses like cost of sale is there, other operating cost is there, investing cost is there, financing cost is there. Which cost, guys, can we go and show this impairment loss inside? Exactly, we can show it inside operating cost. If not, guys, we can also go and show this inside cost of sale. Both are applicable because the paper is not specific now. So therefore, guys, wherever you mark, you will get marks in this particular paper, right? Exactly, it's like an impairment loss. Very good, it's an impairment loss. Guys, in today's paper, listen guys, you can mark it in operating cost, there is no problem. You can mark it inside cost of sale. Guys, because this is a little bit of an older question, shall we guys go and mark this inside cost of sale? The reason, guys, why we are marking in cost of sale is this. Let's look at the first line. Printco is a what question? Is a what company? So now guys, normally if it's a manufacturing company, anything related with machine, we go and mark it to what cost? Cost of sale. So these are machine cost now. Therefore, guys, what we will do to be on par with the marking scheme, let's go to cost of sale and guys, right here, impairment loss. But guys, listen, the article, the new updated article says nowadays expenses, they will tell you where to mark. So you don't need to guess. Understood? They will tell you where to mark. Okay, so today's paper, guys, let's go and mark this inside cost of sale. Why cost of sale? Because these are manufacturing organizations. So you guys know that from FA level, anything related to manufacturing organizations, cost of sale, anything related to machines, we should always go and mark it to cost of sale. That's why I'm charging this loss inside cost of sale, because it is related to what? Machines. Right. Guys, now can you calculate and show me depreciation, guys, quickly? That's an easy adjustment, should not take you that long. They are telling Print's policy is to charge depreciation at 15% and to copy it inside cost of sale. Guys, 15% we have to check on cost. Right now, guys, can you check and give me 15% of cost faster for plant and machine? Please see 15% on cost for plant and machine. Guys, take the updated cost now on the screen. Please check and take the updated cost. And guys, once you get the answer, the paper says for you to go and mark it inside what, guys? Cost of sale. Huh? Mark the depreciation inside cost of sale. Okay, right. So guys, what should be the depreciation? 16,200 minus 2,400, guys. What will be the new cost of the equipment? 13,800 after you remove the held for sale, because guys, you classified it as held for sale at the beginning of the year. So for that asset, you can't depreciate, but remove that. Okay. And for this one, guys, what is the percentage? Is it 15%? Yeah, 15%. Okay. Now, guys, can you check and see 15%? Then what will be the answer? 13,800 into 15%. Guys, is it 2070? Yes. 2070, guys, what you should do. Step number 1, please go and mark it inside cost of sale. Right, start writing, guys, over here. Depreciation. What's the answer? 2070. Yeah. Okay. Guys, then don't forget the basics. When you copy it to cost of sale, depreciation becomes debit and provision for depreciation should become credit, right? So you need to little bit adjust your accumulated depreciation, because we are doing SOFP also now, guys, in this question. So make sure you have done this part. These are the basics of FA, right? You have to add to accumulated depreciation. Right, now, guys, the question is done. Shall we now quickly copy the balances and balance it off? Right, let's start with you. Right, first one, guys, we have equity share we took, other components we took, retained earnings. Guys, can you copy retained earnings inside the SOFP, please? Okay. Retained earning, please copy that inside SOFP. Right, so go, guys, go to SOFP, write retained earning. But guys, be careful, that's retained earning opening balance, 11,470. Write it on the side and keep. Why? Because we have to show this year profit inside that, no, right? So mark it on the side and keep. Okay. Then, guys, next one, plant and machine and land. Guys, let's go and show this inside property, plant and equipment, right? Okay. Let's go and show this inside property, plant and equipment. Guys, if you want, you can make a working for this. Okay. If not at once, you can show the answer, right? First of all, guys, let's show it this way, will you? Okay, plant, updated cost, 13,800. Okay, guys, how did I get 13,800? 16,200 minus 2,400. Okay, now accumulated depreciation. Guys, take a calculator. Can you update and show me this part? Accumulated depreciation, update it. 7,290 minus 900 plus 2070. Okay. Updated accumulated. How much, guys? 8,460. Is it okay? After removing 900 and adding the current year charge, then, guys, can you write here minus 8460? That is the accumulated depreciation. 8460. Okay. Guys, then we have land. Guys, land is also PPE. No? So can you guys add to this answer? Guys, listen, in a company account, we can't show the assets separately, no, in the SOFP. You understand, no? Machine, land, like that separately, we can't show in a company account. PPE, guys, should be shown in one line, the answer. That's why I said, if you want, you can make a working, but it's not necessary, I feel. Right, so guys, add to the land, will you? How much is our land? 45,000. Okay, add 45,000 to this one quickly. Right, done. Bank loan. I believe, guys, bank loan we already finished. Trade and other receivables. Guys, can you copy this inside current assets, please? Second line. Trade and other receivable. Right, mark it over here. 25,010. Trade and other payable, guys, we already copied. No, right? Copy the next one, guys. Cash at bank. Copy that one. What's the answer? 4,700. Okay. Then, guys, remember all the other items are income statement items. Okay. Now, guys, let's start copying this one, guys, over here faster. Right. All the other items are income statement items. Okay. Let's copy here. Will you? Right. Revenue. How much is the answer, guys? Copy to second column. Revenue 97,400. Okay. Production cost. Guys, tell me, this is actually like A-level knowledge. Production cost in the income statement. Where do we, guys, copy? Very good. Cost of sales. Okay, right. Production cost, guys. Now, can you copy it to cost of sale over here? Okay. Production cost. Mark the answer. 60,150. Guys, administration and distribution expenses. Nowadays, we call it as what cost, guys? Operating cost. Can you guys quickly add these two? We'll do as per new syllabus. Okay, add these two for me. Okay, add those two. Okay. So guys, once you add those two, how much you are going to get? 36,770. Is that correct, guys? Administration, distribution, guys, nowadays we don't show separate. So when you add, can you guys show it this way? Right. Operating cost. Okay. Show it like this. Operating cost. What is the answer? 36,770. Okay. That's finance cost. We have guys already shown it here now. So no problem now. Right. What's the last one, guys? Inventory on first. First means, guys, opening inventory. Copy it, guys, over here. Opening inventory 6,850. Copy it inside opening inventory. All okay, right. Done. Guys, first of all, can you use your calculator, guys? Get me cost of sale then quickly. Now everything is done. Let's balance off the question. Right. First thing, get your cost of sale. Start doing this one. 6850 plus 60,150 plus 400 minus 5,560 closing stock plus 2,070. Get your cost of sale. Okay. Guys, I am getting cost of sale as 63,910. Correct, no? Okay. 63,910. Copy it, guys, over here. 63,910. Now, guys, get the gross profit. Okay. I am, guys, getting 33,490. 33,490 for this. Are you guys okay with this answer? Right. Then, guys, can you add and now show your operating cost, guys, over here? Right. Your operating cost, add these two and show 33,75 plus 36,770 at both operating cost, guys. I'm getting 40,145. Okay, that's our operating cost. Now, guys, then show me operating profit. In that case, how much it's going to be? The loss, no? Okay. How much, guys? 6675. Is it, sorry, 6655? No? Yeah, loss of 6655. Okay, income and expenses from investing activity, nothing is there. But guys, listen, in the new standard, you still have to show this answer. Okay, like in that article, guys, they're specifically mentioning even if investing activity, anything is not there, still this answer you have to show here. Profit before finance cost and income tax, though is the same. They have made it compulsory nowadays. Okay, right. Next one, guys, finance cost. Now show the answer. Finance cost should be how much, guys? Minus 400, correct? No, when you remove that one, it will become minus 400. Right now, guys, can you get me the profit before income tax? How much, guys? 7,055. Profit before income tax. That answer, okay, guys. 7055 I am getting minus, correct? No, minus 7055. Okay. Okay. Now, guys, can you get the profit for the year, please? Right, how much is the answer, guys? 4525 minus, no? Okay. Now, guys, take this last answer, 4525 minus, okay? And this answer, guys, now can you copy this to your retained earnings, guys? Minus 4525. Okay, please make sure, guys, you have taken this to your retained earnings. Because, guys, profit for the year, all of for the year must be taken inside retained earning, no? Right? So I want you to take it here. From here, take it to this. Okay. Guys, now can you little bit check and see, guys, is your question balancing, right? Little bit tally and see where things are okay with you. So let's talk property, plant and equipment 13,800 minus 8,460 plus 45,000. So guys, then what will be the answer? It will become 50,340. Then guys, total assets I'm getting 83,680. Okay. Then guys, equity share 36,600 over here, guys 22,500 over here 6,945. Trade another payable 4170 3820. Guys, total equity and liability. Yeah, I think this one is wrong. No, guys, my assets, I haven't taken the inventory. I think guys, balancing answer is 89,240. Yeah, it got balanced, no? 89,240. Here, guys, accidentally, I haven't taken my inventory. That's the problem. 5,700 minus 140. I forgot to take that. Okay. 5560. Then this will become okay. 83,860 plus 5560. Yeah, it's balancing, guys. 89,240. Okay. So guys, another one question we will do based on the new format. Then we will become a little bit more confident than what we are. Can you go for this question that says Vernon Corporation? Go for that one, guys. So I want to do, guys, another one income statement with you all, right? So go to question number 425. Vernon Corporation. Okay. So guys, this paper, they are only asking profit and loss account for 15 marks, earnings per share for 5 marks. So we'll first focus on P&L only, Once that is done, let's focus on guys earnings per share. Okay. So in your writing book guys, and let's start drawing the format one more time. So only I need P&L with other comprehensive income. Okay. No need SOFP. Once we are done with everything, then let's focus on EPS because guys, EPS is a completely different area now, right? So let's not confuse the topics, right? Put the heading guys then, question number 425. Okay. Four two five. Burn on profit and loss account. And guys, this time have other comprehensive income also. Profit and loss and other comprehensive income. Year ended 31st of December 2008. Okay. So guys, please have this format ready and then we'll start. Okay. Guys, for this question, what I'm going to do, I'm going to separately, guys, open a table for my expenses. Operating cost, investing activity, financing activity, guys. I feel better if we can open a small table kind of thing and label it. Or what shall we do? Okay, for the time being, guys, we'll keep it like this value as it is, right? And then we'll start. So guys, when I went through this question, I understood guys, this question is a very good one for you to get familiar with the new standard. There's a lot of different items are coming. So we can use this question as a good learning platform for the new standard. Okay. So guys, please have the chart ready. Only profit and loss account. Guys, can you also add the topic guys over here? Other comprehensive income. We have that also. Other comprehensive income. Okay. And then total comprehensive income. After that, we'll do the earnings per share, right? So guys, please have the chart ready. I'll give you 2 minutes and 11:10, we'll start discussing the question. Okay. Right. Let's start the question. Okay. Okay. Now, guys, first thing, as always, question is finishing in December. Okay. Right. That means, guys, technically, when should the question start, guys? 1st of January 2008. Always, guys, make a note of that whenever you do questions. All good? Right. Let's start. Okay, guys, first of all, shall we quickly copy down these and keep guys in our income statement first, all these numbers, then later we can start doing adjustments, right? So guys, when I say copy to the income statement, I'm asking you to copy it on the side and keep. Right, let's start, guys. Okay, cost of sale, the answer is how much? 46,410. Right. Finance cost, copy it guys over here and keep, open bracket, 4050. Right. Okay, guys, investment income. Okay, right now, guys, can you do me a small work? Can you guys add 3 rows, guys, under investment income if possible? Okay, can you add 3 rows under not investment income? Investment activity is there, no? Below that one, guys, can you add around 3 to 4 lines if you can? Okay, add 3 to 4 lines. Right. Now, guys, listen. Old standard investment income, we used to copy it here. Now, guys, operating income. Nowadays, it's not like that. Investment income, guys, separately, you have to show it inside investing activity. Okay, right. Start writing, guys, over here. Right, investment income. Okay, so guys, when you look at now I have the Kaplan 2025-26 version. Now, when you look at that also, guys, they haven't gone like this detail. They have just stuck to the old method itself, but I would recommend you to get used to the new standard, right? Okay, so market guys over here, investment income 1520, but seems like there are some adjustments because it says no, guys, note number 3. Next one, guys, operating expenses, copy it guys under other operating cost, right? So operating expenses, what's the answer? 20,640. Okay, revenue, can you guys copy that also on the side and keep 75,350. Guys, tax, let's keep it aside because we actually don't know what it, but to be very honest, guys, now you should know this by now. Tax, guys, when it comes on debit side, it's actually, guys, what provision? Under or over. Debit side means, guys, it's an expense, no? So expense means it's under or over provision. It has to be under provision. Over provision is like income. So it will be on the credit side. So guys, debit side means it's an under provision. So just keep it in mind, guys, over here, this is an under provision. Right. Okay, now guys, let's look at now adjustment number 1. Right. Vernon Corporation made a large sale of goods on 1st of July 2008. Guys, keep note, 1st of July. That means for our question, we have only 6 months remaining, which was also the date of delivery. Under the terms of the agreement, guys, Vernon Corporation will receive a payment of 8 million on 30th of June. Okay, guys, we sold it this July. Next July, we will get the money 8 million rupees. Currently, Vernon Corporation has recorded 4 million in revenue and trade receivable. The directors intend to record the remaining 4 million during year ended 2009. Okay, so guys, so far what happened? We did a sale, we'll be getting 8 million 1 year later. You sold in July, next July you will be getting 8 million. But these people have done, so they are thinking, okay, 8 million we are getting next year, no? Half let's show this year, half let's show next year. That's what the directors are planning. The cost of this sale has been accounted correctly in the financial statements. Vernon Corporation has a cost of 8%, which is an appropriate discounting factor of 0.9259. Just first of all, tell me this particular lesson or this particular paragraph is coming from which accounting standard? Don't need the number, just tell me the topic of the standard, guys. What standard coming under? You're selling goods, then what should be the standard, guys? Revenue, exactly. So guys, listen, this is a revenue standard IFRS 15. If I am to tell you specific area, guys, you're selling now and money will come in the future. So for this, we have a name. What is the name, guys? What element? Starts with an F. It has to be the financing element where you get money in the future. So normally, guys, you know when money comes in the future, what we should do? First, we should find what value? First we have to find present value, but keep in mind already 4 million is inside revenue. Right. Guys, after you find the present value, what is the second thing that you should do in accounting? You have to unwind the discount and take. Right. Now, guys, I want you to do a small work for me. Can you find the present value? And then, guys, I would like you all to unwind the discount. Only do that and keep. I will teach you where to mark because now the format is changing. No? So I will teach you where to go and mark. So from your side, what you should do, find the present value and do the unbinding of discount. But before you do the question, guys, I'll give you a small hint. Guys, the sale happened in July. Question is for December. Take that into your mind. Get me the present value and unbinding. I will then teach you where to mark. Right, start doing this one, guys, quickly. Find the present value and the unbinding part. Only do those two. I will teach you where to mark. Okay. Can you guys quickly take 2-3 minutes and get me those two answers, guys, quickly? Find the present value and do the unbinding part. Everything is in the paragraph, right? Everything is given to your hand. Yes, when you're doing the present value part, the 6 months will not play a role. When you do the unwinding part, only the 6 months will play a role. Because guys, basically unwinding is what, guys? Interest, no? When you're doing interest only, you have to be worried about 6 months. If not, don't need to be worried about that part. Only you get me those two answers, guys, the PV and the unwinding. Then I will teach you how to do. Then when you go back home, I want you to redo this question one more time. Okay, right. Okay, all good guys, right? Check your answer. Right, first one, present value. Guys, normally how do we take present value? What is step one, guys? We need what value first? Future value. Correct or wrong, guys? Okay, now the future value is how much? In the future, guys, you're going to receive how much? 4 million or 8 million? Right. Let's see what they're telling. No, guys, in the future, we're actually going to receive how much? 8 million. And that means, guys, 4 million we have recorded. Okay. Right. Recorded 4 million in revenue. But technically, guys, we'll be getting 8 million in the future. So take the future value. And guys, I want you to put the discounting factor. What's the discounting factor? 0.9259. Okay. So first thing, guys, take the future value. In the future, I'm going to get 8 million. What's the discounting factor, guys? It's going to be this much. Okay. 8 million into 0.9259. So what's the answer? 7407.2. Shall we guys take it as 7407 then? Right? We'll take it as that value. Okay. Now guys, listen. What should be the answer for this? For this one, guys, double entry is revenue account credit, trade receivable account debit. Because basically, if you're going to get the money in the future, it's a credit sale. Right? So for credit sale, guys, what's a double entry in accounting? Sales account credit and debtors account debit. Okay, revenue account credit, trade receivable should become debit. So guys, this much only we should mark inside revenue and trade receivable. But when you read the paragraph, you understand, no, how much, guys, these people have actually gone and marked inside trade receivable and revenue. They have only gone and marked. But check the paragraph and see, guys, how much they went and marked actually. Only 4 million has been recorded. Okay, so this should be the correct answer. But these people have, guys, marked 4 million. Then check another how much more million I have to put in my revenue. Right? I mean, this answer only should go. These people put 4 million. So, guys, my question is, Father, how much more we have to put? So, guys, Father, how much more we have to put? 3 million. 3407. Right. First thing, guys, can you add to revenue faster? 3407. You add to revenue. All good? Right. Now, guys, once you add 3407 to revenue over there, then other debit entry should go for trade receivable, which is an SOFP problem. We are not doing SOFP today, no, guys, so you don't have to worry about that part. So only first you go and add to revenue 3407. Guys, step 2, unwinding the discount. Now, listen, guys, this is where you might have made the mistake. Look at this. 7407 into, when you guys unbinding, you have to take the present value. What's the present value? 7407 into the percentage. What's the percentage, guys? We are using 8%. But guys, unbinding is interest. No, interest we have to only calculate what's relevant for the period. So if you sell in July, when is it? Our question, December. That means only how many months? 6 months, exactly. Can you guys now check the unbinding part for 6 months? So 7407, guys, into 8%, that into 6 divided by 12. Okay. That time, guys, I'm getting the answer as 296.228. Shall we, guys, take it as 296? Okay, let's take it as 296, will you? Okay, now listen carefully. What's the double entry for this one? Okay, now think and tell me, look at the context. Can you guys tell me, unwinding is always an interest, no? What is this? Is this an interest expense or is it an interest income? What do you think, guys? Very good. It's an interest income. Why do I say, guys, this is an interest income? Because listen, guys, this is an interest we are getting from selling. Right? We are selling the product now, so we should get the money in the future. So when we are to get the money in the future, this is an inflow. So it's an income. So the double entry, guys, for this will be finance income account will become credit. And then, guys, what will happen? Our trade receivable will become debit. This is the double entry. Okay. Finance income account will become credit. Our trade receivable, guys, will become credit. All okay. Right. Now, guys, trade receivable debit is a problem for the SOFP. We don't need to worry about that. Guys, now the problem is under the new standard, we have 3 topics for income. Right. Now, earlier standard means all incomes we put it inside where? Other income. Now the new standard, what's going to happen, guys? See, we have other operating income, we have investment income, and also, guys, we have finance income as well. Guys, can you look at this again? Context and tell me for which income should we actually go and mark this into. We have three incomes: operating income, investment income, finance income under the new standard. Which income, guys, do you think that we should go? Think like from where are we getting this income? Because of what? Exactly, we should go and mark it to operating income because there is an income from selling what? Goods, operating activity. So we should mark it inside operating income. Start writing, guys, over here. Then within brackets, can you write 296, right? This is unwinding. Okay, unwinding. You don't need to mark unwinding, but I'm just showing you just in case if you need 296. All good, guys. So this is what the maximum that you should do from this particular paragraph. Find the present value, correct the sales. Do the unwinding, make sure you do it for 6 months because this is coming from which one? Selling. I'm going and marking this inside operating income. Are you guys all okay with this paragraph? Shall we move on to the next one then? Right, let's move on to the next one. Right. Okay, first of all, guys, can you quickly go through the paragraph and tell me, guys, what's the lesson that this is coming from? You should, guys, quickly, as soon as you read adjustments, you should know which standard and which lesson, right? Read the question, guys. Overseas customer, they have given exchange rate. What's the lesson, guys? Foreign currency, right? IAS 21. Okay, foreign currency standard. Okay, now, guys, listen. Read the paragraph and tell me, guys, what type of situation we are looking at, settled or unsettled. Read the paragraph. And normally, guys, in that lesson, I taught you two parts: settled transaction, unsettled transaction. Check and see, guys, what type of transaction we are looking at over here. Settled or unsettled? It's unsettled, no? Because, guys, 60-day period, but we still haven't made the payment. Right, listen, quick recap. Under foreign currency transaction, guys, always first thing, when the transaction happens, you have to record it at spot rate. I will teach you how to record. From your side, I want you to calculate the value and show it to me, okay? When you're doing the transaction, what was the amount? Spot rate. And guys, remember, this is an unsettled transaction. So standard says when it's unsettled, you should see whether it's monetary or non-monetary. Now, guys, read the paragraph and see what are we looking at. Is it a monetary or a non-monetary item? You're selling goods. Now, guys, when you sell goods, it's goods and whom? Who is the other party called? Trade receivable. Is trade receivable what item? Monetary or non-monetary? Monetary. Then should I retranslate? Yes, if it's a monetary item, standard says we have to retranslate it and take. So, guys, what you do at the end of the year, I want you to retranslate this. Because the topics are changing, I will explain to you where to mark. Only you calculate and give me the value. When you did the sale, what was the dollar amount? When you're retranslating, what is the dollar amount? Why are we retranslating? It's not settled. It's a trade receivable, monetary item. So therefore, we should convert at the end of the year. Right, do these two parts and guys give me the answer, and then I'll teach you where to go and mark it. If it's a normal question, guys, you will properly know where to mark. Today problem is format is changing, so let me explain that part for you. Right, get me the answers only, guys, for me. Okay, right. So guys, we are able to convert those two answers and take. Okay. Now guys, see, on 1st of December, it's 12 million chromit. Okay, so spot rate on December, guys, 12 million chromits. $1 is equal to 6.4 chromits. So divide, but guys, little bit be careful. Foreign currency, every time we are not dividing, right? There are situations where we multiply. Now here, guys, now if you are a student who is getting confused, whether should I divide or multiply, guys, just put simple ratios. Look at this. 6.4 is equal to 1. So 12 million means how much is 1? Okay. 12 million divided by 6.4. That time, guys, what will be the answer, guys? 12 million when you divide by 6.4, how many dollars we are getting? Million? 1.88. Or is it exactly 1.8? 875 then. I think perfectly it's coming to 1.875, I believe. No, yeah. So guys, we'll keep it as 1.875 million. You can take it to 1.88, no problem. Okay. We'll go it as 1.875 million because it's a perfect number. Then guys, see, we have to pay in 2 months. That means December, if I buy, I have to pay January end. But my question is, guys, finishing off in December, no, it remains unpaid. So when it's unpaid, at the end of the year, the exchange rate is this much. You have to again retranslate. So take 12 million I have to pay. Now the exchange rate is 6. So therefore, guys, it will become 2 million should be the answer when I retranslate. Are you guys all okay with the two values? Right. Now, guys, let me teach you now how to mark this answer and show. Step 1. Guys, when you get the spot rate, what is this situation? We are buying or selling? Selling. So when you sell credit sale, guys, normally in accounting, what's the double entry for credit sale? Sales account should be, sales account has to be credit. Guys, go to sales, credit this quickly, plus 1.875, right? Mark it, guys, over here, 1875, add to your sales. Sales account should become credit. And guys, who should become debit? Trade receivable, but that's a problem for the SOFP. So forget about that. Okay, no need to worry about that part. Right. Guys, now look at this. During retranslation, right, now see what's happening over there. Guys, you bought it for 1.875. My bad, not bought it. We sold it for 1.875. But once you retranslate, now what's the amount? 2 million. That means, guys, is it a foreign exchange gain or loss we are looking at here? It's a gain. Because in December, he should give me 1.8 million. But because of foreign currency fluctuations, now he has to give me 2 million. So we are making a gain. Gain of how much, guys? 125. Check the difference. Okay. Normally, guys, once you retranslate, check the difference and see. Okay. So 1875 minus 2000, guys, what's the answer? 125, guys. There is a difference over there. Okay. 125, there is a difference. Okay. Now, guys, 125, guys, now we have a difference. No, so it's a gain. So what will be the double entry? Profit and loss account credit, because an income, no. Trade receivable debit. Trade receivable, no need to worry. Guys, now tell me income. What type of income can we go and mark this inside? Now, problem is we have now 3 options. Now, in the old syllabus, guys, what they have done, they have reduced this one from operating expenses, right? Under the new structure, where can we, guys, go and mark this? What type of income is this? We are selling the goods. That means, guys, this is a operating income once again, right? Because of selling goods, now we are getting this foreign currency fluctuation. So therefore, guys, this is an operating income. Guys, go to operating income at this one, 125. You can, guys, write over there forex gain. Okay, if you want a detail, you can mark it over there and keep as this is a forex gain. Okay, so guys, this is the maximum that you have to do, guys, when it comes to this particular paragraph. That's it. No more than this we are going to mark. So because the transactions are not recorded, first recorded spot rate. Because it's not settled, please retranslate and pass your accounting entries. Right, now, guys, let's go for the next one then, next adjustment. Number 3. Guys, can you quickly read the paragraph, understand the lesson, and which item of the lesson or which part of the lesson? Right, decide that one, guys, quickly. Right. Read the entire paragraph I want you to first decide which standard. On top of that, what is the accounting area? Guys, what is the standard? Financial instruments. Good. So step one, understand the chapter. Okay, now guys, in financial instrument, what specific instrument are we guys looking at over here? Is it a financial asset or financial liability? It's a financial asset. Good. Guys, this is a financial asset. Now, financial asset also, guys, problem, we have two criteria. No? Financial assets, investments in equity, investments in debt. These guys, financial assets, investments in equity or debt, guys. We acquired bonds. It's debt. Bonds means, guys, loan, meaning we gave a loan to someone else. Okay. So this is a financial asset, guys, investments in debt. Now, guys, another problem. Investments in debt have three treatments. Okay. One is through P&L. Okay. One is through OCI. And then, guys, the other one is through what you can say, guys, over there, short-term investments or short-term for trading purposes. Okay. Guys, when you go through the entire question, can you guys tell me, like based on what are we going to do this one, guys? Now, we have three options. One is amortized cost. The other one is OCI. The other one is simple investment. Yeah, very good. That should be the answer, right? What do you think, guys? What is the method that we should go for? Guys, what is these people's idea? Exactly. Online, both are correct. Good. Okay. Right. Guys, they are planning to sell it or they are planning to keep it. Their plan is to keep. No, they are intending to hold until maturity. That means, guys, if that means business model test is passed, they are planning to keep it until the end. Technically, guys, if business model test is passed, cash flow test is also passed because they want to collect the cash and the capital. So if that's the case, you have to, guys, account this under amortized cost. If you're accounting it under amortized cost, that means, guys, remember all the transactions should be passed through what you can say the profit and loss account. Right. Guys, whatever that you know, can you guys start doing from this adjustment, guys, over here quickly? Right. So remember, guys, it's a financial asset, investment in debt through what method? Amortized cost method. Do the calculation, mark what you can. I will explain the entire thing. Okay, right. Start with you guys one by one. So if you have forgotten the amortized cost table, guys, you can look at your previous notes and start doing, no problem, because you're here, you're doing revision, no? Okay, right. So please look at the paragraph and start doing the adjustment, guys, related to this. Interest, no? 1 minute. Let me check on that calculation, what you did over there. Yeah, very good. Your interest calculation is correct. Now that you have the interest calculation, now you can pass the accounting increase. Guys, to be very honest, you all just have to calculate, do the amortized cost table. To be very honest, guys, you don't need to even complete the whole table. Okay. You just need 2 items. So once you get that, try to guys pass your accounting entries. That's pretty much it. Okay, guys, will I do the adjustment and show it to you? That little bit, see guys how far you are able to do. Right, guys, first thing, if you are doing amortized cost, this is the chart. Brought forward plus interest. Guys, this interest should always be what interest, guys? Effective, which is 8%, minus cash. Guys, cash should always be what interest? Nominal, which is the agreed, the legal rate. So the legal rate is 5%. Then this is equal to carry it down. Okay, now guys, listen. Step 1, when you do brought forward, it is proceeds. Proceeds means, guys, how much you are getting or how much you are investing plus issue cost. Okay, guys, not minus issue cost, plus issue cost. Guys, listen. If it's a financial liability, proceeds minus issue cost. But this is a financial asset, then the issue cost has to be capitalized. Right? So proceeds plus issue cost. So guys, proceeds of the loan is 9 million. We are getting 9 million. How much is the issue cost, guys? 400,000, 0.4 million broker fee. Then that's the issue cost plus 400,000. Guys, listen, for issue cost has to be capitalized, debited to the asset. But accidentally, guys, what these people have done, these people have gone and marked it inside operating expenses. Can you guys see that one? Which has been expensed to operating expense. That is wrong, guys. Okay, issue cost for financial assets, investments in debt through amortized cost. We are not marking it inside operating expenses. So can you guys quickly go to operating expense and remove this and show minus 400 from your profit and loss account. Okay, right. Please guys mark it over there. Minus 400 from P&L. Okay. Right, now guys, come back to the question. So the brought forward is 9,600. Now guys, can you check the effective interest on this 8%? So student said me the answer is 752 when you see 8%. Minus cash, guys, the cash will be 450 if I'm not wrong. Guys, how did we get cash 450? It's like this. When you're calculating cash, you have to look at simple aspects. Guys, how much should you invest on this company? We invested 9 million. We invested. Guys, when you're investing, you're not looking at issue cost and all of that. You're just basically seeing how much you invested. We invested 9 million. How much did that person promise to pay us? He promised to pay us how much percent? 5% he promised to pay. So guys, when you see for 9 million, 5%, what's the answer? 450. That 450 only I put here, and then you have to do the calculation, but it's not necessary. You don't need to actually calculate and get this answer. It's not needed. Okay. Right. Now guys, listen, normally this is what happens. This answer is a finance income. Okay. But guys, look at what the paper said. Vernon Corporation has recorded the interest received in investment income. Right? Guys, he has recorded interest received. Guys, tell me out of 752 and 450, which is the interest received? Interest received should be 450, guys. Interest received means how much, guys, you're getting to the hand actually. So what they did, what we are getting to the hand 450, they have gone and marked it in investment income. Not that it's wrong, but that's not the answer, guys. We should normally take inside investment income. Inside investment income, guys, we should normally take which answer? 752 we should take. So guys, to make it correct, what should I do? I should go and add back. Now how much I have to add back? 302. Exactly. Now guys, can you all go to now this part over here, investment income. To this, can you add, guys, another 302? Because guys, they put 450. Correct answer is 752, but they have put in investment income. Topic is correct. Because guys, you're investing in another company, no? So when you're getting that answer, it's an investment income through. So guys, once you get the answer, you have to add that to investment income. That's it. This is the only entry that you have to pass. Guys, remember, when you complete the table, you're getting a carried down now. This carried down should go to SOFP. Since we are not doing the SOFP, you don't need to worry about this particular part. Right? So this is all, guys, what you should do from cell. Two things. You have to remove the broker fee from operating expenses and add your income to investment income. Guys, are we all okay with the adjustment? Right? Check and let me know, guys, if any doubts that you have. I will clarify. Right? Others, you can, guys, now start doing adjustment number 4 and adjustment number 5 if possible. Okay? Guys, over here, adjustment number, okay, you can, guys, do both and show 4 and 5 without a problem. Whatever that you need is on the page. You don't need to look at the first page. Whatever that you want is on this particular page. Right? Please mark and show me, guys, 4 and 5. Again, guys, for some reason, I'm unable to erase what I wrote. It's coming back for some reason, right? And guys, it will be try to do 4 and 5 if possible. One is PPE, other one is investment property. So guys, today morning I explained no investment property where you have to go and mark. So think of that and, guys, mark it properly. And guys, actually guys, you're free to mark number 6 also. Even guys, number 6, you just have to mark it in one place. That's pretty much it. Okay. Have to mark it in one place. The seventh adjustment, guys, no need to do because that will affect our earnings per share. So you can keep that aside and finish off the others. Okay, guys, now look at the question. During the year, they revalued for the first time and an increase of 12 million. Guys, when you have a revaluation surplus in the income statement, guys, where you will normally mark which topic? Other comprehensive income. No, simple as that. Okay, now guys, can you go to other comprehensive income? Make sure you have written this one. And because it's revaluation for the first time, we don't need to worry about any last time losses, right? So first mark, guys, over here, gain on revaluation. Okay, right. And guys, what will be the answer for gain on revaluation? It's going to be 12 million. Okay, right. But guys, small problem for this 12 million, there is a what? Deferred tax. So guys, deferred tax, when you see 25%. So guys, 12 million, 25% will be how much, guys? It will become 3,000. Very good. But a double entry, guys, for deferred tax on revaluation, deferred tax account credit. I show you that part. So if I am to open a T account, no need T account, but I'm just showing you. In deferred tax account, guys, this will become credit. Okay. What is debit? Revaluation should become debit. Revaluation debit means from here, you have to subtract this 3,000 deferred tax. Okay. You have to subtract 3,000 from here and show. Revaluation account debit, deferred tax account credit. Okay. Guys, next part. Their investment property. That's it. That's all what you should do. Copy the 12 million gain inside OCI, see the deferred tax and deduct it from the revaluation. Right. Guys, then these people are using investment property using the fair value model. It has gone up. Guys, all syllabus, when fair value model, it goes up, we put it in other income. Today under IFRS 18, guys, we should put inside what income? Investment income. Very good. There we go. Right. Plus 4 million. Mark it, guys, over here if you want. Investment property fair value increase. Guys, if it's decreasing, still you will copy it there, but as a minus answer. That's it. These are the minor changes, but you should get used to. Okay. Right, guys, last part, tax. This is the current year estimate. No, guys. Now, normally current year estimate, what we do under our method, we take it to the formula. Okay, right. So, guys, then I will show you that part over here, how the tax part is to be done. Right. Because it's normally done this way. Now, usually in class, we do tax like this. No. If it's the income statement, we have an equation. What's the equation? Current year estimate plus under minus over and deferred tax movement. This is the equation that I normally follow when I do income statement. Okay, if it's tax for profit and loss account, you have to, guys, follow the equation. Current year estimate, guys, answer is 3.2 million. Copy this. And guys, tell me this answer, current year estimate, if we are preparing SOFP, where should it go? Current asset or current liability, guys? Current liability, right? Under and over provision, guys, look at this. The tax figure in the trial balance is under or over provision. So trial balance is your previous page. In our previous page, guys, this tax is coming on debit side. So we discussed before we start the question, if it comes on debit side, guys, this is going to be what provision? Under provision. So under provision, guys, will become positive. Now, guys, next part, deferred tax movement. Actually, guys, in this question, deferred tax movement is 0. Guys, listen, there is a deferred tax. I'm not telling no, but even though there is a deferred tax, guys, the deferred tax movement is 0. You know, guys, why? Look at this. Now, in deferred tax account, I marked 3 million on credit side. No, that was because of the revaluation. Now, guys, when you close this account, carried down is again 3 million. Carried down goes to non-current liability. Is there a movement then? No, that's why I'm saying, guys, over here, the deferred tax movement is 0. So now, guys, when you add these two, 3,330 will become the deferred tax. This should be the answer. Okay, 3,330. Under provision plus current year estimate, no deferred tax movement. Right now, guys, can you then put this one over here, please? Okay. So you can show the working over here if you want. 3,200 is current year estimate plus the under provision, guys. The answer will become 3,330. That's it, guys. Guys, remember the adjustment that's in the previous paragraph will not affect us. The next paragraph is earnings per share. That's not something for us to be worried about now. Okay. Guys, now can you guys please take your calculator, start getting guys total comprehensive income now, guys. Okay. Start doing the adjustments and please get me total comprehensive income. Let's check and see revenue. 75,350, 3,407 plus 1,875. So guys, revenue. Okay, is your answer guys going to be 8632? Correct. 8632. Right, cost of sale guys, we didn't have any changes whatsoever, so 46,410. Right. Our other operating income guys, 296 plus 125. How much guys? 421. Correct, no? 421 positive. Other operating cost guys, 20,240. Is it okay guys? Correct, no? Yeah. Our investment income, 4,000, 5,000, 5,500, 5,800, 5,822. Yeah, 5,822. Our finance cost, we only have guys 4,050. Right. Now guys, let's start getting the totals then quickly. Right. 80,632 minus 46,410. Gross profit guys, I am getting 34,222. Is that okay? Right. Plus 421 minus 20,240. Our I forgot to put an important topic. Operating profit is not inside my chart. We will lose marks nowadays when you don't put that. Okay. Right. So guys, is operating profit 14,403? Yes, no? Operating profit 14,403. Right. Then guys, after that one, profit before finance cost and income tax plus 5,822. Guys, I'm getting 20,225. After adding that, is it correct? After adding investment income, 20,225. Is it correct or is it wrong then? You're getting 16,000. Operating profit guys, is it correct? Oh, that's also wrong. That's okay. Investment income guys, 5,822. No? Okay. That means 14 plus 5 should become then almost 19. Okay, no? Yeah. Then after subtracting finance cost guys, your answer should be 4,050. Profit before tax will be 16,175. Okay. Income tax guys, the answer is going to be after subtracting that 16,175. Okay, after subtracting this one, I'm getting guys 12,845. That's the profit for the year. Then after that one guys, other comprehensive income 9 million. So when I add 9 million to this answer guys, I'm going to get now 21,844. Yeah, that's the correct answer guys. I just checked with the marking scheme also. That is the correct answer. Right, copy it down guys quickly. We have one more part to finish from that question, right? The earnings per share. Now guys, once you're done with that part, now guys, can you do the last one for me? Okay, done. Right. Now guys, can you start calculating guys this part over here? We need to now start doing guys, if I'm not wrong, earnings per share. Now guys, this is a right issue, right? Now guys, first of all, tell me, number one, when we guys do earnings per share, what's the normal equation guys that we should go for if it's earnings per share, right? The equation will be profit after tax divided by weighted average number of shares. Okay. Now guys, remember this business is doing a right issue. Now you know guys, in that lesson the most difficult part is right issue. Okay, because guys, now normally guys, when you do a right issue, you have to have a table like this. Now we need to have a table, date, details, okay, number of shares, the number of months, okay, and then guys, we need to have rights fraction, then only we'll be able to get weighted average. Then guys, can you remember, to get the rights fraction we have to do some more lot of work, right? That term and all of these we have to calculate, right? And normally guys, rights fraction, how do we guys normally get rights fraction? It's always active market price divided by term. Then to get term, we have to do another one calculation. Okay, right. So what I want you to do guys, I want you all to start now. I know remembering all this will be a little bit difficult. So if you want, you can look at your previous work, what we have done, and then start calculating and giving for me guys the rights issue. Guys, profit after tax, you should get the answer what you took now. Now guys, in your income statement, right, there is a profit after tax now guys. How much is that profit after tax going to be? 1 minute. Yeah. So guys, in our book, the profit after tax is 12,845. You should take this and only guys, and then start the question. Okay. You should take this and start the question. So profit after tax guys will be 12,000. Guys, once again, 845 or 485? 845. Okay. Okay. Now guys, can you look at this part and start doing now for me the rights fraction and all of these? Just try on your own. I'll give you around 5-10 minutes and then I will put the answer on the screen. Guys, last part, let's quickly finish this off and go for the break. Okay, now guys, you have to calculate TERP. Now guys, in class, when calculating TERP, we guys always created, so guys, what is TERP in the first place? TERP is something like this. When you go for a rights issue, in the future, the market price is going to fall. Okay, by how much is it going to fall is what we are calculating through TERP. Now guys, to calculate TERP, I would have done a table like this for you all this way. Shares, okay, and calculating TERP in class, this is what we did. We have shares, then we have what you can say the number, and then we have the value. Now guys, when it comes to shares in class, I gave you like this: holding shares, new shares. Okay, let's read the paragraph. On 1st of January 2008, Vernon had 30 million equity shares. So that one guys should come here. On 1st of January, these people had brought forward 30 million shares. On 1st of April, these people issued additional 5 million. Okay, 1st of April, we guys issued additional 5 million. Right, let me check that answer. Good. Okay, so guys, the total will then be over there 35 million. On 1st of July, these people had performed a 2 for 5 right issue. Okay, guys, 1st of July, there is a rights issue. Okay, 2 for 5. So guys, 2 for 5 means like this. Take the number of shares in your hand, 35 million. For this guys, you should see 2 for 5. So guys, for this, when you see 2 for 5 guys, what will be the answer? How many new shares are we creating? 14,000 shares we are creating newly. Are you guys okay with that part? When you do the right issue, we need to understand how many new shares we are creating now. How to do that? Take the existing number of shares and put the ratio. 35,000 shares guys we have in the company. The ratio is 2 for 5. So guys, when you see 2 for 5 guys, what should be the answer? 14,000 shares we are issuing. This happened on when guys? Actually July. July means number 7. Okay. That means when you add these both, end of the year, 49 million shares we have in the hand. Okay. 31st of December, carried down is going to be 49 million. Okay. Guys, now what you should do, put the number of months. Now, when you're putting the number of months, guys, some students, they make small mistakes like this. Guys, see, we started with 30. 30 then later became 35. Now, guys, 30 became 35 in how many months' time? Check and see, guys, your table. Okay, you started with 30 million. Now, we have to put the number of months, no? So, see, 30 became 35 in how many months' time? 3. So, guys, this should be 3 over 12. Because January, February, March, it was 30. Then only it became 35. Guys, 35 became 49 in how many months' time? 35 became 49 in how many months? That also 3, no? April, May, June. 3 months. That means, guys, here 3 and 3 means 49 million stood for 6 months. Okay. Okay. Right. Now, guys, what you should do to get the rights fraction, we need the active market price. Now, guys, active market price is going to be how much, guys? 3.1. Now, the challenge, guys, what we have is we need to get the TERP done. Okay. Now, guys, to do the TERP, we need to have a table this way. Okay. Now, guys, in this table, how to do? Shares, holding share and new share. Okay, now again guys, see, now problem, and I have filled the entire table. I need rights fraction. To do rights fraction, I need active market price, which is 3.1. Now I need TERP. To do TERP, guys, we need to have a table like this. You need to first see how many shares you hold to get that new. For that one, guys, you don't need to look anywhere else. You just have to look at your ratio. What's the ratio, guys, we are going for? 2 for 5. That means a person should hold 5 shares. Okay, sorry. That one guys should come here. 1 minute. Some guys not getting erased. No. Okay. A person guys should hold 5 shares. If he holds 5 guys new shares, how much he will get? 2. Okay. Now guys, here my table is actually wrong. This should be value and this should be total value. Okay. Guys, holding shares are 5. Now you should mark and show what is the price of this. Guys, holding means you have already bought it, no? So when you are buying, check your paragraph. There are 2 values. One is 2.4, other one is 3.1. Now 5 shares, guys, you have to show how much is 1 share value. Guys, holding means you have already bought it. If you're already buying it, means you're buying it at the new price or the old price. Old price, which is at the market price. Guys, 5 shares, if you're owning, you have paid the market price and no guys bought it. So you should take that. The new shares, you will be getting it at how much rate? 2.4. That's the discounted rate. So guys, when you are doing this answer, here it has to be holding share should be at 3.1. The new share should be at 2.4. Now guys, start multiplying. 5 into 3.1 guys, answer will become 15.5. 2 into 2.4 guys, answer will become 4.8. Now guys, total it up. Here it will become how much guys? 20.1. Here guys, it will become 7. Now guys, divide these two. That's your term. Okay, 20.1, divide this one by 7. Okay, 20.1, divide this one by 7. So guys, what's the answer? 2.87 if I'm not wrong. Is it correct guys? Here 20.3, no guys. Sorry. My bad. 20.3 divided by 7. It's coming guys exactly 2.9. Always guys remember how to check whether your TERP is correct or wrong. Once you get your TERP answer guys, it should always be less than the current market price. If it's more than the current market price, that means your answer is wrong. So okay, now our TERP is 2.9. So guys, I'll write it here 2.9. But guys, don't divide these two. You keep it as a fraction. Okay, once you get the right fraction guys, don't divide that. Just keep it as a fraction, 2.9. There's now last part. Our rights fraction is this much. Now, where should I apply the rights fraction? In class guys, I said you this way. Bonus fraction and rights fraction must always be applied top of that particular event. In simple words, now guys, when you look at the table, I'll change the color. Rights fraction is guys happening at this point now. Right? This is for both bonus fraction and rights. Now, when you do a bonus issue, guys, we have bonus fraction. When you do rights issue, we have rights fraction. We have to guys apply this. Where should you apply? To all the shares top of the event. In our case, because it's a right issue, guys, top of the right issue, there are some shares. No, you should apply it for that. That means here, can you see a 3/12 is there? Apply for this 3.1 into 2.9. Guys, not only for that, you have to apply for the one above also. 3.1 divided by 2.9. Because guys, now see, top of the rights issue, we have, do we have 2 actually? Yeah, we have 2 transactions now guys. So for both of these, you have to apply. This is the rights issue. Top of this, we have 1 month and we have 1 month here. So for both of these, now you have to apply. Guys, once you apply, now what you do, take your calculator, this one into this one into this one. 35,000 into this one into this one. 49,000 into 6/12 guys. Now show your answer. Guys, again I'm telling you, rights fraction you should apply for the ones above, not for the ones below. Always for the ones above only you have to apply. Okay. Now guys, start multiplying this one now. 3.1. 30,000 into 3/12, that into 3.1 divided by 2.9. Guys, over here, I think we're getting all decimal numbers. No, guys, the answers. Here, guys, is it 8,017? Yeah, correct. This one, guys, 35,000 into 3/12, that into 3.1 divided by 2.9. 9,000 353. 49,000 into 6/12. Here guys, perfectly 24,500. Now guys, add everything. 8,017 plus 9,353 plus 24,500. Guys, I'm getting 41,870 as my weighted average number of shares. Now guys, take this answer and put it over here. Now check and see guys, what's the EPS? Guys, can someone tell me guys, what's the profit again? 12,845. No, I believe. This earnings per share is more harder than the real income statement itself. I'm getting guys the answer $0.307 approximately. Yes. Ahmed, you sent me the answer long time back. Your answer is correct, right? This should be guys the earnings per share. 0.307. Right. Check on these guys. It was a tough part, the EPS, especially because it's a right issue. Right issue means there's a lot of work to be done. Okay, copy this. Ask me if any doubts. If not, guys, you can go for a lunch break. Come back at 1:30 and then we'll continue. If any doubts that you want to ask, guys, you can ask. I'll stay and I'll clarify and I'll go. Others, you can go for the lunch break. These workings, you can either show it on the scratch pad, right? Now, normally what happens is this. In your real exam, for B part, there will be another space. Okay, now A part is spreadsheet, no? So then you will do on the spreadsheet. Sometimes for B part, they'll give a separate space, or maybe on the spreadsheet itself, you put B part and do everything and show on the spreadsheet itself. Okay, that's how you're supposed to do it. Don't do it on a scratch pad, do it on a spreadsheet itself, all of these and show. Sometimes two separate areas will be given. If not in one Excel sheet, like this itself, you can just put part B, right? And you keep doing the entire thing on the paper. Okay, that's how the real exam you have to do it. Here I did it on the paper, but in the Excel sheet, you have to show all of this. All okay. Okay, so let's go for the break and come back. Okay, so I'll just keep this one here. After the break, guys, another one question we'll be doing. All right, okay. It's like this. If the final answer is correct, they'll give you the full mark. Okay. But let's say if the final answer is not correct. Now, there is a 5 marker. No? If the final answer is not correct, then they will be going through your workings and see which are the areas that is correct. Now, if I'm to little bit look at this marking scheme over here, see. Okay, right. Yeah, if your final answer is correct, they'll give the full 5. Okay, but if the final answer is wrong, then they will go back and check your workings and see, did you get the term correct? Did you get the weighted average correct? Then they will check on those and they'll give marks. So if you have the time, I would recommend you to show the workings. If you don't have the time, then just show the final answer over there. Okay. So guys, and let's do one more question on single entity financial statements. And I think maybe with this we can finish off the class, right? We'll check and see. So next week, guys, focus will be purely on ratios. Okay, next Sunday. Right. Okay. Now, guys, can I guys go for this question, guys? 429. Right. Let's go for this question. Right. Now, guys, in this question, they are asking from you not profit and loss account. Okay. So if profit and loss account is not there, then it means that, guys, there are no changes. It's like our old question. IFRS 18 will not be applicable at this point. Okay. Right. So, guys, they are asking the schedule of adjusted profit, statement of changes in equity, and statement of financial position, right? Shall we guys then quickly keep the formats ready then for that part? Okay. So guys, then can you go to a new page? Right. So start writing guys the question. Required A guys, they need adjusted profit. Okay. So I think long time we haven't done adjusted profit part. Right. So guys, then put the heading draft profit. Leave around 6 to 8 lines, and then guys, can you put the heading corrected profit? After that one guys, B part, we want statement of changes in equity. Statement of changes in equity. Okay, what's the year ended guys for this question? Let's check that and see. The year ended is 31st of December 2005. Okay. Guys, write down details. Let's see guys, what are the topics that this paper is providing us? Right. So guys, for the time being, I can see details. We have equity share. Okay. Then guys, I can also see a share premium. Then I can see there is a retained profit. Maybe guys, there will be a revaluation also, I hope, right? Revaluation. And then guys, we have retained earnings. Right. These are the columns for statement of changes in equity. Right. Then guys, after that one, we have to prepare the SOFP. Right. Then guys, have that also ready then. Statement of financial position as at 31st December 2005. Okay. So guys, we have non-current assets. Okay. Then guys, we have property, plant and equipment. Then guys, leave a few lines. Then we have current assets, then total assets, equity and liability. Then guys, we have equity, equity shares, share premium, retained earnings, revaluation reserve. Then guys, we have non-current liability. After that one guys, we have current liability. Right. Okay. And then guys, total equity and liability. Now guys, after we do this question, I will then teach you for IFRS 18, what is the change for cash flow statements. So guys, remember SOFP, no changes, notes, no changes. Anyway, notes are not there in our syllabus now. Okay. What's the other one guys? Statement of changes in equity also, there are no changes. The change is in income statement and cash flow. Cash flow guys, I'll teach you today before I finish off the class, what is the change that we have. Then next week, we'll focus on ratio, conceptual framework measurement, plus sustainability standards. Okay. So share the WhatsApp group now. Now guys, if the format is ready, we'll then start this adjustment. So guys, remember this paper, they are asking adjusted profit, okay, statement of changes in equity and statement of financial position. These are the three things, nothing to do with the IFRS 18 part, okay. Like basically there is no impact, okay. Right. So guys, what we will do, okay. Okay, let's start guys. Okay, we'll start from this part. Shall we guys go from bottom to top? If we go, that will be a problem. Okay, let's go normal order, will you, right? Let's go top to bottom, will you? Okay. Okay. Now guys, I want you to make a small note of things. If not, what's going to happen? The question is in 2 pages, no? So when we go up and down, online students, sometimes you might not be able to see what's happening. Okay, right? So guys, just take a note down somewhere in your paper, right? So I'll just mark it on the side and keep for your reference. Right now, see land and building, right? Only type anything for the sake of the online students, right? We have guys land and building. Okay. The land cost is 50 million. Okay. And the total amount is 200,000. All good, right? Then guys, plant and equipment. Wait, how can I show you both at the same time? Okay, let's see video. Right. So guys, online students and also guys, you all also, can you all guys try the first adjustment over here? Okay, start off with that one, right? So I will give you the important information guys, what you need. I'll just copy it to this side and keep, and based on this, you can now start adjustment number one. So adjustment number one guys, there's a lot of calculations that is involved there. You do what you can, I'll explain. Okay. Okay. So whatever that you need from the previous page, I have copied to this page and kept. So you can just look at only this part and help me to get the answers guys for the first paragraph. So you need to guys do a few things. There is a revaluation involved. Okay. Right. Then guys, after the revaluation, there is a deferred tax involved. Okay. Then I can see guys, there is also an excess depreciation being involved. Plus, you also guys have to do normal depreciation also. Okay, so from the first paragraph, these are the four things that I want you to try. Okay, you start, you do what you can, and then I'll explain. Right, start guys, this one then. Find these four things, revaluation, deferred tax, excess depreciation, normal depreciation, all of this. Okay. Okay, so now when I copy pasted, 200,000 belongs to land, 320,000 belongs to plant. Okay. Right. Okay, so let me explain these adjustments, what you have done. Check your answer. Until 1st of Jan, S is holding land and building at cost. On 1st Jan 2005, now guys, I forgot to do a basic thing. Now guys, see, this question is finishing off on 31st of December 2005. That means this paper also starts on 1st Jan 2000x5. Jan start, December end. Now guys, this event is happening on 1st of January, right? On 1st of January, guys, what these people are doing? These people are doing a revaluation on 1st of Jan. So normally, guys, when a revaluation happens on the first day, first you do the revaluation gain or loss. Don't do depreciation, okay? Because on the first day, if you do a revaluation, you should first find revaluation gain or loss, right? Now, guys, normally how do we find revaluation gain or loss in accounting? This is the equation. Revaluation gain / loss. First, you take the cost, deduct the provision for depreciation, then guys you will get carrying value. Then what you should do, carrying value must be compared to the market value. Okay, so once you get the carrying value, guys, what you do, you compare this to market value. Now guys, these people are revaluing both land as well as revaluation. Sorry, land and building. Both are revalued. Okay, so let's start. Now guys, I'll do it separately over here. Land separately, building separately. Okay. Now guys, first of all, in the previous page trial balance, they are telling land and building at cost is 200,000. From this, land is 50. So guys, you should understand, if the land is 50 million, then the building separately is how much? 150 million. Provision, guys, you always know, no, land doesn't have provision, only building only has provision. Okay, so therefore guys, now remember, land carrying value will still be 50 million, building carrying value will be 60 million in that case. Now guys, compare this to the market value. 150 minus 90 is 60, right? Yeah, that's 60. Okay, right. Now guys, they valued it to 250, out of which 80 million belongs to land. Guys, out of the 250 million, 80 million belongs to land. That means, guys, how much should belong to the building in that case out of the market value? 170. No, 170, guys, should belong to building. Are we guys all okay with that part? 100, because guys, see, out of 250 million, 80 million land is taking, no. So from 250, guys, if 80 goes, what's remaining? 170. That means 170 is only for building. Now compare. 50 million land became 80 million. There is the 30 million revaluation gain. Okay, 30 million revaluation gain. Okay. Then guys, 60 million worth building today became 170 million. That means, guys, there is a gain of how much? 110 million. There is a gain for what? For building, there is a 110 million gain. Okay. That means, guys, when you do the revaluation, what's the total gain that we have? We have a total gain of 140 million. Okay. Land went up by 30. Building went up by 110. Total gain is how much? 140 million. Now guys, see, normally if you have a revaluation gain, right, at least the first time that they are revaluing, right, all these while we were always holding them at cost. Guys, when you have a revaluation for the first time, you don't need to worry about last time loss, no. So normally, guys, if there is a revaluation gain, where do we guys normally go and mark? Income statement, where do we show guys revaluation gain? Other comprehensive income. But now guys, tell me, today are we doing other comprehensive income in this paper? No, right? In this paper, we don't have other comprehensive income. Why guys, we don't have other comprehensive income? Look at this. In this paper, right? Okay. When I guys show you the requirement, what's the first requirement? Draft profit. In profit, we only mark income and expenses. There guys, you can't show other comprehensive income, no. So now guys, understand carefully. Other comprehensive income technically should go inside statement of changes in equity. But when you're writing, I want you guys to write it this way. Total comprehensive income. Because in SOCE alone, we can't write other comprehensive income, no, right? So guys, total comprehensive income, can you guys write here working number 1? Okay, total comprehensive income, put there working number 1, right? Okay. Right, now guys, separate, let's open a working number 1 guys in our paper. I'll show you on the side working number 1. Okay. Guys, normally total comprehensive income guys is the combination of what and what in accounting? Profit and OCI. Right? First put the heading guys, profit. Okay. Guys, profit I will get from here, drafted profit. Right. Then guys, put the heading OCI, and below this can you write and show now gain on revaluation, how much? 140 million. Why are we showing this separately? Because guys, remember in this paper for OCI there are many adjustments. Yeah, there are many adjustments. So because of this reason, I'm opening a working separately. If not, no need. Because there's a deferred tax and also there is what? Excess depreciation. So everything we should account now. So that's why I'm opening a separate working on the paper. Right? Okay. Right. Then guys, let's move on to this part then. So these are the workings that I need so far. Right? Done. Okay. Now guys, I'm going back to the question paper. Right? I'm going back to the question paper. Right, now guys, remember, because this is such a big question, remember guys one small thing. When you do a revaluation, now the value of this asset will change. Right, because guys, remember we are doing SOFP, there we should show the PPE. So remember guys, once you do a revaluation, the value of land and building will change. Now hereafter guys, land and building new value is how much? It's none other than 250 million after revaluation. Because if you revalue guys, value will change. No, so guys, I'm updating this value. I'll cut from the book and I'll make it 250 million. Guys, one more thing, you know this. When you revalue, what happens to the accumulated depreciation? It has to be cancelled off completely. So this 90,000 guys, I'm going to cancel. Why we are cancelling? When you revalue, the provision has to be eliminated. So I'm cutting this from the book. Because remember, I need to keep all of this in my mind when I do the SOFP, because we are not doing a separate PPE table now in the marking scheme, they're on a PPE table. But when you guys go to do a PPE table, sometimes it's a little time consuming. So make these adjustments then and there in your paper or that scratch pad or whatever. Now we are done with that part. Then guys, what's happening after that? Right. No entries has been made to incorporate this. The buildings have a remaining useful life of 20 years. Okay. Guys, if they give 20 years, they want you to calculate what guys? Depreciation. But guys, now you have to be careful. Land and building together is 250. Out of this 80 million is land. Land guys, do we depreciate? No, only the building has to be depreciated. That means guys, building 170 million worth building, remaining useful life is 20 years. Now divide by 20 and guys get your depreciation. Okay, right. 170 million worth building, when you divide by 20, what is the depreciation guys? 8,500. Guys, remember depreciation is what? An expense. Can you guys make sure you have marked it over here in the Excel sheet? Right, drafted profit. Depreciation of building. If you haven't marked guys, now you can copy it with me. Minus 8,500. Done. And guys, remember, because this depreciation will also, what you can say guys, affect my SOFP, guys, I'm going to keep a note over here. If not, what I'll do is I will forget. No, right here guys, I'll now make my accumulated depreciation 8,500 over here. Because guys, what's a double entry for depreciation? Depreciation debit, no? So we put to drafted profit. Provision for depreciation credit. So now I'm updating my provision and keeping 8,500. Done. Right, let's move on to the next part. Deferred tax is 20%. Right, now normally guys, deferred tax should be calculated on what guys? Revaluation gain. On that only you should see deferred tax. Right, now guys, can you start doing it with me? Right, go to the other comprehensive income. Right, now guys, start writing here then. Okay, deferred tax. So guys, remember deferred tax, we normally check on what? Revaluation gain. Guys, what was the tax rate once again? 20%. Now guys, for this one, see 20%. 10% will be 14,000. 20% will be 28,000. Mark it guys over here. Minus for other comprehensive income, 28,000. Okay, guys, what's a double entry for deferred tax on revaluation? Revaluation reserve debit. That's only what you did now. Minus from revaluation. Guys, what should be credit? Revaluation debit. What has to be credit, guys? Deferred tax has to be credit. Remember, guys, deferred tax is a non-current liability. Make sure, guys, you have written it over here. Deferred tax. Open bracket and write 28,000. Because, guys, we don't know whether some more adjustments are there. No? So, under non-current liability, guys, make sure you write 28. Guys, when you do financial statements, try to pass double entries as much as possible. Because when you pass your double entry in your mind, you know, okay, I have marked this, I have marked that, so that you don't miss out on anything. Okay, so guys, mark it over there. Deferred tax 28,000. Okay. Then guys, what else now they have said in that paragraph? Let's check and see. Okay. S has a policy to make annual transfer in respect of additional depreciation. Prior to the revaluation, the buildings were depreciated over 50 years. Right now, guys, listen. Additional depreciation is what we call, guys, excess depreciation. This will come when there is a revaluation gain. Now, guys, listen. In class, to calculate excess depreciation, guys, I have taught you two methods. Method number one, new depreciation minus old depreciation. That's why they gave the 50 years useful life. But rather than, guys, going for this method, you can go for another one method this way, which is because you already have all your answers with you. Another one thing, guys, what you can do, you can take the revaluation gain and divide this one with the remaining useful life. You will still get the same answer. Because, guys, now what I have seen in paper so far is that mostly you can't go for this method, the first method, because new depreciation will be there, but this is very rare in the paper, finding the old depreciation, because, guys, in papers they don't give the normal useful life. So when I taught you in class, I recommended you always, guys, go for this option. But if you can go for the first option, go for that. If the data is not there, guys, then you should learn how to do second option as well. Guys, because we are doing revision, I will do and show you both methods. Right. Starting, guys, you go with new depreciation. What's a new depreciation, guys? 8,500. You take that. That's the new depreciation. Minus old depreciation. Guys, how to get old depreciation? Before revaluation, what was the value of the building? 200,000. How 200,000? Guys, look at this value. Sorry, my bad. Not 200,000. Before revaluation, it's 150,000. Because, guys, see, land and building is 200,000. Land is 50, no? Then, guys, can you see? Building is 150. So, the old depreciation will be cost 150,000 divided by old useful life. What's the old useful life, guys? 50. Now, check and see, guys. 150 divided by 50, answer is 3. That means additional depreciation is 5,500. No? That should be the answer. Right? That's the additional depreciation. But in some papers, you can't go for this method. Then what you should do, go for second method, revaluation gain. Guys, listen, revaluation gain, don't take 140 million, you should take 110 million. Because 140 is for both land and building now. Only building now has excess depreciation. So now, guys, what you should do, you should take the building revaluation gain, which is 110,000. Now, guys, I'm doing second method. 110,000 divide by remaining life. Guys, in the paper, what's the remaining life? 20 years. Divide by 20. You will still get how much, guys? You will still get 5,500 as the answer. Right? This is the answer you will be getting. So, regardless of the method that you go, new minus old or the second method, answer has to be same, 5,500. Right. Now, guys, what's the double entry for excess depreciation accounting? Double entry, guys, will be revaluation reserve debit, that means revaluation minus, retained earnings credit plus. Where should you show this in the exam? Inside your statement of changes in equity. That's where, guys, you have to show the excess depreciation. Right now, guys, let's show it together then. Take 5,000. Okay, first of all, guys, copy down the working that you want. Then I can quickly mark the answer and show. Okay, right. Now, guys, how to show excess depreciation? Right. Yes, can all of you go to this part, guys? Statement of changes in equity. Right there, guys, can you show now excess depreciation? What's the double entry, guys? Revaluation debit. That means minus from revaluation reserve. And retain earning credit. That means, guys, retain earning should become plus. Okay, this is a double entry for what? Excess depreciation. You have to, guys, always show this inside SOC, not anywhere else. Right? Always show this inside SOC. Right. So, guys, remember that adjustment is still not yet done. Let's see now, guys, what are the other things that we have. And now, guys, plant and equipment is depreciated at 15% on reducing balance method. That's an easy one. No? So that one, guys, how you should do plant. It's like this. Reducing balance method means take the cost of the plant. Then, guys, subtract the provision for depreciation. Right. What is the percentage, guys? They said 15. Then see 15% for this. Now, guys, when you see 15% for this, what's the answer? 320,000 minus 111,200. That into 15%. Is it, guys, 31,320? Yes. Guys, once you get the answer, this depreciation, no, what's a double entry? Depreciation account debit. Depreciation debit means, can you guys make sure you have written it here? The drafted profit calculation. Depreciation of what? Plant. Minus 31,320. Okay, depreciation debit. And then, guys, what should be credit? Provision has to be credit. Guys, provision credit means to the existing provision, you should now add this and show. Okay, to the existing provision, you have to add this and keep. Right. So, guys, this is everything what you have to do from the first paragraph. Start with revaluation, find current year depreciation, deferred tax, excess depreciation, the depreciation for plant. So 5 things we have done in the first paragraph. It's a very big adjustment. Right. Any doubts that you want to ask, guys, regarding any value, you can tell me, then I can explain. Right. Guys, others, can you start for me now? Adjustment number 2. It's a foreign currency related transaction. Start this one, guys, over here. Right. So, guys, over here, like before the break, we did a foreign currency transaction. No? You all have to do 2 things. First thing, guys, no, actually, you all no need to do 2 things. You all only have to do the retranslation. That's it. Now, guys, before the break, I did spot rate and translation. In this question, I only want you to do the retranslation because the paper said the company correctly recorded the purchase. So if they correctly recorded the purchase means the spot rate has been accounted. What you should do is you have to pass the accounting entry at the end of the year. End of the year is basically what? The retranslation. Right. Can you guys pass the accounting entry for this one then? Second adjustment. Yes, can you check your answer guys for this part? Right, now guys, what happened? S bought inventory from an overseas supply on credit. So guys, this is basically what? Credit purchases. Okay, it's a credit purchase. Right, now guys, we bought on 31st of October for 40 million. That time the exchange rate is 4:1. So again, no matter what type of situation guys you do foreign currency, step 1, we should always record the transaction at spot rate. At spot rate, the answer is $10 million because it's 40 million dinar. No guys, when we are buying the stock, the exchange rate is $1 is 4 dinar. So 40 million divided by 4 guys, for 10 million only we have bought the product in terms of dollars. That time guys, what will be the double entry? The double entry will be guys, purchaser's account debit, trade payable account credit, because this is a credit purchase. But the paper says they have correctly recorded the purchases. Now guys, if they correctly record the purchase, you don't need to worry about that part. Now guys, at the end of the year, we haven't paid. The paper says we made the payment, but we made the payment guys on when? Jan. Our paper is finishing on when? December. So guys, at December, have we made the payment? No. Guys, when you don't make the payment, it's an unsettled transaction. Purchaser's debit, that is inventory. That you don't touch. Because guys, purchase is inventory. Inventory is what item? Non-monetary item. So if it's a non-monetary item, you don't need to retranslate. But trade payable guys is what type of item? Monetary. Then what you should do, you have to retranslate this and see, because this is unsettled. So when you're retranslating, you should see what's the rate at the end of the year. So guys, at the end of the year, it's not this one. At the end of the year, guys, the rate is 1:5. So now guys, again, retranslate now. Right, 40 million divided by 5. That means guys, now how much we have to pay for this person? Now we have to pay 8 million only. So guys, earlier I had to pay for him 10 million. Now I had to pay for him only 8 million. That means guys, is it a foreign exchange gain or loss guys? It's a foreign exchange gain of 2 million. Because when I bought, I had to pay 10 million. Now after retranslating, I only have to pay for him 8 million. 2 million foreign exchange gain. So what you should do, because it's a gain, step number 1. Guys, can you go and mark this and show in drafted profit adjustment quickly? Right? Please go to your drafted profit. Start writing here. Forex gain. How much? 2 million. 2,000. Okay. So guys, when you mark it inside Forex gain, what will happen? Income statement will become credit. Okay, right. Then guys, that 2 million, where should it be debit? Or maybe that 2 million, where else should we guys go and adjust? We should adjust it to whom? Trade payable. Because of trade payable, no guys, we retranslated in the first place. So trade payable now should be adjusted. Guys, now think, if it's a foreign exchange gain, should I add to trade payable or subtract from trade payable? What do you think guys? We have to subtract from trade payable. Okay, forget this value. Foreign exchange gain, no. Then foreign exchange gain credit. Now you said me trade payable, then trade payable will become debit. In accounting guys, trade payable becomes debit, means he is increasing or reducing. He is reducing. Liability debit, no, then it's reducing. Right. So guys, go to trade payable, go to current liability, write trade payable. Still I don't know how much is my trade payable, no, so just put minus 2,000 over here and keep. Once we get the original answer, let's adjust it and take it. Right, minus 2 million for trade payable. All okay. That's all guys, what you should do in this adjustment. Nothing apart from that. You should find the spot amount, retranslate, there is a gain, pass a double entry for the gain, simple as that. Okay, now guys, let's move on to the next adjustment then guys over here, right? Adjustment number 3, right? Start this one guys over here. Interest on loan is paid every 6 months with the next payment due on January. The draft profit before taxation includes the first payment made on 1st of July. Okay, right. Now guys, the loan is 7% interest. How much is the loan? 30,000. So guys, what does the paper say? We haven't marked the interest for how many months? We haven't done the adjustment for 6 months. So guys, can you see the 6-month adjustment and quickly mark it and show guys faster? Okay. The interest for 6 months you haven't accounted. Can you please account it and show guys for 6 months faster? The 6-month payment is to be made next year. So they haven't done 6-month payment. Please try and finish it off guys quickly. 6 months adjustments for interest. Should not take you guys that long. Take around 2 minutes and please finish it. Correct, good. Guys, is the interest 1050? Correct, no guys, because what happened? 3000 into 7% guys will give you 2100, but the paper says we haven't accounted only for how many months guys? Only for 6. So into 6 over 12, answer is 1050. Good. Guys, 1050 guys, what do you think? Interest, income or expense? It's an expense. Loan, no. So first thing guys, what you should do guys, go to drafted profit. Start writing guys over here under drafted profit. Loan interest minus expenses, no guys, so profit will go down minus 1050. And then guys, during this year, has this interest been paid? During this year guys, did we pay the interest? No, so therefore guys, this will become interest payable. Accrued interest, this one guys should go for other payable. Guys, can you update this to trade and other payable guys, because in the question paper also it says trade and other payable. So guys, for this one now, can you add 1050 because it's accrued interest? At 1050 for this. All okay, no guys, so that adjustment is also done. In this paper guys, the first adjustment is only very difficult. Okay. Right, then guys, let's go for the next one. Adjustment number 4, tax. A provision for income tax is required for the year ended. Okay, guys, listen, always in your exam, the moment you see tax, remember it this way. For tax, it's always guys ideal if you can do this formula. Because when you do the formula guys, there is no place where you can go wrong. Right? Current year estimate, add the under provision, subtract the over provision, then see for any deferred tax movement. Then this is what we call guys tax charge. Let's go slowly. Right? Have the equation guys ready? We'll do it together. Okay. Okay. Let's start guys. Number 1 guys, current year estimate. Guys, read the paragraph. What's your current year estimate? They're telling how much it's going to be. 30 million. Correct or wrong guys? First put 30 million guys faster. 30 million. Then the balance in trial balance. Guys, let's go for the trial balance. Search for taxation. Trial balance. Right, I have guys over here current tax. It's on the debit side. Guys, if the tax is on the debit side, guys, what do you think about it? It's under provision or over provision. Debit means expense. Expenses means under. Credit means income, then it's over. Right? So it's an under provision, guys. Put it over here, 2.5 million. Right. Okay, done. Guys, now deferred tax movement. Now, the moment you see deferred tax movement, first thing you will remember, okay, in my paper, there was a deferred tax of how much, guys? 28 million, there was a deferred tax. Can you guys remember on the revaluation? But guys, like this, now when you get deferred tax movement, to be very honest, you have to open a small T account. Don't open, I'll show you, right? If it's deferred tax movement, we should open a T account. Normally guys, in the T account, we start with the brought forward. The brought forward, they should give in trial balance. Now guys, let me check my trial balance. Deferred tax. Do we have? No. Then guys, it will become 0. Okay. Then as a student, you might now start thinking, okay, we had a deferred tax of 28 million. What will happen for that? Can you guys remember that 28 million was a double entry? Revaluation debit, deferred tax credit. Okay. Then revaluation deferred tax 28 million. Then guys, you need to close the account and you will be getting a carried down of 28 million. This carried down of 28 million only guys, I went and put it inside non-current liability. Now guys, in this T account, debit side and credit side, is there any movement now? No, that means deferred tax movement is 0. Total tax charge will now become 32,500 in your income statement. Right. Now guys, take this tax and guys, I forgot one more small thing. Guys, tell me, current year estimate, after you copy it here, where else we have to mark this? Current liability in SOFP, always do that now, don't forget, right? I forgot when I'm doing the adjustment, right? Now guys, let's start now updating this one quickly. And the answers work, right? Okay. Right, let's start. First of all, guys, under, wait. Okay, under non-current liability, guys, first I should have a deferred tax. Okay. How much is a deferred tax, guys? 28 million. Right. Then, guys, under current liability, guys, can you write here now current tax for me? Right. How much was the current tax answer, guys? 30 million. No, if I'm not wrong. Okay. And also, guys, over here, I marked another one thing which is missing, trade and other payable. Guys, for 2000, how much did we add again? I believe 1050. No, guys, we added. Yeah. Okay. Right, guys, now tax, check your book. Huh? Under current liability, guys, first write here, will you? Current tax 30,000. Done. And then, guys, over here, in your adjusted profit now, guys, can you write here? Tax. What is the answer? 32,500. From where did we get 32,500, guys? That formula's last answer is there, no? From there only we got 32,500. Okay. Guys, last part. But guys, I'll recommend you a small thing. Before we do the last part, because it will make my work easier, shall we guys first copy down all these numbers one by one and then let's do the last adjustment, because then it will be easier for me to explain. Right, now guys, let's start now. Okay, land and building and plant. Guys, can all of you all guys go to property, plant and equipment over here? Right. Go to PPE. Okay, now guys, start copying with me. Yeah, right. Land and building, guys. After evaluation, we updated the answer as 250. First copy here 250. Done. Land 250. Plant, the value never changed. Copy this one down, plus 320. That's the total cost. Okay. Then guys, building depreciation, we cancelled out on revaluation. Then after revaluation, we got 85. Mark there, guys, minus 85. Why minus? Because we are finding carrying value. Okay. Guys, take out your calculator. Plant, can you guys update and give me the provision, guys, over here? Plant, update and take provision. 111, 144, 144, 520. Little bit check and see that how much will be the provision over there. $142, 520. No, guys. Yeah, so mark there, guys, minus 142, 520. That's the provision. Later we can update, right? Inventory, guys, copy it inside current assets. Inventory, 115,000. Trade and other receivables. That also, guys, copy current assets. Trade and other payable, guys, copy this one, guys, current liability. Guys, you have to be careful. Basics of accounting. Bank is on credit side. That means, guys, these actually what? Exactly. It's a bank overdraft, current liability. Okay. Again, guys, see, bank is on the credit side. No. When bank is on credit side, we call it a bank overdraft. Okay. 16,200. Guys, current tax is already done. Loans. Guys, copy the loans inside non-current liability. 30,000. All good? Right up. Guys, last part. Equity share and share premium. Guys, now look at this carefully. Yeah. This equity share and share premium, have they guys mentioned the date for you? No. That means this is what balance, guys? Opening balance or closing balance? Closing. When they now see retain earnings, they are mentioning first, no, then that's opening. If they don't mention the date, guys, remember equity share and share premium, guys, that is actually the closing balance. So, guys, can you write here as carry it down for me over here? Carry it down, equity share 120,000. Share premium, guys, will become 5,000. Okay. Retain earning, guys, that's the opening balance. So put it over here, brought forward. 158, 150. Last one, guys, draft profit before tax. That only, guys, should come over here, first line. 166, 450. Okay. Then, guys, this paper's last adjustment, and then, guys, we can balance it off, right? Guys, now can you try to do, guys, this last part over here? Last adjustment of the paper. It's a right issue. Start doing this one. Right now, guys, please check your answer, guys, for this part over here. Rights issue, what's going to happen is this. Now, you should not make this mistake. So, guys, what they're telling on 1st of September, they made a 1 for 5 right issue at 1.25. Okay. And it's already including trial balance. Okay. Now, guys, first thing in our trial balance, what's the answer for shares? Okay. Shares are 120,000. Okay. Guys, now see this what's happening, right? Your share capital and share premium brought forward, carried down. Carried down is, guys, 120,000. One share is $1. Understood? Right. Share premium, guys, what's going to be the answer? The paper says share premium is 5,000. Okay, share premium is 5,000. Right. Now, guys, in this paper, the business has gone for what type of an issue, guys? They have gone for a, is it a right issue, guys? These people have gone. Yeah, a right issue of 1 for 5 at 1.25. Right. Now, guys, understand, they have gone for 1 for 5 now. This 120,000, the paper very clearly tells you the right issue is already inside this. Guys, now tell me, if the right issue is already inside this, means this is representing 1 over 5 or 1 over 6. Exactly, it represents 1 over 6 because understand it's like this. Brought forward is there now, that is 5 parts. That means if a person has 5 shares, 1 share he will get that right. Now this right issue is already inside this now. That means this represents how many parts? 6 parts of the business, right? So always remember, guys, closing balance will always represent 1 part more than the ratio, because inside that already the right issue is there. So what you should do, guys, first 120,000 you should, guys, divide by 6. So, guys, when you divide by 6, what will be the answer in that case? It will become 20,000. Okay. So the 1 part is then equal to 20,000. That means, guys, the brought forward of the share should be equal to then 100,000. Guys, not only that, listen carefully. This 20,000, they issued it for how much actually in the paper? They issued it for 1.25. So out of this, guys, 1 is the nominal value. 0.25 is premium value. So 20,000, guys, when you see 0.25 into 0.25, what will be the answer in that case? I believe it's going to be 5,000. That 5,000 will come here. So now, okay, now this one plus this one is equal to 120. This 5,000 only came over here. This is how, guys, the right issue has to be accounted. In your statement of changes in equity, guys, these must be shown. Right, copy this down, guys, quickly. This is how the right issue was supposed to be done. So, guys, now let's show these answers then in the Excel, right? SOCE, right? Start writing, guys, over here, then rights issue. Equity share is 20,000. Share premium is 5,000. So the brought forward, guys, over here 100,000. And the brought forward, guys, over here will become 0. Okay. Right. Now guys, with that the question is all done. Right. First of all guys, can you quickly get the corrected profit? Right. Let's do this part guys over here faster. Corrected profit. 166,450 minus 8,500 minus 31,320 plus 2,000 minus 1,050 minus 32,500. Check the corrected profit. So guys, I am getting the corrected profit as 9580. Yeah, 9580 should be the answer. Okay. Right. Guys, now see this 9580. I should guys now no need to copy, but I'll just show you 9580 goes here because we are doing working number one total comprehensive income. No, so see under total comprehensive income, profit is this much. Can you guys write it here in retained earning properly? 95,080. Copy that to retained earnings. Then guys, what you should do, OCI 140 minus 28. Check and see guys what will be the answer then. 140 minus 28 for OCI. It will become then 112. 112 guys should go over here as revaluation under total comprehensive income. 112,000. Okay. Normally guys, total comprehensive income is profit and OCI. No, profit will always go to retained earnings. OCI answer will always go inside revaluation reserve. Okay guys, listen. Now only thing what you should do is like this. Look at the screen guys. Just find the carried down. Okay. Put the carried down into the SOFP. And then guys, you just have to check and see whether your question is balancing or not. Is it balancing? Yeah, it is balancing. Right. Now guys, let me teach you one more small part and I'll finish off today's class. Right. So this one guys all okay now. Just total up SOCE, take those answers inside where equity, then just balance off your SOFP. It is balancing because we have done properly with double entries. Right, let me guys teach you one important part and then let me finish off then today's class. Right. Now guys, let me teach you IFRS 18, the impact on your cash flow statement. Next week guys, once you become comfortable with IFRS 18, I'll teach you what is the impact that it has on ratios. Not much, but cash flow guys, it's having a small impact. Guys, first thing in our FR exams, cash flow full question will not come. They will ask extract of operating activity, maybe investing activity, maybe financing activity. Guys, if you have the notes, because I want to show you the changes, right? If you have my class notes, can you little bit tell me guys what are the things that I gave you, right, under the old syllabus for cash flow statement? Under IAS 1, cash flow statement guys was like this. Okay, right. Little bit check and see guys, do you all have my notes what I gave for cash flow statement by any chance in your writing book? I would have given what is coming under adjustments, all of that. Little bit check and see, do you all have that? Because if you all have that, I can easily connect and show you what are the changes. Little bit check and see guys in your writing book, do we have? Okay, in case guys you don't have, it's not a problem, but I'll tell you what changed. Okay, guys, cash flow statement, previous standard, IAS 1. How do we guys start the indirect method? Right? Normally, what will be the first sentence for cash flow statement, guys? Indirect method, we started off with profit before tax. Right? Earlier, guys, what we used to do, we used to start with profit before tax. All okay? Right. Guys, remember in IFRS 18 cash flow statement, okay, we are not starting with what you can say guys profit before tax, rather we are starting with operating profit. We are starting with operating profit, not profit before tax. Okay, that's change number one. Okay, wait guys, before that. Okay. Right, now guys, tell me today morning, now let me connect this and show. Okay, now guys, today morning for IFRS 18 profit and loss account, what are things guys that we normally had for P&L? We started off with guys revenue, then guys what did we have? Cost of sale, then we had gross profit, then we added other operating income, then we deducted other operating cost, then only we got operating profit. So guys, listen, now under indirect method, guys, earlier we used to start with profit before tax. No, nowadays we are starting with operating profit. All okay? Change number 1. Then guys, after profit before tax, what did we have earlier in cash flow statement? What is the topic called? Adjustments. Here also we have adjustments, but guys, listen carefully. Your adjustments will only come from what is inside this part over here. Because guys, I'll tell you revenue. Guys, what are two types of revenue? What we have? One is cash sale, other one is credit sale. Cash sale, if it's inside operating profit, is it a problem? No. Cash sale, cash flow statement, no problem. Credit sale, guys, normally who will be created? Debtors. Debtors are adjusted inside working capital changes. No, so this is not a problem. So understand, guys, inside cost of sale, inside other operating income, and inside other operating costs, any non-cash item, that only we are normally marking inside adjustments. Examples: depreciation, amortization, right? Then impairment losses, right? These are the things that we normally mark inside adjustment. That means inside cost of sales, other operating income, other operating costs. If there is any non-cash item, you guys should mark it inside adjustments and reverse it. Right, now guys, listen, previously in adjustments, I have taught you things like rent income, dividends received, all syllabus, right? Under IAS 1 in adjustments, if you check the notes, guys, which I gave you in the class, I would have given you under adjustments, rent has to be removed, dividends received has to be removed, interest has to be removed, all of that has to be removed. But guys, now you think and tell me, under IFRS 18, previously rent received, dividends received, interest paid, investment income. These should I remove under IFRS 18 adjustments? Now under IAS 1, we removed all of that. Tell me guys, those 5, what are the 5 once again? Rent income, interest received, dividends received, investment income, and maybe I said another one also, interest paid. These things under IFRS 18, should I remove them from adjustments? What do you think guys? Yes or no? The answer is no. You know why the answer is no? IFRS 18, we are starting with what? Operating profit. The 5 things that I mentioned: interest, rent received, dividends received, investment income, and maybe there's another one thing also what I mentioned. All these are guys coming before operating profit or after operating profit? All are coming after operating profit. No, that means are they inside this answer? No, that's why it doesn't have to come inside the new adjustments for the cash flow statement. Guys, remember, top of operating profit, if there is a non-cash item, that only we should take for adjustments. Previously, guys, we started with profit before tax. No, profit before tax means finance expenses, distribution expenses, administration expense, other income. All of that we had to pass. That's why I had to remove a lot of things. But guys, when you come to IFRS 18, top of operating profit, we have to only be worried about cost of sale, other operating income, and other operating costs. Only non-cash items which are inside that you have to remove. And also guys, disposal, gain or loss also will come under this particular syllabus. Okay. So remember guys, anything that comes under operating profit, we should not show. Understood? For adjustments, as a student, you have to only be worried about what is coming top of this and not what's coming after this. Right? So that's one of the biggest change that you need to know. Guys, then after this, we normally have working capital changes. That is same. Inventory, trade payable, trade receivable. One last change, guys. Now tell me, guys, after this, we used to get something called cash generated from operation. Guys, below this, we used to mark 2 things. What and what, guys, if you can remember? Very good. It was income tax paid. And what's the other one, guys? Other one was guys, interest paid, income tax. 1 minute. Income tax and interest. Okay. Guys, listen. Under the old standard, we had income tax and interest paid. No, income tax will still be there. The next big change, interest paid is no more an operating activity. Interest paid, guys, hereafter is a financing activity. That actually makes more sense. Now, earlier, a lot of students always used to ask me why interest paid is coming under operating activity. Because in income statement, guys, interest is what expense? Finances, no. Under IFRS 18 change, they have made the logical change. Interest paid is no more an operating activity. It's a what activity? Financing activity. So for cash flow statement, guys, these are the only changes that you need to know. Guys, change number 1, we are starting with what? Operating profit. Inside adjustments, what will come? Earlier we started profit before tax. Now we have to only start, guys, with operating profit. Second change, guys, what you should remember is that only what is inside cost of sale, other operating income, other operating cost. Only non-cash items which are inside that you have to be worried about when it comes to adjustments. These are the normal examples that you should be worried about. Earlier, things like rent received, interest received, dividends received, investment income, those and interest paid. You don't need to worry about that hereafter when it comes to adjustment, because all of the 5 items what I said now comes after operating profit. What comes after operating profit, you don't have to worry about for adjustments. You only have to worry about for adjustments numbers coming top of operating profit. Last change, interest paid is no more an operating activity. Interest paid is hereafter financing activity. These are the changes, guys, that you need to know for IFRS 18 cash flow statement. All good? Next week, guys, in the morning, I'll teach you what are the changes that we have for ratios. We'll do some consolidated ratios next week.